Hello, good morning friends. Today we are starting with CA final SFM revision batch. This batch will be very useful for May 2023, November 2023 exam. We are going to conduct the session every day except Sunday between 9:30 to 11:30, 2 hours per day, and the session will go for about 15 to 20 days. This session would be in English. Good morning Mehul, good morning Suraj, everybody good morning, and we are going to take all the important questions of all the topics, starting with bond valuation today, then we'll go to valuation of equity share, portfolio management, derivative, forex, business valuation, mergers and acquisition, and we'll take problems on money market instrument also. So this way it will be a comprehensive revision. Because it's a revision batch, so please let me have the liberty to understand that you must have done SFM once. So with that small assumption, I will have to go ahead that you have already studied SFM once. This batch will not be for those students who are doing SFM for the first time in their life. Okay, so you cannot start with this revision batch. Revision batch means we are going to have a holistic revision of your entire syllabus. Pavan, good morning. Prachi, good morning. Ishwar, good morning. Akshay Agarwal, good morning. We have uploaded the notes on our website vino.in. This is our website vino.in, where you will go to Students Corner and download the notes. Notes are in PDF format and they can be printed also. So I would request that if not today, then from tomorrow keep the printout ready so that you don't have to write the question. Question should be in front of you. We have given all the questions that we are going to take. Only questions are there in the notes. We will write the solution as if you are writing in the exam. You just go to our website vino.in, student corner, and you will find the notes there. Our website is vino.in. At the top you have student corner, you will find the PDF of these notes that we are going to take. If you have any query, you can ask me. Mr. Rajesh, good morning. Aruna, good morning. Mohammad Ahmed Siddiqui, good morning. Priyanka, good morning. Ajinkya, good morning. Those students who are in Pune, they can come and attend the class face to face at our Pune center located at Prestige Point, first floor. So you can come. Some students are from Pune, they can join directly face to face at our center located on first floor, Prestige Point, Shukrwar Pet. So I would be happy if I find some students in the class. Right now I am sitting alone and recording. Can we go ahead now? Mohammad Ahmed, good morning. So we are going to start with the very important topic, bond valuation. Bond valuation will have a weightage of 8 to 10 marks in the exam. Sometimes it can be even more than that. So dear student, I will begin with one important question on bond valuation. I will explain each and every term that will come in the question, and I will also give you some theoretical background of that. So are you ready? Are you ready? Yes or no? Please let me know. Are you ready? So we'll start with bond valuation first. First, question number 1. Those who have the notes, they can come to question number 1, which is from July 2021 exam. There can be a internet problem, so you can have a 5 to 8 second delay. So please cooperate. Check the internet at your end. You will be able to understand. Don't worry. I'll go today a little slow, as if I am taking a regular batch. Okay. So can we start now? Question number 1 is from July 2021 exam. An investor has recently purchased substantial number of 7-year. This is the time. 6.75%, that is the coupon rate. Rupees 1000, that is face value. So this is the maturity, this is coupon, this is face value bond with 5% premium payable on maturity. So the redemption will be at 1000 plus 5%, 1050 at a required yield of required YTM of 9%. YTM is 9%. However, due to a financial crunch, he is looking to sell this bond and has got a proposal from another investor who is willing to purchase these bonds by shelling out a maximum amount of 897 per bond. So he is planning to sell this bond for 897 today. Investors follow intrinsic value method for valuation of bond. So in order to find the value of the bond, we have to calculate the present value. You are required to determine first the market price, then the duration and the volatility of the bond. So from this question we are going to cover 3 aspects: how to compute intrinsic value, duration and volatility, means modified duration. The price of the bond today is the present value of all future cash flow. What is the duration? Duration is the average time required by an investor to recover his investment, and volatility of the bond means will take modified duration. It measures the relationship between change in the yield and the bond price. Required YTM of the investor. So you have to also calculate the required YTM of the new investor. The new investor is going to purchase this bond at 897. The new investor is going to purchase this bond for 897. So how much would be the yield for the new investor, and what is the relationship between the price of the bond and YTM? Okay. So one by one we'll solve. These are the factors given to you. At any stage you can ask query. Okay. Question number 1 from the revision notes. So first what we'll do? First we'll solve part 1, which is computation of market price, duration and volatility of the bond. So dear students, please follow me. This video lecture will be there in the app also after the lecture. In case if you miss something, or if you have missed something, you can check it there. Write down calculation of market price, duration and volatility of the bond. Draw this table first. Year, cash flow, PV factor at 9%, which is the YTM, present value, and year into present value. Year into present value. Okay. The question has 1000 rupees face value and 6.75% coupon rate. First 6 years, year 1, 2, 3, 4, 5, 6, year 1, 2, 3, 4, 5, 6, the investor will get a coupon of 1000 into 6.75%, that is 67.5, that is 67.5. So write down 67.5 6 times. Write down 67.5 6 times, and in the last year he will get 67.50 the coupon, plus he will also get the redemption 1050. The total amount he will get is 1117.50. 1117.50. Now I will ask you to do the remaining calculation. For calculating the intrinsic value of the bond, we will take present value, and for calculation of duration of the bond, we will multiply year into present value. I hope you have done this. Okay. So write down factor 1 divided by 1.09, 0.917, then multiply by 67.50, you will get 61.898, right? And then 61.898 multiplied by 1, same figure 61.898. Factor is printed in the question book. So in question you will see the factors, just copy the factor from there, 0.842 for second year. You can copy the factor from there and multiply by 67.50. Very good, Akshay. 56.835 and multiply by 2, 113.67. Factor for year 3 is given 0.772. Yes, Akshay, continue. Multiply 52.110. With the class you will also learn the presentation, you will also learn the speed, and into 3, 156.33. Everybody should reply. Year 4 factor is given in question 0.708. Those who don't have the question, please download it from website vino.in. $47.790, 191.16. One student has asked a query, can we directly use annuity? The answer is only if you have to compute present value. But if you have to compute duration also, then you cannot use annuity factor. For duration calculation, we require present value of each year because I have to multiply by year. So please continue with the factors given in the book. Please continue. Please also reply everybody. I will be very happy. 0.596, sixth year. Check the answer if you have done. 7th year factor is given 0.547. Multiply and multiply by 7 and multiply by 7. Now what you do, those who have done, take the total of this column, that will give you the present value of the bond or the current price of the bond that should be there, or what is called intrinsic value of the bond. And then you take the total of this last column also. This will be required for duration calculation. So one student has given the total of present value column 914. Very good, Akshay Agarwal. And anybody for the last column total? Last column total. Last column total. Approximately you are getting 5274. Yes, very good. One student has confirmed 5274. So this will be required for duration. The formula for duration is the summation of year into present value divided by present value. So that will help you to get duration also. So now write down below the table, please write down Rishabh is saying total of the last column is 5262. Let me check. 5274. Yes, that is okay. That small difference is okay. Rounding of difference is always okay. So price of the bond. Your first question was what is market price of the bond? The market price of the bond is 914.011 and the duration of the bond is equal to now in the exam the students lose mark because they don't write the formula properly. To get full marks, first write the formula, then write the answer. Formula is summation of year into present value divided by summation of present value. So that is, take the total of your last column 5274. Some students have got 5262. You can take that, no problem. Divide by 914.011. 914.011. So the answer comes to 5.77. 5.77. One student Rishabh has got 5.76. That is also okay. So what is the meaning of duration? It is the average time required to recover the investment. Okay. From the duration we get what is called modified duration or volatility of the bond. So please write down our next answer. What is the volatility of the bond? Write down. Everybody please reply. Volatility of the bond. That is modified duration is equal to, first write formula, duration upon 1 plus YTM. Duration upon 1 plus YTM. Duration upon 1 plus YTM. Write nicely. One day you have to revise also. Quickly, one day before the exam, I have found best of the lot questions for you. So duration formula, Sidana has given correct answer, duration upon 1 plus YTM. Give me the final answer now. Give me the final answer. 5.77 divided by 1.09. 5.77 divided by 1.09. So that comes to 5.28. 5.29 is also okay. 5.28, 5.29 is also okay. Students who are in Pune can come and attend the classes in our Prestige Point, first floor. Now there is another question number 2. What is the required YTM of the new investor? So write down required YTM of the new investor. This you can solve by applying the formula. The formula for YTM in case of a coupon bond. The formula for YTM in case of a coupon bond is equal to C plus RV minus CP, C plus RV minus CP divided by N upon RV minus CP by 2, plus CP by 2, RV plus CP by 2, RV plus CP by 2. RV plus CP by 2. I'll just start again. New investor. You have to look at the YTM from the point of view of the new investor. New investor is going to invest 897 rupees in this bond, correct? So for him, the amount he is going to invest is 1897. Please solve. Let me see who will give me the answer first. Yes, come on. Reply. Who will give me the answer first? Yes, Manan, please reply. Rishabh, please reply. Mehul, please reply. Anybody got the answer for this? So the answer is 9.18%. 9.18%. Approximately write down. 9.18% approximately. When you are using the formula method, you get approximate answer. You do not get 100% accurate answer. In order to get accurate answer, we can solve it by interpolation formula or IRR method. So one student is requesting, let us solve by IRR method. So suppose you don't remember the formula, then you can solve the rate of return using IRR formula. So please write down. Alternatively, required yield of new investor using interpolation formula. Mehul Garg got it right. 9.178% is also okay. Now we'll try by one more method. This formula can be used only for coupon bonds. Formula can be used only for coupon bonds. But this IRR method can be used for any type of question. So write down 4 columns: year, cash flow, PV factor at 9%, PV factor at 10%. Year 1-7. Now you can use annuity because my objective is only to find out IRR. If you have to calculate duration, then you have to write separately. Cash flow for first 7 year would be 67.50, that is coupon. At 9% annuity factor, first you have to take on your calculator annuity factor, then multiply by 67.50. Annuity factor multiplied by 67.50. You will get 339.72. Correct? Yes. Then you take annuity factor for 7 year and 10% multiplied by 67.50. So one student has got the answer at 10%, 328.62. Year 7 write down redemption 1050. Year 7 redemption is 1050. 1050. Seventh year factor, take on calculator seventh year factor, 1 divided by 1.09, press equal to 9 equal to 7 times, and then into 1050. You will get 574.39. Check. Follow the discipline. Do it yourself. Do not copy. And at 10%, try 10%. 10%, what is the answer? 538.65. Rishabh got it right. 538.65. You can write 538.82 or 65. Now please tell me the total 9%. At 9%, the total is 914.11 approximately. At 10%, the total is 867.44. Rishabh got it right. Very good. And how much amount he has invested? 897. So now you apply IRR method and get the answer. So the answer would be YTM is equal to, YTM will be equal to 9 plus, in the numerator take the difference between 914.11 minus the amount invested by the investor 897, and in the denominator take the difference between the two present values. Take the difference between the two present values. This is one way to calculate IRR. Anybody who would want to reply? Anybody wants to reply? Yes. So many students have got the answer now. 9.37 or 9.36%. Right. 9.36 is also okay. 9.37 is also okay. So this is called YTM using interpolation formula, and this is called YTM using formula method, but it has limited applicability. It cannot be applied. The formula cannot be applied for every type of bond. Now there is a last line. What is the relationship between price of the bond and YTM? So I will dictate, please write down. I will dictate, you will write down. Which method we should use in the exam? For a coupon bond, you can use this method, no problem, unless you are more comfortable with YTM. But for other questions, if it is not a coupon bond, then you can find out the YTM using interpolation only. Write down one line. Write down one line. Mehul, write down one line. There is an inverse relationship between bond price and YTM. There is inverse relationship between bond price and YTM. Mehul has got 9.67%. I think you need to just check your calculation again. It should be close to 9.37%. We'll go to next question number 2. This question was asked in November 18 exam, May 14 exam, RTP November 2021. This question is on convertible bond, and we are going to discuss various terms associated with convertible bond, right? And very easy question if you know the concept of convertible bond and the various terms used in connection with convertible bond. Question can be asked for up to 8 marks. Already asked. Now, the following data is related to 9% fully convertible. So 9% is the coupon rate, fully convertible into equity share debenture issued by Delta Limited at rupees 1000. 1000 is the face value. Market price of 9% debenture is 1000 and face value is also 1000. Conversion ratio is 25. One debenture will be converted into 25 equity share. Straight value of debenture is 800. Straight value of debenture means if there was no conversion option, that means there was no conversion feature, it was a plain bond without any additional feature, how much would the price be? In that case the price would be 800, but because it has a conversion feature, the price is actually 1000. Then market price of equity share on the date of conversion. The market price of the equity share is 30 rupees. Then expected dividend per share is rupees 1. Expected dividend is rupees 1. Now you have to compute following 7 items and I think you will get 1 mark for each correct answer. First is conversion value of debenture, market conversion price. Market conversion price, write down, it is also called conversion parity price. Write in bracket, or I think I have already written for you. Then conversion premium per share. How much premium per share you are giving? Ratio of conversion premium, premium over straight value of debenture, favorable income differential per share and premium payback period. So we'll solve one by one and I will explain it also. So with this you will have a good practice of convertible debenture or convertible bond, highly tested in the exam. So are you ready? Say yes. Everybody who is watching live telecast, they should say yes 3 times S after YE. Okay, so start. First write down, first answer write down, conversion value of debenture. Conversion value of debenture. That means if the debentures are converted into shares, what is their value in terms of market price? Yes, Ganesh, thank you. Yes. Mehul, yes. Rajesh Jain, yes. So please give me the answer now. Market price of one equity share is 30. Conversion ratio is 25. So Rishabh has already answered 750. Is right 750? So you will get 1 mark for this much effort. Darshana is also right. 750. Okay, try this one. Second answer. Market conversion price. This question is very important. You will get in your exam. Market conversion price. Market conversion price. Market conversion price is also called conversion parity price, which is equal to the market price of convertible debenture, market price of convertible debenture, market price of convertible debenture divided by conversion ratio. In the exam, first write formula, then write figures, then write answer. Minimum 3 steps you have to dedicate. Some student directly write the answer, then they might lose marks. So now you put the values. The market price of debenture is 1000. conversion ratio is 25, which means the conversion parity price is rupees 40. It is as good as paying 40 rupees for one share today. It is as good as paying 40 rupees for one share today. Sidana is right. Come on, next. Third answer, write down. Conversion premium per share. Conversion premium per share. Conversion premium per share means how much excess you are paying per share. How much excess you are paying per share. This question was there in November 2022 exam also. As I said, this question is very important. This was in November 22 exam also. Write down there, November 22 exam. Students who don't have the question paper will download it from website vino.in. This batch will be in English. So what is the answer here? Conversion premium per share. Is it 10 rupees? Yes. You can solve it by one more formula. Write down alternatively. I will give you both. Then whichever one you are comfortable, you can follow it. So write down alternatively. Conversion premium per share is equal to market conversion price minus market price of equity share. Market conversion price minus market price of equity share. Okay. So market conversion price was 40 minus 30. The answer is 10. You can use any of the two formulae. Don't solve by both because you don't have time in the exam. Now what is your next question? Ratio of conversion premium. Ratio of conversion premium. Ratio of conversion premium is in percentage term how much more percentage you are paying over the conversion value. You could have directly purchased 25 share, right? But you have not purchased 25 share, you have purchased one debenture and for that you paid 1000 rupees. So how much excess percentage you are paying? Right. Bond price minus conversion value upon conversion value. Jaju is right. Try. Give me the answer before I show you the presentation. First you will try. This is revision batch. You already know this answer. You have done in class also. So 1000 minus 750 divided by 750 into 100 into 100. So that is 33.33%. 33.33% is right. Jain is right. Sidana is right. One more. Premium over straight value of debenture. Premium over straight value of debenture. This you will answer in percentage. You are paying 1000 rupees, but a similar bond without conversion feature is available for 800 rupees. So you are paying 200 rupees more. You are paying 200 rupees more over and above on 800 rupees. So you have to express in percentage, right? Always write three things in such cases: formula, calculation, and the answer. So the formula is market price of convertible debenture minus straight value of bond divide by straight value of bond, and you will get 25%. You will get 25%. Is the answer 25% right? Please confirm. Yes, 25% is right. Next answer. Rajesh Jain is right. Rishabh is right. Uh, Favorable income differential per share. Favorable income differential per share. Favorable income differential per share. Next heading, write down favorable income differential per share. Favorable income differential per share, the formula is coupon interest from debenture. Coupon interest from debenture, how much interest you are earning from debenture minus how much dividend you would have earned from the share. Okay, that is favorable income. You have purchased a debenture, not a share. So how much extra you are getting, how much extra cash flow you are getting. Solve. Divided by conversion ratio. So the logic is that by buying a debenture, how much additional cash flow you are generating, income you are generating per share. So how much coupon you will get from this bond? 9% of 1000, 90 rupees. How much dividend you will get if you are going to buy the share? You will get 25 share into 1, that is 25 rupees. So you are actually getting 65 rupees more by buying a debenture. Divide by 25. What is the final answer? Rupees 2.60. Rupees 2.60 is your favorable income differential per share. You are getting 2.60 per share more by buying a debenture instead of share. And one last answer, premium payback period. One last answer, write down premium payback period. Premium payback period. Come on. Premium payback period means in how many months or year the premium that you had paid would be recovered. Is it right? From that income differential. So how much premium per share you have paid? In your earlier calculation, third question fee, 10 rupees you have paid premium. And how much is your favorable income differential? 2.60. So to recover that premium, conversion premium that you have paid for buying the debenture, approximately how many years it will take? 10 divided by 2.6. Is it 3.85 years? 3.85 years. So write down lower the better. Okay. This is your answer of this question. This was a question on convertible bond. So we have taken a coupon bond, we have taken a convertible bond. Now I am going to take, guess what I am going to take next. Question, which question? Question 3. But what is the importance of this question? It is based on callable bond. Yes, one student correctly guessed. We are going to take a question on buyback of a bond, callable bond, where the company has the right to call back the bond before the maturity. That is called callable bond. Okay. Why will a company want to call back the bond? When they had issued the original bond, the interest rate was very high. But after some years, the interest rate may have gone down. So now they can call back the old bond and issue the new bond at a lower interest rate, and they can save interest for the remaining period. Okay. Sometimes the company may not need a fund. So why to keep on paying interest when you don't need the fund? Is it right? So in that case, it will be better to call back the bond. or suppose my friend Adani ji has too much of debt. They want to reduce their debt in the balance sheet. So they can call back the bond, and this way the debt can be reduced. But usually the question in the exam is, should we call back the old bond and issue the new bond? That is a typical exam question. Should we call back the old bond and issue the new bond? So that will involve lot of calculation. There will be some cost associated with calling back the old bond, and there are some benefit associated with calling back the old bond. So what will be the cost of calling back the old bond? You have to pay premium on old bond, because that is the condition that in case if the company calls back the bond, they will have to pay call premium over and above face value. They will have to pay some amount. Secondly, they will have to again incur the flotation cost. They will again incur the flotation cost of the new bond. Sometimes there can be overlapping interest. What is overlapping interest? That is, you are paying interest on old bond and you will also pay interest on new bond for some months, because you cannot exactly synchronize the refund of the old bond and issue of the new bond. That is, you can't say on 1st March I will redeem also the old bond and I will issue also the new bond. So there may be some time gap, and therefore there is a overlapping interest. Plus there will be tax implication also. So tax implication would be on call premium, flotation cost. If the bonds are issued at a discount, then on discount also there will be tax implication. You will save interest on that. You have tax payment. So all this will be considered, and then we'll take a decision whether to redeem the old bond or not. Understood? So what we will do, we will basically calculate NPV of the redemption decision. And as usual, if NPV is positive, then accept the decision to refund the old bond. And if NPV is negative, then reject the decision to refund the old bond. So depending upon numbers, the answer can be refund the old bond or continue with the old bond. Only on pure financial ground we have to answer this question. Okay, without getting emotionally attached with anything, just do the calculation and answer. So I will read the question, write it. Very important, very important question. Again, expect in the coming exam this question. Messrs Trans India Limited is contemplating calling rupees 3 crore of 30 years rupees 1000 bond . 3 crore is the face value. Original bond was issued for 30 years, rupees 1000 bond. So 3 crore divided by rupees 1000. Can you calculate how many bonds were issued? How many bonds? Number of bonds? 30,000 bonds were issued. For some calculation, I will need this number. So remember everybody, 30,000 bonds were issued and it was issued 5 years ago. So 30 minus 5, how many years are remaining now? 25 years. It's called remaining maturity. And the original bond was issued at a coupon rate of 14%. Okay. The bond have a call price of rupees 1140. This is 1140. Now understand, you are going to pay 1140 per bond. Face value is 1000 rupees. 140 is called call premium. 140 multiplied by 30,000. 140 multiplied by 30,000. So 42 lakh rupees call premium you have to pay today. You have to pay today. Okay, the bond had a call price of 1140 and had initially collected proceed of rupees 2.91 crore due to a discount of 30 rupees per bond. So this original bond was issued at a discount, which means they are amortizing the discount. They are amortizing the discount. So total discount given was 3 crore minus 2.91 crore. Please help me. What was the total discount given? 0.09 crore, which is 9 lakh rupees. Yes or no? Divide by 30 years. So they are amortizing every year how much? 9 lakh divided by 30,000. So 30,000 into 5 they have already amortized. But 30,000 into 25 is still to be amortized. So when you are going to redeem the old bond, you are going to write off this unamortized discount immediately. Correct? When the bond is not there, the related unamortized discount will not be there, it will be written off. So you will get the tax shield on unamortized discount today, but you will not get it in future. You will get it today, but you will not get it in future. So you are only accelerating the amortization of discount. So this will have a tax shield implication. Okay. Old bond was issued at a flotation cost of 3,60,000. Same discussion for flotation cost also. You will today amortize the remaining flotation cost balance. Sir, how much is remaining flotation cost balance? 3,60,000 is original amount. Divide by 30 years. So can you calculate and give me the answer? 12,000 into 5. 60,000 already amortized. And 12,000 into 25. That is how much? 3 lakh rupees is unamortized. This we will amortize today on the date of refund of the old bond. Very good, Rishabh. 3 lakh is right. Next line. The company intends to sell rupees 3 crore. So this is a new bond having same 3 crore rupees value of 12% coupon rate. So they are going to save 2% coupon here, and it will be for remaining period, that is 25 year. It proposes to sell the new bond at par value. So good news is that the new bond will be issued at par. So no discount on the new bond. So new bond does not have discount related adjustment. The flotation cost will be 4 lakh. So 4 lakh divided by 25 will be amortized. 16,000 rupees per annum will be amortized over 25 years. Cash flow will be incurred today, but the tax shield will be over remaining 25 years. Company is paying 40% tax. So wherever tax shield is involved, take 40%, and after tax cost of debt is 8%, which means this is the discount rate. This is the discount rate for all present value calculation. If the question gives you the discount rate, take it as a discount rate. Now as the new bonds must first be sold and their proceed then used to retire the old bond, the company expects a 2 months period of overlapping interest. Oh, so 2 months you have to pay interest on old bond at 14%. Overlapping interest means for first month and second month you have to pay interest on old bond also, and you have to pay interest on new bond. So this is my cost. 2 months interest on old bond is also my cost, but interest is a tax deductible expenditure. So therefore we will also consider tax shield on interest. Question is, what is the feasibility of refunding the bond? Got it? So I am going to do first two calculations. In year 0, what will be my cash flow? In next 25 year, what will be my cash flow? This I have to convert into present value by multiplying by PV annuity factor. And then the third step will be to find out the net present value. If NPV is positive, we will refund the old bond. So let us solve. I have explained everything. Please mark it very important question. Right. Step 1. Please write down step 1. Calculation of cash flow of year 0. Follow my instruction and you have to present your answer nicely in the exam. Calculation of cash flow of year 0. Calculation of cash flow of year 0. Calculation of cash flow of year 0. So write down, first write down point A, call premium net of tax. Call premium net of tax. Point A, write down call premium net of tax. Call premium net of tax, you can understand, 140 rupees per bond we are paying. 140 means 1140 minus 1000 into 30,000. And if you have to convert into after tax cash flow, multiply by 1 minus 0.40. Multiply by 1 minus 0.40. Give me the final answer. Are you getting 25 lakh 20,000? So this is your cash outflow. This is your cash outflow. Then write down B. Flotation cost of new bond. No calculation involved. 4 lakh rupees outflow given in the problem. Flotation cost of new bond 4 lakh rupees outflow. Flotation cost of new bond 4 lakh rupees outflow. Now remember, you have issued old bond at a discount of 9 lakh. For 5 years you have already taken the tax benefit. Remaining 25 years you have not taken tax benefit. But that unamortized balance will be written off now. So you will get the tax shield today on unamortized discount of old bond. Point number C, write down. Point number C, write down. Tax shield on unamortized discount of old bond. Tax shield on unamortized discount of old bond. So you will write 9 lakh into 25 by 30. 5 years are over. 25 years are remaining and the tax shield will be 40% of that amount. So this is positive cash flow. How much is that? 3 lakh rupees. Positive 3 lakh. Very good, Sidana. Write down next point. Similarly, the flotation cost of old bond, you have already redeemed the old bond. So unamortized flotation cost will be written off today. So please write point number D. Tax shield on unamortized flotation cost. Tax shield on unamortized flotation cost tax shield on unamortized flotation cost of old bond. Take 3,60,000 into 25 by 30 and that you multiply by 40%. Is it 1,20,000? Do you have any more outflow in year 0? Guess. Last paragraph, read and guess. You have overlapping interest for 2 months. So write down point number E. Point number E, post-tax interest on old bond, post-tax interest on old bond post-tax interest on old bond for overlapping period of 2 months. For overlapping period of 2 months. For overlapping period of 2 months. Write nicely. This is how you have to write in the exam. And that is where the student don't get full marks. They just write some kind of calculation. So I will explain the calculation now. 3 crore into 14%. Understood? Into 2 by 12 because only 2 months you have to pay. And I have to calculate after tax cost of interest. So I will multiply by 1 minus 0.4. Final answer is 4,20,000 negative. Let me check who will give me the total first. This is my year 0 cash flow. Come on, take total. Everybody. The total is 29,20,000 negative. 29,20,000 negative. Rishabh is right. Very good. This is my year 0 outflow, net cash outflow. Now we are going to compute the cash flow of next 25 years. Okay. And then convert that into present value. So are you ready? Write down step number 2, calculation of cash flow of year 1 to 25. Calculation of cash flow of year 1 to 25. Calculation of cash flow of year 1 to 25. Right hand side amount. Write nicely. I am also teaching you how you need to present in the exam. First point A, write down. Main reason for refund is interest saving. Okay. So always write first point as interest saved. Net of tax. If tax rate is given in the problem, interest saved net of tax. How much interest you will save on 3 crore? 2% you will save. Earlier you were paying 14%. Now you will be paying 12%. So 2% on 3 crore. But because you are going to save interest, you will not be able to save tax. Right? So there is a loss of tax shield. Loss of tax shield. So I will take into 1 minus 0.40. This is the after tax effect. 1 minus 0.40. Do the calculation. Every year you will save 3,60,000 net of tax. Very, very good. Then what are the other cash flows? Now remember, you have taken the tax shield on discount of old bond in year 0. You will not get for next 25 years. You have got the tax shield on unamortized flotation cost in year 0. You will not get in the next 25 years. Plus, you will get tax shield on the flotation cost of the new bond. So these are the 3 points we have to write now. Point B, loss of tax shield. Loss of tax shield on discount of loss of tax shield on discount of old bond. Loss of tax shield on discount of old bond. In old bond you have issued at 9 lakh rupees discount, divided by 30 years. So every year you are getting 30,000 rupees amortized into tax rate 40%. Into tax rate 40%. So how much tax benefit you will not get in future? 40% of 30,000 rupees. 40% of 30 every year, 12,000 rupees per annum. That should be 30 because per annum amortization is 30,000 rupees. If you want to take 25 year, then this figure has to change. No? This is old bond. For new bond, I will take 25. Okay, you are right, but that is for new bond. Same way, write down. Loss of tax shield on flotation cost of old bond. Loss of tax shield on flotation cost of old bond. Right, 3,60,000 divided by 30 into 40%. So the answer is 4,800. Earlier you were getting every year 12,000 into 40% as tax shield, but that we have already considered in year 0. So you would lose in the next 25 years. So 4,800. And there is one advantage of issuing new bond. You will get the tax shield on the flotation cost of the new bond. Very good. Right. Tax shield on flotation cost of new bond. 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 So that will be 4 lakh rupees divided by, this is 25 year now. Your query is resolved. Why we have taken 25? New bond has 25 year life into 40%. So this is our benefit. So positive number. Tell me the total of this. Anybody for total of this amount column? $349,600. So this is my per annum benefit. This you will get for how many years? 25 years. Every year it becomes an annuity. So by multiplying by annuity factor, we will get the PV of saving, PV of benefit. So write down my step number 3, which is NPV calculation. So this is a very good presentation, and if you write like this, you will get full marks. Calculation of NPV. Right hand side amount. Calculation of NPV. So dear students, first write down PV of saving. PV of saving. PV of savings. PV of saving will be annual saving into PV annuity factor. Annual saving into PV annuity factor. 8%, 25 years. So take on your calculator annuity factor for 8% and 25 years and multiply by 3,49,600. Are you getting something close to 3731980? 3731980? 3731980. Got it? Now just compute the outflow which we have already done. Point B, less cash outflow in year 0. Less cash outflow in year 0. Everybody, what was the answer? Step 1 answer? 29,20,000. Amazing. So now you write down the last line, point C, NPV. Write nicely. Presentation is also important. Only when you are running short of time, then do directly. 811,980. Positive or negative? Positive. 811,980 positive. So what will be your decision? What will be your decision? will refund the old bond and issue the new bond. So write down the conclusion, decision, write down, refund the old bond, refund the old bond, refund the old bond. Okay, so that was a very important question on callable bond. We have covered most of the adjustment in this one example only. If tax is not given in the problem, then no adjustment relating to tax will be required. Now we'll take another highly important question on interest rate immunization. So another topic is interest rate immunization. Immunization means the change in the interest rate will not affect the return of the investor. Okay. Let us read the problem and I will explain it again. Are you ready? Everybody please say yes. Those who are studying online, please write yes 3 times. Yes, yes, yes. Then I will understand that yes, you are listening to me. Question is from November 18 exam. It was I think for 8 or 10 marks. Rajesh is yes. Rishabh yes. Mehul yes. Subhash Arora yes. Very good. I am glad. So one more question we'll take today, that is question number 4, and then we'll continue tomorrow after this question at 9:30. Please keep the printout ready. You can get the printout on website vino.in, www.vino.in. Naveen is saying yes, Priyanka is saying yes, and also please tell me whether you are enjoying this or not. Okay. Today was the first day, so there was some technical issue at the beginning, but now we have understood what are the problem that can arise. Naveen, Priyanka, very good. So you are enjoying this lecture. The following data are available for 3 bonds A, B, C. These bonds are used by a bond portfolio manager to fund an outflow scheduled in 6 years. To underline this, when are you supposed to pay a liability? You are supposed to pay some liability by redeeming this bond after 6 years. So we will say duration of liability is 6 years. Duration of liability is 6 years. Current yield is 9%. All bonds have face value of ₹100 each and will also be redeemed at par. So first you write down this question as very, very important for coming exam. Suraj is also saying yes sir, I am enjoying. Very good. When you are enjoying, I am enjoying. Interest is payable annually and this motivates us to put more effort. So there are 3 bonds. There are 3 bonds. Bond A, B, C. These are their maturity years and these are the respective coupon rates. First question is a bonus mark. Duration of each bond. Second question is the bond portfolio manager has been asked to keep 45% of the portfolio in bond A. So you are given a weightage of 45% for A and you have to also compute for B and C. Calculate the percentage amount to be invested in bond B and C that needs to be purchased to immunize the portfolio. Understood? So we have to ensure that duration of the asset should be equal to duration of liability should be equal to 6 years. So we'll have to solve a simple equation and find out the weightage of bond B and bond C. After the portfolio has been formulated, the interest rate change occurs, increasing the yield to 11%. So what has happened? The market rate of return has changed. It has become 11%. Because of this, the new duration of these bonds are bond A 7.15, bond B 6.03 and bond C 4.27. So these are the duration they have already calculated for you. Say thank you sir, thank you institute. Otherwise they can ask you to again calculate, and for 3 hours you will just do the duration calculation. Is the portfolio still immunized? Why or why not? So you have to recalculate the duration of portfolio. Okay, you have to recalculate the duration of portfolio using revised figure, and if it is equal to 6, you will say portfolio is immunized. If it is not equal to 6, you will say portfolio is not immunized. Next is determine the new percentage of B and C bonds that are needed to immunize the portfolio, bond A remaining at 45% of the portfolio. So this question and this question is same, only you have to use different data for solving that problem. Is it right? So how do you compute the duration? There are two ways you can compute the duration. One is by using the formula we have used in the first problem. Second is by a formula method. Directly apply the formula and you will get the answer. So this time I am going to solve it by another method which you will like it. If you understand, you can do faster. This is for time saving exercise. So learned student, please write down, first write down bond A. Bond A. Bond A, write down. First we'll compute present value. Present value of bond A is equal to, what is the coupon rate of bond A? 10%. Can you see 10%? 10% of 100 rupees 10 and multiplied by the current yield is 9% given. So 9% will be the discount rate. 10 year is the maturity plus 100 rupees face value into PV factor 9%, which is the YTM today, and 10 year. Solve. Kindly solve and find out the present value. Kindly solve and find out the present value of the bond. So that is 10 into 6.4176 plus 100 into 0.42241. Yes, please reply. What is the final answer? The student can trust me with the factor and you can go ahead. Anybody final answer? The final answer is 106.417. Please write it down, you can check later. 106.417. Then you write down current yield. The current yield formula is annual coupon upon current market price. Annual coupon upon current market price. Current yield formula is annual coupon upon current market price. Annual coupon upon current market price. 10 rupees coupon 106.42. Mehul Garg is right. Rajesh Jain is also right. Is 9.40%. Now write down the formula of duration directly. This is the formula you can apply for a coupon bond. Formula is current yield upon YTM. Current yield upon YTM upon current yield upon YTM into PV annuity factor bracket YTM comma N upon into 1 plus YTM plus in bracket 1 minus current yield upon YTM into N. Ready? Put the values. How do you put the values? Current yield is this 9.4, write down. YTM is 9% given in the problem. In the question there is a small drafting mistake. Current yield is 9% written. It should be YTM is 9%. It should be YTM is 9%. Into PV annuity factor 9% comma 10 year into 1 plus 0.09 plus 1 minus 9.4 divided by 9 into 10. Just try yourself. Try. $1.0444. Annuity factor we have already calculated, so don't waste time. 6.4176 again into 1.09 plus in bracket 1 minus same 1.0444 into 10. So that gives me final answer 6.82 years. Okay. If suppose you find this is difficult, then you can follow the earlier method. Summation PV into year upon summation PV. Both will give you same answer. Is the answer right? 6.82 years. Okay. Say yes or no. Okay, now you write down bond B. Bond B, same process will follow. In bond B, write down next line bond B. Present value is equal to now here the coupon rate is 11%. So 11% of 100 will be 11. 11% of 100 will be 11 into PV annuity factor bracket 9% comma 8 years. It has 8 year maturity. 9% is the YTM plus 100 into PV annuity factor 9% comma 8. Solve. Just write it down, later on you can check. 111.0698. Okay. Write it down, later on you can check. Yes. Now write down below that current yield. Current yield is equal to 11 rupees. What is 11? Coupon. And current market price, the previous answer, is 9.9%. 9.9%. Now write down duration. Don't write the formula again. In one answer write formula only once. Put the values now. Duration equal to 9.9 divided by 9 into PV annuity factor 9% comma 8 years into 1 plus 0.09 plus in bracket 1 minus 9.9 upon 9 into 8 into 8. Solve. Write down the answer 5.84 years. Later on you can check. 5.84 years. Is it right? 5.84 years. 5.84 years. Now I will tell you one more thing before I go to bond C. If suppose the coupon rate is 9% and YTM is also 9%, what happens? The price of the bond is equal to face value of the bond, correct? If coupon rate and YTM are same, the price of the bond will be equal to face value of the bond. So if you look at the third bond C, the coupon rate is 9% and YTM is also 9%. So therefore there is no need to calculate. The price of the bond will be equal to 100 rupees only. And in case if price and face value are same, the current yield and YTM will also be same. Current yield will be 9 divided by 100. Current yield will be 9%. YTM is already 9%. So this portion becomes 1. This portion becomes 1. So this entire portion will become 0 because 1 minus 1. So duration will be only equal to this much. So that will save your time for the third bond if you know this basic thing, that if coupon rate and YTM are same, price is equal to face value and current yield is equal to YTM. So with that knowledge, we will go ahead, write down bond C. Rishabh is right, intrinsic value is equal to face value. So bond C, write down, I am going to save your time. Coupon rate is equal to YTM. Bond is trading at par. The bond is trading at par. That is rupees 100, write down. That is rupees 100. Then write down duration. Now I have given you the logic of this shortcut formula. Duration is equal to PV annuity factor, because current yield and YTM will be same, so the ratio will be 1. Solve. PV annuity factor 9% comma 5 year into 1 plus 0.09. Give me the answer now. One person has already answered. 4.24 years. Rishabh Sidana is right. Anybody else? Please. Is right? 4.24? 4.24 years is right. Okay. So we have computed the first part of this answer. There are 3 more parts. Due to some work, today we'll stop here and we are going to continue tomorrow at the same time, 9:30 AM. So thank you very much for joining me today, and I wish you will continue with this batch and you will get very important questions. Thank you very much. We are going to end the session today. Hello, good morning friend. We are solving an important question on bond valuation. Question number 4. The first part of the question was calculate the duration of each bond. Calculate the duration of each bond. So in that case, we have already done that calculation, first part, by applying the formula of duration. You can solve by tabular format also. You can solve by tabular format also. Now we'll go to the second part of the question. What was the second part of the question? I'll read from the question paper. I'll read from the question paper. What was the second part of the question? It was to second part, the bond portfolio manager has been asked to keep 45% of the portfolio in bond A. So weight of bond A is defined. Calculate the percentage amount to be invested in bond B and C that needs to be purchased to immunize the portfolio. So this is a problem of immunization. In case of immunization, the duration of the liability should be equal to duration of the asset. So first point is, what is the duration of liability? So for that, read the first and second line of the question at the top. It says these bonds are used by a bond portfolio manager to fund an outflow scheduled in 6 years. So which means that the liability has a duration of 6 years. So the duration of the bond portfolio should also be 6 years. Second issue is, how do you calculate the duration of a bond portfolio? It is the weighted average duration. So second concept is, the duration of a portfolio of a bond is the weighted average duration. We want the portfolio duration should be 6. We are given the weight of portfolio A, bond A. So we have to find the weight of bond B and bond C. So if you say that portfolio bond A has a weightage of 0.45, B plus C will be how much? 0.55. So if you assume that A is 0.45, B is suppose X, C would be 0.55 minus X, and then we can solve an equation and find the value of X, and we'll find the value of weight of bond B and bond C. So start writing now. Percentage amount of investment required in bond B and bond C. Percentage amount of investment required in bond B and bond C. A very easy question. If you go well prepared in the exam, then amount invested in bond A is equal to amount invested in bond A is equal to 0.45. Amount invested in bond A is equal to 0.45, which is given in the problem. Next line, write down hence amount invested in bond B, and C is equal to 1 minus 0.45. 1 minus 0.45 is equal to 0.55. Now write down below, let the weight of bond B be WB. 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 Okay. Below that, write down, therefore weight of bond C is equal to 0.55 minus WB. 0.55 minus WB. Just wait a minute. Is right? Are you able to watch the video properly? Please reply yes or no. Student studying at home, is the video and the presentation Understandable? Okay, so let us continue. Next line, write down, in order to immunize the portfolio, in order to immunize the portfolio, in order to immunize the portfolio, duration of asset is equal to, duration of asset is equal to duration of liability. Duration of asset equal to duration of liability. Duration of asset is equal to duration of liabilities. Now write one equation. The equation will be WA into DA. DA is duration of bond A. DA stands for duration of bond A, plus WB into DB, WB into DB, plus WC into DC, plus WC into DC is equal to 6, is equal to 6. This is the equation, and now you write the figures below the equation. WA is 0.45 given in the problem, 0.45 into 6.86, which is the duration of bond A we have computed earlier, plus WB into 5.84 into 5.84 plus in bracket write 0.55 minus WB, that is weight of bond C, into 4.24 into 4.24 is equal to 6, is equal to 6, is equal to 6. Now please solve the equation. How did you get 6? 6 is given in the first second line. The duration of the liability is 6 years. Outflow is planned after 6 years. So we have to ensure that duration of the bond portfolio should also be 6 years. So who will give me the answer of WB? WB is the missing figure here. WB is the missing figure here. Anybody who got the answer for WB? Please solve. WB is coming to, Rishabh has got it right, 0.3631. You can write 0.36 also. 0.36 also you can write. And then you will calculate WC. WC is equal to, come on, WC is equal to 0.55 minus 0.3631. So Prachi Kothari is also right, 0.36. WC Rishabh is right, 0.1869, or you can write 0.19. 2 digits are also okay. 2 digits are also okay. Kothari is also right. So this is the answer of second part. Agreed? Now we'll go to the third part. Write down answer part 3. Answer of part 3. Answer of part 3. Everybody should reply. I will read the question part 3 again. Just they have changed the data. after the portfolio has been formulated, an interest rate change occurs. Okay, so after the formula, this weight you have assigned, market interest rate has changed, increasing the yield to 11%. So YTM has changed. The YTM will change, the duration will change. So they have themselves done the calculation of new duration. The new duration of these bonds are A 7.15, B 6.03, and C is 4.27. Is the portfolio still immunized? Is the portfolio still immunized? Why or why not? So what you should do now, you should calculate the duration of this portfolio again based on revised duration. Weights you have computed, and if it is equal to 6, then we will say it is still immunized, and if it is not equal to 6, then we will say it is not immunized. Is it right? So write down the answer, part 3. Write down the heading calculation of revised portfolio duration. Calculation of revised portfolio duration with revised yield. Calculation of revised portfolio duration with revised yield. Weights we have computed, duration they have given. So write down below is equal to 0.45 into 7.15, that is your weight of bond A and the revised duration of bond A, plus 0.3631 into 6.03, that is revised duration of bond B, plus 0.1869 into 4.27, that is revised duration of bond C. I would want student should give me the answer. Student should give me the answer. What is the revised portfolio duration? So one student has said 6.20. Let me check. Yes, you're right. Amazing. Sidana got it right. Prachi got it right. 6.20. Okay. But duration of the liability is 6 years. Duration of this bond portfolio is 6.20. So my question is the portfolio still immunized? So you will write a note. Write a note below. No. Portfolio is not immunized. Portfolio is not immunized. Portfolio is not immunized. As the duration of the portfolio has increased from Mehul Garg is also right. 6.21 is also okay. Has increased from 6 years to 6.21 years. Has increased from 6 years to 6.21 years. This was your answer of the third part. Fourth part is determine the new percentage of bond B and bond C that are needed to immunize the portfolio, bond A remaining at 45% of the portfolio. So what they have done here, they have just asked you to revise the weights based on revised duration. Am I right? Weight of bond A is still 0.45. You have to find the weight of other two bonds with the new duration. So write down answer of part 4. Answer of part 4. Answer of part 4, we have to solve it like second part only. Keep the question in front of you. This question paper can be downloaded from our website vino.in. you will find in the resource section, free resource section, these notes. You can download and take a printout. So write down new percentage of B and C bonds, new percentage of B and C bonds that are needed to immunize the portfolio, It's a lengthy question but easy question. So I am going to write the equation again, same equation, WADA plus WBDB plus WCDC is equal to 6. Solve. WA is 0.45, which is given in the problem. Revised duration of bond A is 7.15 plus WB into 6.03 plus in bracket 0.55 minus WB into 4.27, and that is equal to 6. Let us say who will give me the answer first. Solve for WB. Student will have to solve. Then only I will be able to understand that yes, you are learning. Anybody wants to reply for weight of bond B? Weight of bond B is 0.246. Very good, amazing. Weight of bond B is 0.246. Very good. Now tell me weight of bond C. Take 0.55 minus 0.246. Very good. 0.3034. 0.3034 is right. 0.3034 is right. But later on, do we need to write the whole formula again? There is no need to write the formula again. The good question is, you can just remove this line. This is what your query is. You can remove it. This line is not actually required. You are right. Just for discussion purpose, I have brought it again. Okay. So this answer finally is over. It was a good question. You can get full marks by solving like this. So today we will take one more question. Prachi is also right. Question number 5. Question number 5 is based on forward rates. Question number 5 is based on forward rates. So these are the different varieties I have taken in the revision batch. Question number 5 in front of you. Below is a list of prices of zero coupon bond of various maturities issued by a company. So these are zero coupon bond. Zero coupon bond means no interest paid during the lifetime of the bond. The bond will be issued at a discount and redeemed at par. Okay, of various maturities. Year 1 maturity. Face value is 1000 rupees, but the price is 943.40. Maturity is 2 year. The price is 873.52. The maturity period is 3 year. The price is 816.37. Find the forward rates. So you have to find the forward rates. Is it right? What is forward rate? The rate that we expect will be prevailing in future. The rate that we expect will be prevailing in future. That will help us to sometimes take decisions. Sometimes it gives rise to arbitrage opportunity also. Okay. Now this is first basic question of forward rate. Second question is, suppose an 8.5%, this is your coupon rate, rupees 1000 face value, this is face value, 3-year maturity bond. So there is another bond which is a coupon paying bond which pays 8.5% coupon, 3-year maturity, of a similar company is available in the market. What would be the appropriate price of this bond? What would be the appropriate price of this bond? So this answer can be found out by using the forward rates that we will calculate in the step number 1. Is it right? So how do you compute the forward rates? What will you do first? What will you do for computing forward rates? First step will be to find out YTM of each bond. Is it right? So write down step 1. Step 1. First we should calculate the yield of, zero coupon bond. Using the YTM of zero coupon bond, we are able to calculate the forward rate. Now tell me, I am going to ask you a question to check your understanding. First we will calculate the YTM of first bond whose maturity is 1 year. Price is 943.40 and face value is 1000 rupees. What will be the YTM of this bond? Now that 56.60 is the amount. We have to answer in percentage. So you divide by 943.40. Difference you divide by, yes. So the answer for the first bond, it seems, would be 6%. So write down the equation. First write down, we will solve following equation. In a zero coupon bond, all of you know, in a zero coupon bond, the price of the bond today is the present value of the face value or future cash flow. Future cash flow is only face value on redemption. Solve. So this equation you will use for all the 3 bonds. Price of ZCB is equal to face value upon 1 plus R to the power n. So now we'll first compute. Under that, write down calculation of R01. It means the YTM of 1 year bond today. Using 1 year bond, calculation of R01, spot rate for 1 year maturity. Is it right? R01 means spot rate for 1 year maturity. So you will take 943.40 is equal to 1000 divided by 1 plus R to the power 1. Solve it. Everybody please solve it. So you are getting 6%. You are getting 6%. Anyway you present, your answer should be 6%. Anyway you can present, your answer should be 6%. You can directly take the difference and divide by 943.40. That is also okay. For 1 year bond, you can solve by any method. Right? Now below that write down calculation of, next line, calculation of R02 using 2 year bond. Calculation of R02 using 2 year bond. Calculation of R02 using 2 year bond. Yes, please come on, reply. What will be the YTM of a 2 year zero coupon bond? So I will write the equation like this. Just wait a minute. I am just trying to make some correction in the presentation. Can you see the screen now? Hello students, can you see the presentation now? Can you see the presentation now? Okay. Sorry, there was some setting issue. So write down the answer now. 873.52 equal to 1000 divided by 1 plus R02 to the power 2. So this is the yield of a 2-year zero coupon bond. Solve. So how do you solve? So R02 will be equal to 1000 divided by 873.52 to the power 1 by 2 minus 1. Solve. First to take on your calculator this divide by this. Press the square root function for 1 by 2. Press the square root function for 1 by 2 minus 1. So how much is the answer here? Yes, Mehul Garg has given 7%. Very good. Now write down same calculation. Do little fast now. You have understood. Calculation of R03. Calculation of R03 using 3-year bond. Calculation of R03 using a 3-year bond. So here the equation would be like this. Present value is given in question 816.37 is equal to 1000 divided by 1 plus R03 to the power 3. 1 plus R03 to the power 3. Okay. These are basic things you have to know. And how do you solve this R03 equal to? Take 1000 divide by 816.37 to the power 1 by 3 minus 1. Third root you have to take. You have to take the third root. Yes, come on. This time it is a challenge. This is 7% only. Huh? How did you get 7%? Okay. So there is a trick on the calculator that first you type 1000 divided by 816.37. Okay. You will get some number 1 point how much? 22. 2249 and 0.3333. This is the answer. Take square root of this number 12 times. 12 times. Then minus 1. Minus 1. Multiplied by 0.3333 plus 1. Multiply equal to 12 times. Multiply equal to 12 times. So how much is that? 1.07. So 1.07 minus 1.07. Therefore, the answer is 7%. So these are the YTMs. These are not forward rates. These are the YTMs. Now we will find out the forward rate, which is your first question. Write down step number 2. Step number 2 would be forward rates. Step number 2, write down forward rates. Write the formula for forward rates. Forward rate is equal to 1 plus YTM T to the power T upon 1 plus YTM t minus 1 to the power t minus 1 to the power t minus 1 and then minus 1. This formula you should know for forward rates. Okay, this formula will save a lot of time. Now for year 1 always forward rate and YTM will be same for year 1. So basically we have to do the calculation for second and third year. So write down one note below. Note forward rate for first year. Forward rate for first year is same as YTM of 1 year bond. Is same as YTM of 1 year bond. Is same as YTM of 1 year bond. That is 6%. That is 6%. Same as YTM of 1 year bond, that is 6%. Okay. Now write down below that a small table will draw for year 2 and 3. Okay, right. Now draw one table. F12 means forward rate for the second year. What will be interest rate after 1 year for a period of 1 year? What will be the interest rate after 1 year for a period of 1 year? So what will be the interest rate in the second year? So write the formula. Please write the formula. 1 plus 0.07 to the power 2, which is the YTM of second year, 0.07, divided by 1.06 minus 1. So this is approximately 8%. Okay, now I would require you to try the next one, F23. I want you to try F23 in the same manner. This is a revision batch. Students should be capable of solving. So F23, come on, F23. Those who don't have the notes can download it from the website. F23. Yes, come on. I am waiting for you. And you are also waiting for me. Who will blink first? So the answer is 7%. The answer is 7%. Very good, Rishabh. 7%. Is it right? You forgot the power. One student is saying he's forgetting the power. Don't forget the power. You don't know the power of the institute. Okay. Their power will push you down by 6 months. So this was the answer of forward rate. Now next question is, what is the price of a bond? What is the price of a bond which pays a coupon of 8.5%, face value is 1000 and the maturity is 3 years? Using the forward rates we can find it out. Is it right? Or using the YTM we can find it out. So write down the next answer. Calculation of the price of the bond. Calculation of the price of the bond. We have got the forward rates for year 1, 2, 3, correct? So how do you calculate the price of the bond using forward rate? Write down price is equal to first year coupon will be 8.5% of 1000 rupees, 85, correct? And the first year forward rate or YTM is given 1.06%. So this is the present value of coupon of the first year. Now this is the present value of the coupon of the second year. Why we have taken like this? Understand, there are 3 years involved. 6% is the forward rate for this year. 8.009% is the forward rate for this year. So if you will get 85 rupees here, first you will discount by 8.009%. This amount you will discount by 6%. So you are discounting 1 year at a time. You are discounting 1 year at a time. So therefore we have to divide by, actually we are dividing first by this factor and then we are dividing by this factor. And the same thing for third year also. In the third year we will get 1000 face value plus 85 rupees coupon. And the third year forward rate was 7%. So you will first bring it to this point by 7%, bring it to this number by 8.009%, and bring it to year today by 6%. So that is the answer. Please solve. Let us see who will solve it first. Let us say who will solve it first. Come on. Rates are different for every year. So we are basically pulling it down 1 year at a time. Yes. So if you get 1085 at the end of third year, the discount rate for this period is 7%. So we have taken 7%. Then you will get a present value at this point. To bring it to this point, you discount it by 8.009%. You got the value here. To bring it down to year 0 level, you discount it by 6%. So who got the answer? Anybody who got the answer? Check the final answer. This way, using forward rates, we can compute the price of a coupon bond also. So please reply if you can. What is the answer? What is the answer? Please reply. What is the answer? $1040.12. 1040.12 is right. So this is how you calculate the price of a bond given the forward rates. And how do you compute the forward rate? By using YTM. First you have to get the YTM of zero coupon bonds. Okay. If the rates were like different for first 2 years, then you could have taken a PGA for 2 years. Right? Yes, if the rate was same for first and second year. If the rate is same, you can apply the annuity factor. Okay. So this was bond valuation. We'll start with this next topic, valuation of shares. This topic is again important for exam. Question can be asked from 4 to 8 marks on this topic. So let us start with one November 2020 question for 8 marks. A little tricky question if you have not prepared well in advance. So I would highly recommend that you must prepare this question before you go to the exam. Question number 1 from November 2020 exam for 8 marks. An investor is considering to purchase the equity share of LX Limited, whose current market price is rupees 112. Current market price is given 112 rupees. Okay. The company is proposing a dividend of rupees 4 for the next year. Next year underline. So D1. Next year means dividend of year 1. Dividend of year 1. Now LX Limited is expected to grow at 20% per annum for the next 4 years. It is expected to grow at the rate of 20% per annum for the next 4 years. So every year the dividend will grow at the rate of 20% till 4th year, and then what will happen? The growth will decline linearly to 16% per annum after the first 4 years. So see, the growth rate will be, suppose I draw a line, the growth rate will be 20% for year 1, 2, 3, 4, and then it will decline every year. It will decline every year to 16%. From 20 it will become 16 over the next 4 years. Okay, so each year how much will be the decline? Each year how much will be the decline? Decline will be 1%. Decline will be 1%. So it means the growth rate will become 19, 18, 17, and then it will become 16, and it will remain at 16 forever. Then it will remain at 16 forever. Okay. Thereafter it will stabilize at 16% per annum infinitely. The investors requires a return of 20% per annum. So this is my discount rate. You are required to calculate the intrinsic value of the share of X Limited. That means present value of future cash flow. And then, is it worth to purchase the share at this price? So you have to compare with 112 rupees. Compare with 112 rupees and check whether you need to buy the shares or not. So what is the new concept in this question is that the growth rate will decline linearly to 16% per annum after the first 4 years. The growth rate will decline every year till it reaches 16%, and then it will stabilize at 16% per annum for infinite period. So you have to find intrinsic value and you have to find whether it is advisable to purchase the share or not. So how do I solve it? If you know the concept of this linear decline in the dividend rate, you can easily crack it. Linear means equal decline in each year. Equal decline in each year. So we will assume equal decline in each year means 1% decline in each year. So can we now solve by preparing a table? Say yes. Yes sir, very good. Write down calculation of intrinsic value of shares. Calculation of intrinsic value of shares. Now I hope the audio, video, presentation, everything is clear. So this is a question on multi-period growth model. This type of problem is called multi-period growth model, where growth rate is high in the initial years, slowly and slowly they start declining. So whether it is Microsoft company or Google company or Infosys, everybody has to go through this. First few years they are making super normal profit, then they give more dividend, but later on as the competition increases, no new innovation happens, the growth rate starts declining and then it becomes stable at a normal rate. So I am going to draw total 5 columns. First column write year, second column growth rate, third column dividend, fourth column PV factor at 20%, which is given in the problem. So respect the institute, they have given you the factor, and last column present value. So first you write down year 1. First write down year 1 growth rate 20. But they have given year 1 dividend is 4 rupees. So don't further add 20%. It is already including growth of 20%. Read the second line. The company is proposing a dividend of 4 for the next year. So some student might take 4 plus 20%. It is 4 only. Discounting factor printed in the question book 0.833. Kindly multiply 3.33. 3.33. Now year 2 write down. Now you will add 20%. First, second, third, fourth. Growth rate is 20%. 20%. 4.80 factor type from the question book 0.694 into 4.80 3.331. Come on, next year 3 20%. Add 20%. 4.80 plus 20% 5.76 factor 0.579 multiply 3.335. Year 4 again 20%. Up to year 4 the growth rate will be 20%. The factor is given 0.482 multiply 3.332. Everybody should reply. Now wait. After year 4, the question says third line, growth will decline linearly. Growth will decline linearly. There may be a spelling mistake in the book. Linearly means by equal percentage. Linearly to 16%. So from 20 it will become 16 linearly, equally. So we will assume decline is by 1%. The question is not very clear on that. After the first 4 years, so it will become 19. So now your dividend will be previous dividend plus 19%. 8.225. Factor is given 0.402. Multiply. Kindly multiply 3.307. Right. Year 6 18%. Take 8.225 plus 18%. You will get 9.706. Factor is given 0.335. Multiply 3.251. Very good. 7. Growth rate will be 17 now. Take the previous dividend plus 17%. 11.356. Factor is given 0.279. Come on, student, come on, multiply. 3.168. Now after that, from 8th year and onward, the growth rate will be 16%. So it will become a constant growth model formula. You remember constant growth model formula D1 upon KE minus G. So that means we have to make a small working note for that. So from 8 till infinity, 8 to infinity, we will prepare a working note for that. The growth rate will be 16%. Now don't take this figure and plus 16. That will be only 8th year, but 9, 10, 11, 12 till infinity, the dividend will continue to grow at the rate of 16%. So it becomes a perpetuity. So I will have to apply a formula below. Write down below working note 1. Working note 1, write down terminal value in bracket P7. P7 means price of the share after 7th year. Price of the share at the end of 7th year. Price of the share at the end of 7th year. Okay. So how do you calculate it? P7 is equal to D8 upon KE minus G. D8 upon KE minus G. Come on. Dividend of the 8th year will be dividend of the 7th year into 1.16, 16% growth, divide by cost of equity is given in the problem 20% and the growth rate is given 16%. Yes, come on, Mehul, Rishabh, please reply. Priyanka, Prachi, please reply. Preeti, all students must reply the answer. Haji, how much is the answer? Final answer 329.324. Anybody for this? Approximately 329 you are getting? 0.32. Okay. Prachi is also right. Rishabh is also right. So write down that number in the main page now. Bring that number here. This is not dividend, but this is price at the end of 7th year. This is price at the end of 7th year. So which factor you will apply? 7th year factor or 8th year factor? Which year factor you will apply? 7th year factor or 8th year factor? Present value factor. 7th or 8th? This is not dividend. This is price at the end of 7th year. So I have to bring it to year 0. So the factor would be of 7th year. Same factor. Same factor. 7th year is right. Preeti is also right. Mehul is right. Multiply now. 91.880. Now I want to check who will give me the total first and correct. Start. Competition starts now. Everybody. There are some students in the classroom attending physical batch and there are number of students attending from home. So I want to see who will answer first, the physical class student or the online student. 114.94. Oh, physical class student got it right. Probably because of advantage of face to face. No internet lag. Maybe the students who are learning at home, there is a lag of 1 or 2 seconds. But they also got it right. Kothari got it right. Kabra got it right. Anandam got it right. Now the question was whether it is worthwhile to purchase the share. Market price is 112. Market price is 112. Intrinsic value is 114. You are getting the share cheaper. So tell me again, buy or not to buy? Buy or not to buy? Buy or not to buy? Mehul is right. So what advice will you write? Should the investor buy the share or not? The answer is yes, buy, because it is cheaper. Yes, you have some query? Write down advice. That is a mistake. This is 114. 114.94. Right, 114.94. Everybody is saying buy the share because it is undervalued. Write down the note and then conclude the answer. The intrinsic value is rupees 114.94. Whereas the current market price is 112. Whereas the current market price is 112. Therefore, the stock is underpriced. Write nicely. Hence, it should be purchased. Hence, it should be purchased. Hence, it should be purchased. Yes, cost of equity means investors required return 20%. That is the discount rate investor will use to calculate the present value. So this answer is over. Question for 8 marks in the exam, bonus mark. Okay. So do the practice before you go to the exam. Looks easy once you solve. Now try question number 2. This is from July 21 exam for 5 marks. NM Limited is aspiring to enter the capital market in 3 years time. NM, Narendra Modi Limited. Okay. Okay. We will not make more comments on that. The board wants to attain the target price of 70 for its share at the end of 3 years. So what is the target price after 3 years? 70 rupees. The target price is 70 rupees. The present value of the share is 52.03. What is the present value? 52.03. Dividend is expected to grow at a rate of 15% for the next 3 years. NML uses dividend growth model for its projection. The required rate of return is 15%. That is your cost of equity or discount rate. Very interesting question. You are required to calculate the amount of dividend to be declared by the board in the base year so as to achieve the target price. So they have given you the answer 52.03. This is P0. This is P3. D1, D2, D3 is not given. The student has to find D1. The student has to find D1. First chance to you. First chance to the student. Suppose you are appearing in this exam and this question appears for 5 marks. What would be the dividend of the base year, means first year, so as to achieve the target price? Yes, anybody wants to reply? Again you have to solve equation. Is it right? Yes, students are requested to answer. What will be the dividend to be declared by the board in the base year to achieve the target price? So D1 you have to find. You can assume D1 as X. This will be X into 1.15. This will be X into 1.15 square because the growth rate is 15%. And P3 is 70. So you will discount it and it should be equal to 52.03. So once after solving it, you will get the answer X, and that is your answer. I have given you enough hint. For discounting purpose, factors are given in the question. Come on, come on. Anybody? I hope all of you are awake. Or have you gone into the sleep mode? Please reply. Check whether you are exam ready or not. Are you exam ready? If yes, answer this question. Nobody has answered till now. So I will give you the answer now, or if you have done in the same way, you can check. Let base year dividend be D0. Let base year dividend be D0. Let base year dividend be D0. Nowadays the institute has started asking reverse question. they will ask you to find the base year dividend given the price of the share. So please write calculation of share price today like a normal question solve, and it will be equated with the price today 52.03, and that will give you the value of D0, and you can find the value of D1 also, correct? So first year dividend would be D0 into 1.15, D0 into 1.15, PV factor printed in the book 0.8696, multiply, you will get, how do you multiply? 0.8696 into 1.15 will give you this number, and then write D0. Year 2 will be D0 into 1.15 square, factor is printed 0.7561, multiply, how much you are getting? 0.99994 D0 you are getting. Very good, those who are replying. One student has already answered, Geetika, she has answered 2. Let us check. Third year dividend will be D0 equal to 1.15 to the power 3, factor is given, and multiply 0.6575 into 1.15 to the power 3. You will get something like 0.99998. Why you are getting same answer? The reason is, on one hand you are increasing by 15%, on the other hand you are discounting also by 15%. So actually it should have been 1 in all the 3 years. Is it right? Because you are discounting and compounding by the same 15%. 70 rupees, third year price 70 is given. So that will also be discounted by 0.6575. Multiply, you will get 46.025. Take the total. First you add these three numbers which has D0. You can write 3D0 also. Okay. So it comes to 46.025 plus 3D0. If you want to write 3D0, it's okay. And this should be equal to what? This should be equal to 52.03. So write down equation, share price today is equal to 46.025 plus 2.99996 D0, or just write down 3D0. Chidana has also replied, answer is 2. So your answer is right. Clap for all the students who have got it right. 2 rupees D0. So what will be D1? 2 into 1.15. Answer both. 2.30. So I don't know whether they want base year means D0 or D1. So I would prefer to write both the answer. Now they can't deduct marks. So this was a good question. One student has written also, nice question. Yes, all question in this book is nice only if you go to the exam with well preparation. One more practice will take, this time on buyback of share. Do you know buyback? Sorry, right share, not buyback, right share. Right share means company wants to raise additional funds by issuing equity share to existing equity shareholder. That is called right issue. Okay. Like recently my close friend Adani had made a right issue of which company? Reply, Adani Enterprise. What was the amount? 20,000 rupees. Crore. 20,000 crore. Yes, that was like right issue only. FPO. Public was also invited. So it was, let us say, FPO. Okay. Reliance company had gone for right issue 3 years back. This issue was withdrawn. Anyway, I'll come back to my question. July 21 exam for 5 marks. I will tell you this is also bonus mark if you are well prepared. Otherwise you can make minor mistake. A Limited is proposing to fund its expansion plan of rupees 12 crore. So first you underline 12 crore by making a right issue. Share issued to existing shareholder. Current market price is 40. Board is willing to offer a discount of 20% on the current market price for the right issue. Understood? So what will be the subscription price? 40 minus 20%. Is it 32? So in order to motivate the existing investor to subscribe to the share, they will have to offer the share at a lower price. Board is also desirous that the fall in the ex-right price of the share be restricted to 10% of the current market price. So what is your ex-right price expected to be? 40 minus 10%. So ex-right price is 36 rupees. Calculate number of new equity share to be offered for each right held. Then theoretical value of the right and the total number of equity shares to be issued. Total number of equity share to be issued. So please solve first yourself. Number of new equity share to be offered for each right held. So what is the ratio they are asking you? What is the ratio of right issue? Whether it is 1:2, 1:4, 4:1, something like this. Geetika is right. Geetika, I don't know whether you are right or not, but she said the answer is 1:1. I have to check. Yes, anybody? Ratio. That is, what is the ratio of right issue? Because the number of share to be issued is printed separately. Number of share issued will be 12 crore rupees you want to raise, and you are going to offer at 32 rupees. So that may be a different easy question. This question requires right issue ratio. Right issue ratio. Because otherwise question 1 and 3 will become same. Right issue ratio. Come on. So anybody who got the answer? One student has only replied. Subscription price, write down. Subscription price, write down. Write in detail. We are doing two things. We are revising the syllabus, plus we are also learning the presentation skill for the exam. Okay. So first you should always write the heading, then the formula for calculation, then calculation 40 minus 20%, and then write the answer. So usually I suggest 3 lines minimum. You should write to calculate any answer. Then X right price. Again here write down current market price minus 10%, 40 minus 10%, 40 minus 10%. Okay, then you will get 36 rupees. Those who don't have the notes will download from our website vino.in. You will find in the free resources section at the top. Now write down step 3. This was a tricky question. Only one student has answered till now. Calculation of ratio in which right shares are to be issued. Calculation of ratio in which right shares are to be issued. Do you remember the formula of X right price? This formula is taught in the class. This formula is also in EPS chapter also. In intermediate AS20, EPS, come right price, X right price, subscription price. So the formula is come right price into right ratio plus subscription price divided by right ratio plus 1 divided by right ratio plus 1. This is the formula of basically weighted average rate. It's a formula of weighted average rate. So now you put the values. 36 is equal to 40 into X. 40 into X. X is the right ratio plus 32, which is the subscription price, divided by X plus 1. Divided by X plus 1. Now I hope you can solve. Come on, quickly. Students are not replying. Have you gone into sleep mode? The answer is 1. X is equal to 1. So 1:1 was the correct answer. Geetika Dina Karan was right. Okay, 1:1. So first, if you get this right, you will get 2 marks. Then the next question is theoretical value of right. Theoretical value of right means, first write a note. Note, one right share to be issued for one existing share. Reserve is right. One right share to be issued for one existing share. Now, next step, write down theoretical value of right. Theoretical value of right. That means if you want to sell this right to somebody else, how much you can sell it for? Anybody holding this right can buy the share for 32 rupees. And the market price after the right issue is over will be 36 rupees. So what is the worth of this right? The worth of one right will be equal to 36 minus 32. Now what is the mistake you can make here? You can take 40 minus 32. You can buy the share for 32 because the moment you buy the share, the market value of the share will go down to 36. So you should compare with 36, because you will say, the buyer of the right will say, I will get a benefit of only 4 rupees. So why I will pay 8 rupees? Because the moment I apply for the share prices will go down to 36 rupees. So this right will have a worth of 4 rupees, theoretical value. Practically it can be more than or less than that. We are in the classroom, closed environment. So mathematically 4 should be the answer. Last question for this part 3 of the question 3. Number of right share to be issued. Write down number of right share to be issued. Always present in a tabular format if you can, or in good handwriting. First write down A, funds to be raised. Funds to be raised. Funds to be raised is 12 crore, rupees in crore. Subscription price is 32. This is the easiest question of this chapter. Then number of equity share to be issued, like a school question, 12 crore rupees you have to raise. Share will be issued at 32. So you are going to issue how many shares? So write down 37,50,000 shares. 37.5 lakh you can write. You can write 0.375 crore. Anything you want, you are welcome. Okay. There they will not deduct marks. If they deduct marks for rounding off, it is wrong. injustice to the student. Okay, now we'll take May 19 question. For marks I have not written, but it is around 8 mark question. Are you ready? This is another different variety of question. It was asked in exam and they repeat this question with different data. Okay, they will change the data. They will change the data in your exam and they will ask you the same question. So tell me, are you ready? Louder yes. Everybody should say yes. YESSS. Following financial information are available of XP Limited for the year 2018. So year is 2018. Equity share capital is 200 lakh. Reserve and surplus 600 lakh. Debenture 350 lakh. Now underline interest rate here 10%. So the interest is 35 lakh. Agreed. And the total of the asset side is 1200 lakh. Asset turnover ratio is 2. Do you know the formula of asset turnover ratio? Anybody wants to reply? Asset turnover ratio. Asset divided by turnover or turnover divided by asset? I am getting two answers. Asset divided by turnover or turnover divided by asset. What have you learnt in your ratio analysis chapter in that wonderful intermediate syllabus? So the formula is sales upon asset is 2 and asset sales upon assets 1200 is 2. So you can use this information to find sales figure. So basically they are testing your fundamental knowledge of the ratio analysis also. You can't take an excuse that I am not a student of intermediate anymore. So please do not give me such questions. They are hardly going to listen to you. Sales. Tax rate. So let me see student, those who are studying. Mehul said turnover by asset, Preeti, Risha also. Okay, so everybody said this ratio, you are right. Now 30%, then operating margin is 10%. If operating margin is 10%, which means operating cost will be 90% of sale. Yes or no? If operating margin is 10%, then operating cost will be 90% of sale. Sale is 2400. Operating cost will be 90% of 2400. That will give you operating profit. That will give you operating profit. From operating profit, you will deduct the interest. You will get earning before tax. You will deduct tax. You will get earning after tax. Indirectly, you have to prepare one small P&L account using the data. And then once you get the PAT, you can compute the dividend also. How much dividend they are going to pay? 20% of the earning. That is dividend payout ratio. Current market price is 28. Required return 18%. This is discount rate. Okay. Now next is prepare one income statement. Similar questions were asked in ratio analysis chapter of intermediate syllabus, but they used to stop here only for 8 marks. But when you come to final, they start asking more. Then you have to find sustainable growth rate, G. Growth rate is equal to return on equity into retention ratio. Do you remember something like this you have studied? Retention ratio into return on equity. If dividend payout ratio is 20, retention ratio will be automatically 80%. But to compute the return on equity, You have to take earning after tax divided by equity shareholder fund. Equity shareholder fund is here 200 plus 600, share capital plus reserve. Okay, so that is your return on equity, and you can get the growth rate. So once you get the growth rate, then you can find the price of the share using dividend discount model. D1 upon K minus G. Give your opinion on the investment in the company share at the current price. Current market price is 28. You will get intrinsic value in answer 3. Compare intrinsic value with current price, like in question number 1 we did today, and you will be able to conclude whether we need to buy the share or not. Say yes. So did you like this question? Did you like my selection of question for your next exam? Do this type of question come in the exam? Read below what is written. May 2019 exam. The questions are repeated after 2-3 years. Okay, and now the high time that this question will come again. They keep repeating after 3-4 years. Okay, they will not repeat in the immediate exam. Anyway, why we are discussing non-core issues? We have to learn. Syllabus is vast, anything can be asked, but I have tried to ensure that most of the concepts are covered in less time. So start with step 1, calculation of sales and operating cost. Calculation of sales and operating cost, because first I need to find sales, then only we can prepare the income statement. Right hand side rupees in lakhs. Point number A, total asset 1200. Point B, asset turnover ratio 2 times. Asset turnover ratio 2 times. Point C, write down sales. Sales will be 2 times of total asset. Nowadays this ratio is very important. Many investors check what is the asset turnover ratio, how much efficient is the company. Okay, so that is 2400. Then you write down point number D, operating margin. Operating margin means operating profit margin. Operating profit means earning before interest and tax, EBIT, 10%. So if operating margin is 10%, what will be operating cost ratio? Next line, operating cost ratio. Operating cost ratio is equal to 100 minus operating margin. 100 minus operating margin, 90%. Operating cost ratio means what is the operating cost as a percentage of sale. Very important for understanding the performance of a company. And next point F is operating cost. Operating cost is C multiplied by E. C into E, 2160. 2160. 2160 is right. So now we are in a position to prepare income statement. Step 2, write down income statement. Step 2, write down income statement. There is no fixed cost. This operating expense include all variable and fixed cost. Okay. Operating expense will include your cost of goods sold and variable cost, fixed cost, admin cost. Operating cost, write down 2160. Operating cost 2160. Therefore, EBIT 240. EBIT 240. EBIT 240. Less interest. That is 350 into 10%. 35. Therefore, EBT is C minus D. See the presentation in detail. 205 C minus D. Easy for the examiner to check. Point F, tax at the rate of 30%. So tax is 61.5. Earning after tax E minus F. 143.5. Dividend at the rate of 20%. Dividend at the rate of 20%. 20% of earning. 20% of 143.5. 28.7. And point number I, retained earning. Retained earning. So how much is the retention? G minus H 114.8. Suppose you don't want to write this, this is okay. Up to this is also okay. Not required, but in the institute answer it was written. Otherwise, income statement does not show retained earning. Okay. Now my first answer is over. Second answer is what is the sustainable growth rate? So I will first find out the retention ratio, because the growth rate formula is retention ratio into return on equity. So step 3, write down, dear student, step 3, write down retention ratio. Step 3, retention ratio is 1 minus dividend payout ratio. 1 minus dividend payout ratio. 1 minus 0.20. So that is 0.80. Do you agree? So my next task is to find return on equity, ROE. Step 4. Calculation of return on equity. Calculation of return on equity. Calculation of return on equity. So the formula will be PAT upon net worth. Earning after tax upon shareholder fund. Earning after tax upon equity shareholder fund. Who will reply? Let us ask our student. PAT from the previous table. Net worth means share capital plus reserve. So PAT was 143.5. Share capital plus reserve 200 plus 600 is 800. Multiply by 100. So Prachi Kothari has given the answer 17.94%. You are right. Kothari ji is right. Okay. 17.94%. Wonderful. Now quickly give me the growth rate also. If you have got retention ratio and return on equity, can you not give me growth rate? Come on, growth rate. Growth rate. Step number 5. Growth rate G is equal to retention ratio into return on equity. Yes, come on, everybody. So our student Prachi has again replied 14.35%. Darshana Jaju has also replied same. Mehul Garg same. Is right, 14.35%. So this will give you 2 more marks. For each question you have 2 marks. There are total 4 parts. Do you want only 4 or you want to get 8? 8. Go ahead. Determine the price of the share of the company using dividend discount model. So now I have to find price per share. For that, first we will compute how much is the dividend per share given by the company today. So go to your previous table. You will find in the second last line of income statement, dividend paid was 28.70 lakh, correct? And number of share in the question book 20 lakh. Number of share 20 lakh. So please tell me, my dear student, what is dividend per share given by the company in the current year? Dividend per share is 1.435. Step number 6, price per share. They are asking you to use dividend discount model. So the dividend discount model is D0 into 1 plus G upon R minus G. D0 into 1 plus G upon R minus G. Solve. Who will give me the answer? D0 is 1.435 into 1 plus growth rate is 14.35%. So 0.1435 divided by 0.18 minus 0.1435. One student, Prachi, has already answered 44.96. Yes, you are right. Enjoy. Wonderful. You are a good candidate for the exam. 2 more marks for this. Do you want 2 more marks for opinion? Yes, this is the intrinsic value of the share. But the market price is just 28. The market price is just 28. So recommend buy or don't buy. Market price is lower than intrinsic value. Buy. Please reply everyone. All the students will reply buy. So most of the students are saying buy. So write down the advice. Students will write advice nicely. Just don't write buy, BUI. Since the intrinsic value is rupees 44.96, since the intrinsic value is rupees 44.96, Siddhana is saying undervalued. Very good. While it is selling at rupees 28, hence it is underpriced. Hence it is underpriced. It should be purchased. It should be purchased. So this was an 8-mark good question. If you have done practice in advance, you will get it right. So what are the possible mistakes? Asset turnover ratio, many students take asset by turnover. The whole answer will be wrong. Even growth rate formula, many students don't remember. Then also the answer is you will get same. Don't worry. So do practice it. One more different type of question. 5. May 18 RTP. But a good question. Something new to learn if you have not studied such question before. Question is SAM Limited has just paid a dividend of rupees 2 per share. Underline just paid. Just paid means D0. D0. And it is expected to grow at the rate of 6% per annum. Growth rate is 6%. Understandable. After paying dividend, the board declared to take up a project by retaining the next 3 annual dividend. Now what the board is planning, they are planning to undertake a new project, but for this they will need funds, and therefore they are not going to pay the dividend for the next 3 years. Is it right? If they do not undertake the project, then dividend will be 2 rupees plus 6%. But if they undertake the project, then dividend will be 0, 0, 0 for first, second and third year. Understood? It is expected that this project is of the same risk as the existing project, means same discount rate. It means same discount rate. The result of this project will start coming from the 4th year onward from now. So from 4th year onward, you will see the impact of this project. The dividend will then be 2.50 per share. So D4 will be 2.50 and it will grow at the rate of 7%. So the revised growth rate would be 7% if you undertake the project. If you do not undertake the project, growth rate will be 6%. Now up to this we have done so many questions in the class. What is new? This paragraph and then related question. An investor has 1000 shares in SAM Limited and wants a receipt of at least rupees 2000 from this investment. So you have made an investment in SAM and you want that every year I should earn at least 2000 rupees. So you can earn 2000 in two ways. One, dividend. Second, by selling the share. By selling the share. Am I right? If you are in the need of funds, by investing in a share, either you should get dividend or you should sell the share. If the company undertakes the new project, it won't pay dividend. Then how do you get 2000 rupees? By selling the shares. How many shares you will sell? 2000 divided by price of the share at the end of year 1. 2000 divided by price of the share at the end of year 2. 2000 divided by price of the share at the end of year 3. Because from the 4th year onwards, the company will start paying the dividend. Is it right? Required. Evaluate whether the market value of the share is affected by the decision of the board. So basically you have to solve this question 2 times. First using this data and second using this data, and check whether the price of the share today will be higher by undertaking a new project or not. Very easy. And next is recommend how the investor can maintain his target receipt from the investment for first 3 years and improved income thereafter, given that the cost of the capital of the firm is 8%. So this 8% is your KE, discount rate. Okay. So let us solve this question. First write down step 1. Step 1, heading write down value of share at present. Value of the share at present before undertaking the project. Before undertaking the project. P0 equal to D1 upon K minus G. P0 equal to D1 upon K minus G. Last dividend was 2 rupees into 1.06 divided by 8% minus 6%. Rishabh got it right, 106. What about other student? Have you also got 106? $106 is right. Okay, go ahead. Step 2, write down value of the share after undertaking the project. Value of the share after undertaking the project. write a note, no dividend would be payable for 3 years, no dividend would be payable for 3 years, and dividend for year 4 would be rupees 2.50, and dividend for year 4 would be rupees 2.50. Next line, growth rate is equal to 7%. Growth rate will be equal to 7%. So we are given D4 and revised growth rate. So if D4 is given, then by applying this perpetuity formula, you will first get the price at the end of year 3, and that will again be discounted by the third year factor to get the price at the beginning of the year 1 or today, P0, like we have done in question number 1. Okay, so directly you will not get the answer. First you will get P3, then from P3 we will get P0, right? P3 equal to CVS of the third year, right? Yes. See, if this is the timeline, this is D4. So by applying the formula you will get P3. Then you have to again discount it to get P0. So you have to discount by 3-year factor. So 2 steps will be involved. Students again make a mistake. They take this only as a final answer. Write down 2.50 divided by 8% minus 7%. So P3 will be equal to 250. Very good. Those who are replying, very good. But don't stop here. Get P0 also. P0 will be equal to 250 divided by 1.08 to the power 3, which is equal to, Siddhana is right, 198.46. 198.46. Yes, 198.46 is also okay. So this is your first answer. Whether the market value of the share is affected by the decision of the board. From 106 rupees, it has moved to 198.46. So the answer is yes. Write a note. Every time write a note as per the question. The price of the share is expected to increase. The price of the share is expected to increase from rupees 106 to rupees 198.45 or 46, whatever. Price of the share is expected to increase from rupees 106 to rupees 198.45 after the announcement of the project. Okay. Now the question is, the investor wants 2000 rupees every year. The investor wants 2000 rupees every year. Understood? But company is not going to pay the dividend. So you will have to sell the share. So I need to find price of the share at the end of year 3, year 2, year 1. Year 3 already we have computed 250. So write down, the investor can take up this situation as follows. The investor can take up this situation as follows. You can just save time by writing price, calculation and rupee. P3. P3 will be directly write 250. Already calculated. P3 250 already calculated. Then write down P2. P2 will be, this is the price of the third year. So if you discount it by 1 year factor, from P3 it will become P2. So type 250 divided by 1.08. 250 is here. You have to bring it to year 2. So gap is 1 year. So just simply you take 250 divided by 1.08. That will give you price at the end of year 2. How much? 231.48. Don't write so much. You can just write down 250 divided by 1.08. And year 3 write down. P1 write down. P1. Take this number and divide by 1.08. Take 231.48. Write like this, 231.48 divided by 1.08. Just bring it down by 1 year. Yes, Rishabh, come on. So he is getting 214.33. These are the prices of the share at the end of year 1, 2, 3. Up to this is understandable. Now, step 3 write down. Number of shares the investor should sell. This part of the question is new. Normally, it has not been asked in the exam. Price, number of share investor should sell to maintain receipt of rupees 2000. To maintain receipt of rupees 2000, draw this table. Year, minimum amount required, price per share, last column number of shares to be sold, year 1, 2, 3 write down. Minimum amount required 2000, 2000, 2000. Price per share as per previous table. 214.33, 231.48 and 250. Now divide. Round off on the higher side, because if you round off on the lower side, you will not realize 2000 rupees. So check the answer. Is it 10? Is it 9? 8. So total how many shares you will have to sell? 27. Number of shares sold in 3 years is 27. Very good, Rishabh. Now he had 1000 share in the beginning. He sold 27. So number of shares left at the end of year 3. Number of shares left at the end of year 3. Is it 973? Now, can he get 2000 rupees or more in the 4th year from the dividend? Let us check. Dividend of the 4th year is 2.50 and he has got 973 shares. So do you think he will be able to get 2000 rupees? How much you are getting? 2.50 into 973. Yes. So now you write down one more line. His dividend income for year 4. His dividend income for year 4 will be 973 into 2.50. 973 into 2.50. Is it 2432.50? Yes. Which means he does not have to sell share after 4th year, and it will grow only. It will grow at the rate of 7% every year. So write a note and complete the answer. This answer is over subject to this note. One student has a doubt in the classroom, physical classroom. Yes, please ask your query. Ask slowly. I will repeat query also. We got P0 we have got. That was price today. You can do reverse working also. You can do reverse. Answer will be same. From P0, if you multiply by 1.08, you'll get the same answer. Yeah, discounting and compounding will give you same answer. Whichever way you can do. Again, you can take P1 and into 1.08. You can take P2 into 1.08. You are doing the same thing. If you want to present like this for P1, P2, P3, you can do it. Just write a note and complete the answer. Write this note. One more confusion. No, the discounting and compounding are same thing. One takes you to the future, one takes you to the present. Write down a last line. Thus, if the project is taken up by the company, the investor should be able to maintain his receipt. Of at least rupees 2000 for first 3 years, and would be getting increased income thereafter. So today we'll stop here. We'll continue tomorrow at the same time. So please be present. I hope you enjoyed today's lecture. Those who are at home, kindly reply, did you enjoy? Say yes. You can say no also if you have not enjoyed. Hello, good morning everyone. Please come to question number 6 now. Please come to question number 6. Valuation of share. May 2021 RTP question. May 2021 RTP question. Are you ready? So this is the question. ABC Limited just declared a dividend of rupees 28 per share. Mr. A, underline this 28 rupees, just declared means D0. Just declared means D0. Declared a dividend of rupees 28 per share. Mr. A is planning to purchase the share of ABC Limited, anticipating increase in growth rate from 8% to 9%. So what will be the growth rate henceforth? 9%. Growth rate will increase from 8% to 9%, which will continue for 3 years. So this 9% growth rate will continue for 3 years. He also expects the market price of the share to be 720 after 3 years. So this is P3 720. P3 720. You are required to determine the maximum amount Mr. A should pay for the share if the discount rate is 13%. So you have to find intrinsic value. The maximum price Mr. A will be willing to pay for the share if he is of the opinion that 9% growth rate can be maintained indefinitely. Indefinitely means forever. Okay, indefinitely means forever. So that means you will simply apply the formula for second part, D1 upon K minus G. The price of this share at the end of third year. what will be the price of the share at the end of third year if 9% growth rate is achieved, and assuming that other condition remaining same as above. So you have to find P3. So P3 will be D4 upon K minus G. Is it right? D4 upon K minus G will be P3. So the third question you have to find P3, and the instruction is calculate rupee amount up to 2 decimal point. Use present value factor up to 3 decimal point. This question has been asked in earlier exam also, and it was asked in May 21 RTB. So first we will solve part 1, where dividend for the first 3 years will grow at the rate of 9%, and then after 3 years the price will be 720 rupees. So write down basic question, sometimes they ask in the exam, and it is a bonus mark. Expected dividend for next 3 years. Expected dividend for next 3 years. Year 1 D1 is equal to last dividend paid is 28. Growth rate is 9%. Very easy question. So 30.52. Year 2 write down. Year 2 D2 will be 28 into 1.09 to the power 2. So the second year expected dividend is 33.27. Check. Is it right? Year 3. 28 into 1.09 to the power 3. 36.26. And the price of the share is 720. Next line write down required rate of return. K is equal to 13%. Presentation for exam purpose, otherwise directly I can also solve. Market price after 3 years. Market, write down market price after 3 years. This is a presentation technique for exam. P3 equal to 720. So once you have computed the basic data, this is the basic information. Now you can solve. So write down answer. The present value of share is equal to P0 equal to, you can present in tabular format, you can present in equation format. Both are okay. Yes, who will give me the answer? All the students studying at home, kindly reply. P0 equal to D1 upon 1 plus Ke plus D2 upon 1 plus Ke to the power 2 plus D3 upon 1 plus Ke to the power 3 plus P3 upon 1 plus Ke to the power 3 again. Anybody wants to reply? One student has already replied 577.15. Rishabh. Let me also check. These are the 3 dividend and 720 is the price. Students are requested to solve. Preeti, 577. Very good. 577.15 is the right answer. Amazing. So you got 2 marks for this much effort. Now those who have done can try second part. In second part, the growth rate 9% will continue forever. So answer of second part, write down. Answer of second part, part 2. Previous answer you got it right, 577. Part 2 write down. If growth rate 9% is achieved, for indefinite period, if growth rate 9% is achieved for indefinite period, then maximum price Mr. A willing to pay, Mr. A would be willing to pay, directly apply the formula D1 upon K minus G, D1 upon K minus G. Rishabh is right, D1 upon K minus G. So that comes to 30.52 divided by 13% minus 9%. 30.52 already calculated. So write down 763. So once again Rishabh got it right before everybody else. Okay. Any query on this? The previous answer was 577.15. Second answer is 763. Now I am going to ask you the third answer. So the competition begins. Please reply third answer. Write down answer of part 3. Assuming that conditions mentioned above remain same. Assuming that conditions mentioned above remained same, the price expected after 3 years will be, the price expected after 3 years will be, try, I am waiting for your answer. What will be P3? P3 will be D4 upon K minus G. D4 will be D3 already calculated into 1 plus G. So see the answer. P3 will be equal to D4 upon K minus G. D3 into 1.09 divided by 13% minus 9%. So one student Rishabh got 988. Preeti Anandam got 988. Okay, 988 point anything is okay. 988 you have reached. You got one more mark. Total 5 marks you will get. 2 plus 2 plus 1. Is it right? So that was relatively easy question. So this way we have taken some important question on valuation of share. Mehul has also got it right. Now our next topic would be related to this only. Some formula we have used there will be required in the next topic also, called portfolio management. Is it right? So how many of you like portfolio management? Say yes, we like, or say no, we don't like. Yes or no. Student should reply. Accordingly, I will decide the speed. Do you like? There are some students in classroom who are saying no, we don't like. And somebody is saying we like also. So don't worry. Question number 1, taken from July 2021 exam for 10 marks. So your query would be, do they ask such question in the exam? Yes, that is why it is there. So question, write down July 21, question number 1. Keep the printout ready, and these notes are available on our website vino.in. This is the website vino.in. In the free resource section you will find these notes. Mr. X is having 1 lakh shares of Messrs. Kanakya Limited. The beta of the company is 1.40. So Kanakya Limited beta is 1.40. Mr. Y, a financial advisor, has suggested having the following portfolio. So what the advisor has suggested, that don't invest in only one share. Instead of that, you should invest in 4 shares, make a portfolio so that your risk will be diversified. SKPD beta, and he has suggested that this should be your percentage of investment weights. These are the weights. and now they are giving you market return is 12%, risk-free return is 8%. You are required to calculate the following for the present investment, that means with beta 1.4 and suggested portfolio, which means you have to find out for this portfolio what you have to find. What is the expected return based on CAPM? Very easy. What is the formula for CAPM? RF plus beta into RM minus RF. Very good. So you have to compute for stock and portfolio. If the market goes up by 2.5%, so market is right now 12, which means here you will take 14.5. If market goes down by 2.5, so it will be 9.5 RM, and if the market gives negative return of 2.5%, so RM is minus 2.5. So with these three RMs, you will have to find out the expected return of the stock and the portfolio. If the probability of the market giving negative return is more, that means if you think this possibility is high, there is a possibility market may give negative return, then please, how respectfully they are asking you, please advise Mr. X whether to continue to hold Messrs. Kanakya Limited or to buy the portfolio as per the suggestion of Mr. Y. If so, then why? So you have to answer after computing this answer, and we will see where is the expected return more. Is it right? Accordingly we can suggest. So very easy question for 10 marks. I can't believe that they are asking you such question for 10 marks. I wish I had appeared in this exam. I would have got a rank. Step 1. Calculation of portfolio beta. First I'll get portfolio beta because I need to apply CAPM model for portfolio beta. Portfolio beta is weighted average beta. So concept number 1, portfolio beta is weighted average beta. Students will write security beta weight into beta. Security beta weight into beta. First chance to you. Please try. Mehul, please try. Preeti, please try. After writing the security, write beta given in the question. Weight is given 10%, 0.1. Multiply K 0.75, 0.10, 0.075, 0.40, 0.3, 0.120. Correct? 1.4, 0.5, 0.7. Anybody total of the last column? 1.015. So this I will require for the next three answers. Portfolio beta is 1.015. Sidana got it right. Very good. You seem to be a hard working chap. Step 2, write down. Calculation of expected return. First I will calculate expected return. Three columns we will draw. Particulars, expected return, formula write in bracket RF plus beta into RM minus RF, and return percentage write down. We have to compute it for both the stock and the portfolio. The stock name is Kanakya Limited. The original question has RM 12%, RF 8% and beta 1.4 for the stock. 1.4 is the beta of the stock. First line of the question. Question has mentioned in the first line. So the answer for Kanakya Limited is 13.6%. Portfolio based on original market return 12%. Anybody? Portfolio. Portfolio. Come on, come on. You are in a revision batch. Anybody? 12.06. Rishabh Sidana is right. Other students should also reply. Step 3, write down expected return if the market goes up by 2.5%. Expected return if the market goes up by 2.5%. So I will again do the same thing, only I will change RM, which is 12 here. I will make it 12 plus 2.5, 14.5. Please solve. Solve for Kanakya Limited. Kanakya Limited, 8 plus 1.4 into bracket 14.5 minus 8. Many students in the exam must be thinking, how it can be such an easy question? Something is wrong. Nothing is wrong. This is an easy question. 17.10% is right. Yes, everybody should reply. Next, portfolio. Try yourself. Portfolio. Portfolio. Is it 14.6%? Sure? Very good. You are right. Okay, do the same exercise by writing step 4. Writing step 4. Expected return if market goes down by 2.5%. Expected return if the market goes down by 2.5%. So now my RM will change. It will become 12 minus 2.5. That is 9.5. 9.5 you understood? So 10.1. 10.1. Portfolio. Portfolio. Anybody for portfolio? 9.523%. So that was my answer of part A, B, C. C spending. If the market gives negative return, of 2.5%, which means RM will be minus 2.5. Come on, student. Step number 5, write down. Step 5, expected return if the market gives negative return of 2.5%. If the market gives negative return of 2.5%, only getting answer is not enough. The presentation skill should be there. You are a professional. So I am helping you to learn the presentation skill also. So what is Kanakya Limited return? Anybody for minus 6.7%? Very good. Portfolio. Portfolio. Anybody for portfolio? Portfolio? Minus 2.66%. Minus 2.66%. So who has got a lower negative return? Portfolio has a lower negative return if the market is expected to turn negative. So the question is, second part, if the probability of negative return is more, advise Mr. X whether to continue the holding of Messrs. Kanakya Limited or to buy the portfolio. So should you continue with Kanakya Limited or should you buy the portfolio? In Kanakya Limited, the loss will be more. Here, the loss will be less. So what is your advice? to buy the portfolio, right? And the reason for that is beta of the portfolio is less. It will be less volatile compared to the stock. Okay. When there is a possibility that prices will fall, it is better to have investment in stock or portfolio with lower beta. Okay. Write down the note and conclude the answer. I will dictate. Note, if the probability of market giving negative return is more, it is advisable to Mr. X to buy the portfolio suggested by Mr. Y, and then they have asked you why. The answer for that why is because beta of the portfolio is less than Kanakya Limited. Beta of the portfolio is less than Kanakya Limited. So this answer is over. Any query on this?
If the market was positive, then the Kanakya Limited investment would have been better.
If the market is going to go up, then Kanakya Limited will give you a higher return. Yes. So actually, then we have to also see what is the standard deviation, etc. But the data is not sufficient. So to some extent, it will depend on your attitude toward the risk also. If you're willing to take a higher risk, go with stock with higher beta. Okay, invest in Adani Total Gas. Invest in Adani Power. But people like me invest in ITC, HUL, safe stock. Okay, where I know that I won't lose much. So the answer of such question always depends on ability to take the risk. But when they are saying that market is expected to give negative return, then it is better to have lower risk. Okay, lower loss. One very good question now coming before you, taken from May 21 RTP. The following information pertains to Golden Limited. PBT, profit before tax, before word underline, which means I need to deduct tax. Tax rate is 30%. Equity capitalization rate means K. Return on investment means R. 18%. Retention ratio means B. 80%. Number of share outstanding 75,000. Keep question in front of you. The market price of this share. Question number 2. What happened? 75 lakh. I made mistake in speaking. The market price of the share of the company in the bull market was. Bull market. What is bull market? Prices are expected to go up. This is bull market. Was somewhere around rupees 2100 per share. So this is the current market price. Advise whether the share of Golden Limited should be purchased or not. So basically you have to apply the formula for valuation of share like the previous chapter and check whether this is overpriced or underpriced. Whether this is overpriced or underpriced. So you have to apply the same formula D1 upon K minus G. Is it right? Retention ratio is 80%. So dividend payout ratio will be 20%. And you can calculate the dividend per share from this information. Okay. After that, you have to check whether it is overpriced or underpriced. After that, another question also suggests the form of market, prevalent market as per EMH theory. Sir, what is EMH theory? EMH, have you heard EMH? Portfolio chapter, there is a concept EMH, efficient market hypothesis. So that is why I took this question. There are three levels of market efficiency. One is called weak form, one is called semi-strong form, and one is called strong form. So weak form means technical analysis is useless. Analyzing the past data is useless. Okay. Semi-strong means technical and fundamental analysis is useless. The market already incorporates all the available information. So when you get up in the morning at 9 o'clock, 9:15 the market opens up. You think yesterday night I had read a news. Okay, steel prices will be increased. So let me buy Tata Steel. Tata Steel price at 9:15 has already increased. Is it right? That is called semi-strong. And strong means even insider information is taken care of by the market price. So after solving this, you'll have to answer what is the form of market prevalent as per efficient market hypothesis. So first they have given an instruction also, use Gordon's growth model. So go back to your happy, lucky intermediate days. Gordon model formula, E into 1 minus B upon Ke minus B into R. Do you remember this? No, it is same formula, D1 upon Ke minus G, because this portion is G and this is your dividend. Earning multiplied by dividend payout ratio is dividend per share. So even if you don't remember this formula, you can write D1 upon K minus G. Both are same. Okay. Now one student Geetika has already replied, share is underpriced, hence bought. Very good. Let me check. So write down step 1. If this question appears in the exam, how will you write the answer? First, we need to find out EPS and we also need to find out the growth rate. Ready? Steady. Go. Step number 1, EPS and growth rate. First, PBT. PBT in rupees in crore, 75. Then write down less tax at the rate of 30%. 22.5. PAT, write down PAT. How much is PAT? Rupees in crore, 52.5. Then write down number of shares which is given in the problem, 75 lakh, 0.75 crore. In crores write down, in crores. So crore can be divided by crores. Okay. Now who will tell me EPS? Come on. EPS. Anybody? Rupees. EPS in rupees write down. Nobody has replied. The student learning from home, have you gone into sleep mode? 70 rupees. What is retention ratio? 80%. Very good, Rishabh. What is return on investment in the problem? Return on investment is given in 4th line. Is it 18%? What will you get if you multiply these two? B into R. Growth rate. Very good. Priyanka is also right. Rishabh is right. So my question is, what is growth rate? Yes, Kabra, please reply. Growth rate. So growth rate is 14.4%. Very good. So if you write this much, out of 5 marks, you will get 1 or 2 marks. That is how the marking will be done. Now the step number 2, specifically they have said use Gordon growth model, which is same as dividend discount model. Next line, calculation of market price per share. Calculation of market price per share using Gordon's formula. Using Gordon's formula. Solve. You can use this formula, you can use D1 upon K minus G also. Students have started replying also. Everybody should participate. This will be in your interest also. So apply the formula E into 1 minus B upon K minus G upon K minus G. I'll give you a note for that. This question is not clear whether it is D1 or D0. Okay. So we'll write a note for that. It is assumed that dividend is expected dividend. It is assumed that dividend is expected dividend. Alternatively, you can assume it is past dividend, so you will have to increase it by the growth factor. Accordingly, answer will change. Now write down the advice. Advice, write down the market price is less than intrinsic value. The market price is less than intrinsic value. Therefore, the share is undervalued. Therefore, the share is undervalued. Market price was 2100. But the calculation gives me 2333.39. And if you take D1, the answer will be higher than that. It will be 2669. In both cases, the current market price is less than intrinsic value. Hence, it should be purchased. Hence, it should be purchased. Up to this question was on valuation of share. Okay. Now, they have linked it with the portfolio chapter by asking you to comment what is the form of market efficiency. So, write down, this form of market is a weak form of market. This form of market is a weak form of market. As it is not discounting all the information. As it is not discounting all the information. There is a huge difference between what it should be and what it is. So still there is a gap. It's not a strong form of market. It is not a semi-strong form of market, because in semi-strong form, all published data is already taken into account. So it can be only weak form of market. Okay.
But if it was semi-strong, what information would have been given like that?
These are the information, semi-strong form, company's PAT, company's cost of equity, etc., dividend policy. These are the fundamental information about a company. So in that case, it should have matched.
Similar, not so much.
Not so much of difference. Not so much of difference. Correct. It's the market is a weak form of market, because even though information is publicly available, those have not been considered in the price calculation. So somebody can play with the market and earn super normal profit. Is it right? Like you can do it in this example. By buying this share, you can earn additional income. It should be 2100, it should be 2333, but available at 2100. So that was the reason I took this question, because you will get 1 or 2 marks for writing this small note. Yes, many students will not understand the question only. Some of you did not know EMH full form also. Anyway, now we'll take some advanced question. Some students must be thinking, sir is taking only easy question. Let us take one more question from May 2021 RTP. K Limited, this question they have repeated many times in the RTP, MTP and exams. Okay, past exams. So, a possible question in the exam. Question number 3. K Limited has invested in a portfolio of short-term equity investment. You are required to calculate the risk of K Limited. This is a question. Calculate the risk of K Limited short-term investment portfolio. Risk you have to find of portfolio relative to that of the market. Relative to that of the market. Risk in relation to that of the market. So which statistical number gives you the relationship between the riskiness of the stock or the portfolio in relation to that of the market, whether it is standard deviation, variance, covariance or beta. Which of this gives you the relative riskiness of the stock or portfolio with respect to the market portfolio? Give me the answer. Option A, B, C, D. A is standard deviation, B is variance, C is covariance, D is beta. Those who are from home, they can answer A, B, C, D. Okay. Nobody has answered. We'll come back to this question. Keep thinking. From the following information given below, number of share is given, market price per share is given, beta is given, expected dividend yield is given. The current market return is 20%, RM, and risk-free return is 10%, RF. Advise whether K Limited should change the composition of its portfolio. Should it change the composition of the portfolio? Means should you buy, sell or hold? Right now you are investing in this share. Should you continue to buy, sell or hold? And for that purpose we have to check whether they are underpriced or overpriced. If yes, then how? Note, make calculation up to 4 decimal points. So my question you have not yet answered. Some students have said standard deviation. The answer is no. Standard deviation measures the total risk of a portfolio or a stock. It is not a relative measure of risk. Beta is a relative measure of risk. A beta of 1.5 says that the stock or portfolio is more risky than the market. If market changes by 1%, the stock or the portfolio return will vary by 1.5%. And the data is also given in such a manner that you can only calculate portfolio beta in this. Can you calculate standard deviation or variance or covariance in this example? The answer is no. And how do you calculate the beta? First you have to multiply these two. That will give you value. convert value into weight, multiply by beta, that will give you beta of portfolio. After that, we will answer this question: should we change the composition of the portfolio or not? Is it right? So one student, Geetika, already answered portfolio beta is 2.93. I have to check your answer, Geetika. You can just try the other questions. In the meantime, let other students solve if you have done it. Okay, so please write down first answer, portfolio beta. So the intention of the examiner is to check whether you can interpret this line properly or not. I am waiting for you. First, draw the format. Do not apply shortcut. First column is investment. Second column is number of share. Third column is market price. Fourth column is market value. Then convert market value into weight. Beta, which is given in the problem, and weight into beta. The total of the last column will be portfolio beta. Portfolio beta measures the relative riskiness of the portfolio as compared to market. So please complete the table. I will come in 1 minute. Okay, so are you able to solve? Check the answer. Final answer is 2.93. Geetika got it right. Rishabh, Priyanka, students who are in the classroom, they also got it right. Just check it again. Is it right? 2.93? No mistake? You can't make mistake in such basic questions. Otherwise, you lose mark. This is a bonus mark, 2 mark portfolio beta. The question was, first paragraph of the question, you are required to calculate the risk of K Limited short-term investment portfolio relative to that of the market from the information given below. So market portfolio has a beta 1. Market portfolio has a beta 1, that you know. Always the market portfolio beta is 1. This portfolio of K Limited has a beta of 2.93. So is it relatively riskier than the market portfolio? Yes, write a note. So the first part will be over. The portfolio beta is 2.93. Portfolio beta is 2.93. Thus, the portfolio is risky. Thus, the portfolio is risky compared to the market. Portfolio is risky compared to the market. Now my next question is whether we should change the composition of the portfolio. Whether we should change so for that we will compare two things. In the given question we can compare required return versus expected return. Required return is calculated as per CAPM. And expected return is given in the problem, expected dividend yield. Can you see that last line of the table? Expected dividend yield. Now you have studied in your portfolio chapter that by comparing these two, you will be able to identify whether the stock is overpriced, correctly priced or underpriced. Is it right? If your expected return is more, you're getting more return than what you require, then it is a situation of undervalued. Okay, we'll see. Keep thinking. Right. First we'll compute required return as per CAPM. First we'll compute required return as per CAPM. Write down. Step number 2, calculation of required return as per CAPM. No, portfolio is not required. Individual security you have to reshuffle. No? In order to check which security I need to buy or sell, I have to do individual stock calculation. For that, first you find out the required return as per CAPM. And the formula is RF plus beta into RM minus RF. RF plus beta into RM minus RF. Just draw two columns. Stock, required return. Stock, write down A. Stock, write down A. And keep the question in front of you. Everybody will understand. The risk-free return is 10% plus market return is 20% minus risk-free return 10% and beta of stock is 2.32. I have written the answer. I would ask you to check it. Is it 33.20? Please check. One line blank. Stock B. 55.60, C 28%, and D 40%. So one student is saying there is a huge gap between required return and expected return. That is right. But my question is whether the stock is undervalued or overvalued. Let us ask for A. Vote for A. Is expected dividend yield is 9.5%. Expected return is 9.5. So student will have to answer whether it is overvalued or undervalued. Question is open to everybody. Come on, show your intelligence to this world. If expected return, this is expected return, is less than required return, overvalued, it is over. You are getting less. Since you are getting less, it means you are paying more. If you are getting less return, it means you are buying something expensive. Is it right? Expected return is based on the actual price available in the market. If I buy at this price, this is the return I will get. And if you are getting less return, you are buying it expensive. Is it right? So it's overvalued. So all of them are overvalued. You are right. And all of them needs to be sold and you need to purchase other securities. So write down the conclusion. Comparing dividend yield with the expected return of investment, comparing dividend yield with the expected return of investment, as per CAPM, it can be observed that all the investments are overpriced. In bracket for your understanding, expected return is less than required return. Expected return is less than required return. If expected return is more than required return, it is undervalued. If they are equal, it is correctly valued. So the conclusion is that they should be sold by K Limited. They should be sold by K Limited and acquire new securities. They should be sold by K Limited and acquire new securities. Okay, anybody, any query now? So this was a good question. Question number 4 now from your May 19 exam. Another question which is repeated. It is a highly repeated question from this topic. Write down repeat question. And if it is repeat question, it is important also. Many times you can just check. Question number 4. Miss Preeti, a school teacher, after retirement, has built up a portfolio of rupees 1,20,000, which is as follows. So like the previous question, this is a small repetition, but I will tell you why I have taken it for discussion. These are the 4 stocks, number of share like the previous problem, market price and beta. So you have to again calculate the portfolio beta. Her portfolio consultant, Sri Vijay, has advised her to bring down the beta to 0.8. Is it right? So you have to bring down the portfolio beta, whatever is that right now, to 0.8. So you have to compute first portfolio beta and second how much risk-free investment should be brought in. How much risk-free investment should be brought in? Because if your portfolio beta is high, then you should bring some risk-free investment. Risk-free investment has a beta of 0. So if you add risk-free investment which has a 0 beta, your portfolio beta will reduce. So what is your target portfolio beta now? The target portfolio beta is 0.8. So for that, first you have to compute the portfolio beta. Write down calculation of present portfolio beta. Student will write step 1. Always in the exam, preferably write in the step manner. There is a step marking in the exam system. So more number of steps you write properly, you get more marks. For exam purpose, step marking is important. So dear students, I will give you the format and you will solve and give me the answer. Everybody, come on, Mehul, Rishabh, Geetika, Priyanka. Anybody who got the answer? Suraj, Venu Gopal. So one student in the classroom has given the answer 1.108. 1.1084. Okay. Let me check. Have you got the total value 1,20,000? Then have you got these weights 0.4167, 0.0833, 0.1667, 0.333, and then have you got the total of last column as 1.108? This is a question which first part is a bonus mark, 1.108. Now my next question is, what should be the risk-free investment to be brought in so that your portfolio beta is reduced to 0.8? First chance to you. What should be the weight of risk-free investment? Similar question was asked in November 22 exam also. Write down similar question in November 22 exam. So I am asking you a question to test your revision, how much you know. You have to ensure that this new portfolio, which will comprise of the stock and the risk-free investment, should have a beta of 0.8. So what should be the weight of risk-free investment in that portfolio? What should be the weight of risk-free investment in that portfolio? So you'll have to solve an equation and get it. Weight of shares is 1.108. Sorry, beta of the shares is 1.108. Beta of risk-free investment is 0. So you have to assume weight of one of the two as W, weight of other will be 1 minus W. Is it right? One you can assume W, the other one will become 1 minus W. This you can multiply by 1.108. This you multiply by 0 and you must get 0.8. So don't you think you can find out the value of or the weight of shares and the weight of risk-free investment here? Try. I have given you the answer. You just have to solve it. First you give me the weight, then amount. Portfolio beta right now 1.108. Write down. Anybody who got the answer can reply. Required beta is 0.8. Required beta is 0.8. All of you know beta of risk-free investment is 0. If you don't know, then this point you should know that beta of a risk-free investment is 0. Beta of market portfolio is 1. These two are given in our syllabus. Let the weight of shares, next line, let the weight of shares and risk-free investment be, let the weight of shares and risk-free investment be W and 1 minus W respectively. Is it right? Portfolio beta is equal to weighted average beta. Portfolio beta is equal to weighted average beta. Now I am going to give you an equation you will solve. We want 0.8 as portfolio beta and it is equal to W into 1.108 plus 1 minus W into 0. Correct? So this portion will become 0. So W will be equal to 1.8 divided by 1.108. Kindly answer. So W will be 72.2%. Is it right now? That means these are the shares. So the proportion of shares in the new portfolio would be 72.2%. And what will be the proportion of risk-free investment? 27.8%. These are the proportion or weights we have found out. Now Mehul Rishabh has given correct answer. You have to also write down the amount. Now the shares are 1,20,000. Shares will constitute 72.2% of the total portfolio. So I will get the total portfolio value now, and 27.8% of that portfolio will be risk-free investment. So write down below existing portfolio value is 1,20,000. Desired portfolio value, because risky stock shares are 72.2%. So your portfolio value should be now 1,66,205. So can you now tell me what should be the desired risk-free investment? Desired risk-free investment should be 46205. Is it right? 46205. There is one more way you can solve. You can say 1,20,000 I don't want to change. If you don't want to change 1,20,000, then you have to sell some share and buy the risk-free investment. So in that case, you can write this also, alternative 2. In some exam, the institute presents like this. In some exam, they present like this. So we are confused. So when you are confused, what you should do? Write alternative answer also. Yes, it won't take much time. 1,20,000 into 72.2%. 86,640, and risk-free investment. Right, both. Yes, actually I used to solve by this method only, but the institute answer is in a different way. So if you don't want to change the value of the portfolio, then alternative 2. And if you are willing to change the value of the portfolio, that is, you don't want to sell the share, but then you have to bring the risk-free investment in that case. Both answers are okay. Institute should make it clear whether we need to increase the value of the portfolio or keep the value of the portfolio same. If you have to keep the value of portfolio same, then you'll have to sell the stocks and buy the risk-free investment, and the stocks will be sold in the ratio of their weights so that the portfolio beta remains the same. Now let us cross check whether your answer was right or not. You want to cross check or you'll do it in homework? We'll cross check. Yes, whatever you do in this previous example, whether you follow this or this, you write a note in the exam. Okay? Because institute has given both the answers in different exams. They can do anything with you. They are also into a profit making business. How will you survive? Now in the institute answer they have given the proof also that by bringing risk-free investment to this number, your portfolio beta will come down to 0.8, which was actually not a part of the answer. If they ask you prove, then you do it. Okay, so what you will do, you will just take A, B, C, D, E, F, G, H, I, J, K, L same, only add here risk-free asset 46205, beta of risk-free asset 0, solve it and prove that the total will be 0.8. So this is proof. You can take a screenshot if you want, take a photo if you want, write only if asked. Yes, when you solve the equation, it is automatically proved. No, that is what I said. If they say prove, then write it. In only one exam they have done this. Other exam they have not given the proof in the suggested answer. So student can solve it by writing the proof or can ignore it. But if the proof is specifically asked, then you have to prepare that table. Is it right? Okay. Now we'll take question number 5. Again write down most repeat question. One of the highly repeated questions from this topic is question number 5, and that is the reason I am taking it. Even though it may sound easy, it is better to keep ourselves ready. Sometimes easy questions can be more challenging in the exam. Question number 5. As an investment manager, you are given the following information. Okay. So there are 5 columns. Particular price in the beginning, let us call it P0. Dividend, let us call it D1. Market price, it should be market price at the end. Market price at the end. This is beginning price. This is market price at the end of the year, P1. Share or bond, whatever. And the last column is beta. So there is a small drafting mistake. It should be market price of share at the end. Market price of the share at the end. Right. So now we are given shares of 3 companies: Manufacturing Limited, Pharma Auto, and we are given Government of India bond. This question has a very serious mistake. They have given beta of these 3 companies 0.8, 0.7, 0.5, and Government of India bond 0.99. 0.99. It should be 0, but they have given 0.99, which is more than the beta of auto, pharma, manufacturing. Government has also come under risk. So instead of Government of India bond, it should be Government of Pakistan bond. Okay. Then the question will be rectified. Be by assuming risk-free return is 16%, risk-free return is 16%, I will erase it, otherwise some Pakistani will shoot me from the border. Calculate expected rate of return of the portfolio aggregate of the investor. So what is the overall return of the portfolio? What is the overall return of the portfolio? Second, expected rate of return of portfolio in each. Each means you have to find separately for each of them. So 4 answers will be required. Above stated share using CAPM. Using, you will say, can I use this formula D1 plus P1 minus P0 upon P0? This is also a formula for calculating the return of a period. Is it right? But that is not CAPM. That is not CAPM, because one student had asked this query some years ago, that return is equal to dividend plus capital gain upon the beginning price. You are right. But what is the question? CAPM. So CAPM is RF plus beta into RM minus RF. Beta is given. RF is given. RM is missing. Oh my God. So you have to find out the RM. If you can find out RM, you can solve this question. And then you have to find out the average rate of return. This question they have not properly drafted. Average rate of return of the portfolio. This is one of the controversial questions. Okay. But then in the exam, which they have already asked 6 or 7 times, you can't write it is a controversial question. Hence, I refuse to answer this question. Kindly give me full 8 marks. So first we'll find out RM, and for that there is a trick. Treat that these 4 securities represent the stock market. What will you assume? These 4 securities consist of stock market only, or the market portfolio. These 4 securities represent market portfolio. Then can we find out RM? Yes. This is the total dividend. This is the total market value at the end. This is the total market value at the beginning. So for the market portfolio, I can apply the formula D1 plus P1 minus P0 divided by P0, where dividend will be total of all the dividend, P1 will be total of all the prices, and P0 will be total of all the prices at the beginning. Is it right? In fact, that is your first question. Calculate the expected return of the portfolio aggregate of an investor. And then the same question they are asking below, average rate of return of the portfolio. So average rate of return of portfolio will be calculated by applying CAPM. So in order to get the RM, there is no choice but to assume that the given portfolio is a market portfolio. Okay. Please write down. Please write down. Assume that this is a market portfolio. Similar question if they ask, you have to assume that. Yes, that the given portfolio is a market portfolio. Yes, you have to assume it is market portfolio. So then write down, let us calculate RM. Let us calculate RM. Let us calculate RM. Now write down 4 columns. Investment, initial price, dividend, market price at the end, market price at the end, So under investment, write down same three companies. You can write in short M Limited, P Limited, A Limited. In the exam, don't write short form. And the last is Government of India bond. Government of India bond. Now write down the initial price 30, 40, 50, 100, 1005. Tell me the total of the initial price. 1125. Dividend write down 222. And Government of India bond 140. My God. मोदी है तो मुमकिन है. Everywhere. Market price at the end 55, 65, 140, 1010. Total of the last column. Just check it. Do not copy. Is it right? 1270. So can you now tell me what will be RM? RM will be equal to, write down below, RM is equal to dividend plus closing value minus opening value upon opening value. With formula you have to solve. If you write directly in the exam, the paper checker sometimes they deduct marks. And when we tell them why have you deducted marks, they say this is a poor presentation. Same answer, two students get two different marks. One gets 8 for the same question, one gets 6 for the same answer. So this is 25.87%. Once you get RM, now the problem is easy. Write down below. So this was my first answer. Expected rate of return of the portfolio aggregate of the investor. So on an aggregate basis, the investor earned 25.87%. Now for each stock we have to compute. Write down please. Write down required rate of return as per CAPM for each security. Required rate of return for each security as per CAPM. Required rate of return for each security as per CAPM. Write down the formula RF plus beta into RM minus RF. One by one. First write manufacturing limited. For manufacturing limited, the answer is expected return or required return is equal to 16 plus 0.8 into bracket 25.87 minus 16. How much is that? Is it 23.9%? Next, pharma. Pharma is 22.91%. No problem. Some difference in decimal is okay. Auto Limited 20.94%. 20.94%. Okay, approximately. Government of India bond 25.77%. So this is a bonus mark once you get the RM. But many students are not able to get the RM if you have not practiced before going to the exam, because it will not click. And now the next question is average rate of return of the portfolio. So there are two ways you can do it. One is these are the return of individual stocks. Weights are not given. So assume equal weight. If you assume equal weight, total divide by 4, will give you average rate of return. Second method is first find portfolio beta. First find portfolio beta, and using portfolio beta you can find the rate of return as per CAPM. But one problem is there, weights are not given. We'll assume equal weight. If you assume equal weight, then it is simple average. Okay, so write down step 3, average return of the portfolio. Average return of the portfolio, just add those 4 answers and divide by 4. How much is that? Add total, divide by 4. $23.38. You can stop here in the exam, but if you want to write alternative presentation, write this also. Alternatively write down. There is no harm in writing just 1 or 2 lines. First we will calculate average beta of the portfolio. We'll check. 23.18. Okay, no problem. You can just check your calculation. If your calculation is right, then go ahead. So now write down, first we'll calculate average beta of the portfolio. First we'll calculate the average beta of the portfolio. Average beta of the portfolio is 0.8 plus 0.7 plus 0.5 plus 0.99 divided by 4, because we are assuming weights are equal. Okay, so you will get 0.7475, and now you use 0.7475 in the CAPM model. If specifically they tell you anything, then we should know the alternative presentation also. Both answers are not required. So write down expected return as per CAPM, RF plus beta into RM minus RF. Please write down 16 plus 0.7475 into bracket 25.87 minus 16. So are you getting 23.38%? Say yes. So you will get almost same answer. Some difference may be because of the rounding off. It's okay. Yeah, they will give you marks. Okay. So that was question number 5, repeated in the exam multiple times. Another repeat question is, and good question is, question number 6, May 17 exam. Okay, this will be a very good question and very important question. Pre-practice is required. The following information are available with respect to Krishna Limited. Jai Krishna. Year, Krishna Limited average share price, dividend per share, average market index, dividend yield, return on government bond. So these are your risk-free return. Then compute the beta value of Krishna, and at the end of 2015, and state your observation. Whether it is underpriced, overpriced, we will see. So how do you calculate beta in this case? First we have to compute the return of each year. Okay, then you remember the formula of beta, covariance of the stock with the market upon variance of the market portfolio. That is the basic formula of beta. To calculate the covariance, you need to find out the deviation of the x minus x bar into y minus y bar. So we will assume stock is x and market is y, and then accordingly we will solve. First thing we need to find out the x bar, means average return of the stock. Average return of the stock. Okay. First year I can't calculate because the previous year data is not given. But second, third and fourth year we can compute the expected return because the opening prices are given. I will use this formula D1 plus P1 minus P0 divided by P0 to calculate the return of the respective year. 2012 we are not calculating because opening balances are not available. Okay. So first 2013 I will show you, and then you will calculate (2013) is 12.24%. Say yes. 2014, anybody? 2014. 2014, check. (32.41%). 32.41%. 2015. 2015. 2015 is 16.13. 16.13. Is the answer right? Then take the total of the last column. Total is 60.78. Divide by 3. That will give you 20.26%. Is it right? 20.26% is right. This is your average return of the stock. Now we'll do the same thing for market, but in case of market, I will also have to add the dividend yield which is given in the problem. So market also will give me appreciation in percentage by comparing the opening and closing balance. To that I will add dividend yield, and that will give me total market return, capital yield plus dividend yield. So write down step 2. Very good question. On your own you can make mistake in the exam if you have not practiced. Year calculation, percentage of index appreciation, percentage of index appreciation, dividend yield in percentage, total market return, total market return, total market return. One I will show you, other two you will calculate. 2013 Now don't use 2012 line because opening balance is not there. In 2013 the closing is 2130, opening is 2013, divided by opening 2013. So that gives you 5.81% appreciation, correct? Say yes. Plus 5%, market return is 10.81%. Is it right? Now try 2014. 2014 try. 16.33% you are getting. Very good. Everybody should try. 2015. 2015 try. 16.79%. So what is the total? $43.93 divided by 3. Divide by 3, you will get 14.64%. Is it right? 14.64%. Right. So I have got average return of the stock, average return of the market index. So can I not calculate now? Can I not calculate beta now using the formula covariance upon variance of the market? Yes or no? So using that basic knowledge of this chapter, beta is the ratio of covariance of the stock with the market upon variance of the market portfolio. So we will assume stock is X and market is Y. Very important question. 8 marks if you have done the practice in advance. So write down 2013. Now go to your step number 1. You will find these returns figure there. Year wise return 12.24%, 32.41%, 16.13%. Market return from step 2 10.81%, 16.33%, 16.79%. Then I will compute X minus X bar. X bar means the average return of the stock 20.26%, correct? Take 12.24 minus 20.26. Practice is very important in this chapter. Otherwise students don't know which column to draw, what should be added, deducted. So anybody wants to reply X minus X bar. Is it minus 8.02? Below that, second year. 12.15. Very good. Year 3. Minus 4.13 is right. 8 mark bonus mark. But you should know it. Anybody for Y minus Y bar? Take 10.81 minus 14.64. Come on. Minus 3.83. Again, take 16.33 minus 14.64. 1.69. Is it 1.69? Last one. 16.79 minus 14.64. 2.15. Now what you will do? Multiply these two. X minus X bar into Y minus Y bar. If both are negative, write positive number. If both are positive, write positive number. One is positive, one is negative, write negative number. Check. Done. Check the answer of second last column. Are you getting positive 30.72? Say yes. 20.53. 20.53 is right. Minus 8.88. Total. Check total. Minus 8.88. Take total of these three numbers. 42.37 you are getting. 42.37. 42.37. Is it right now? Now take y minus y bar square. Take this column and take the square. 3.83 into equal to you'll get 14.67. 1.69 into equal to, that is the trick, 2.86. 2.15 into equal to 4.62. Take total 22.15. So what will be the beta now? This divide by this. Correct? Right. So dear student, now you write below that beta equal to formula summation x minus x bar into y minus y bar upon summation y minus y bar square. Y minus y bar square. Y minus y bar square. So that is 42.37 divided by 22.15. 1.913. Okay, 1.913 seems to be right. Now write down observation. Observation they have said, but not clearly exactly what they want us to observe. We want to check whether the stock is overpriced, underpriced, and what action should be taken in each year. So observation, write down. Observation. CAPM return, actual return, and action. CAPM return, actual return, and action. So first I will solve, next two you will solve. Risk-free return is based on government bond. You are right. So first year the CAPM return was 6 plus, what was the beta? 1.897. Beta is not given. Beta is not given. This is your computed, no? That is by mistake. You take 1.91. Whatever beta you have got, take the same figure. I think I have made a mistake in writing here. You can take the same beta which you have got in your previous answer. Return on market was how much? 14 point? No, for that year. For 2012-13. 10.81. Correct. We are doing year-wise calculation. So is it 15.12? Then actual return is how much? Actual return is 12.24. Actual return is less than CAPM return. So it is overvalued. The action would be sell. The action would be sell. The action would be sell. Okay. Risk-free return is given in that last column. 6%. 6%. Yeah. 15.20 is okay. Try the next one. Anybody wants to reply the next one? What is your CAPM return here? 25.60. What is actual return in that year? Can you see this 32.41 in your step 1 answer? Step 1, is it there? Yes. Now this year your actual return is more than the CAPM return. So you should buy. It is undervalued. It is what we call positive alpha. Is it right? What we call it? Positive alpha. Positive alpha means your actual return is more than CAPM. So that means you should buy. Here it is negative alpha. Negative alpha means sell. This is 25 point how much? 76. Okay, very good. So learned student, please do the last year yourself. How much is the answer for last year? Yes, come on, CAPM return. Nobody is replying. Where have you gone? Is it 26.47 approximately? 26.64. 26.64. And what is your actual return? Last third year, 16.13 is there. 16.13 is there. Your answer is sell. Good question. Cabra has also got the same answer. Now in this year actual return is less, so sell. This is negative alpha. Negative alpha stock should be sold. Okay. So there is one more question pending. Should we do it today or tomorrow? Tomorrow. You are tired? Okay. So now we will continue tomorrow. Hello, good morning. Please come to question number 7 now. Question number 7. Mr. X owns a portfolio with the following characteristic. Factor 1 sensitivity, security A 0.80, that is beta for security A. This is beta. Security B 1.50. This is beta of security B for factor sensitivity. Risk-free security has a beta of 0. Factor 2 sensitivity is 0.60. Factor 2 sensitivity for security B is 1.20 and risk-free security beta is 0. Expected return is 15%, 20%, 10%. This is the expected return of security A, security B, and risk-free security. 10%. Risk-free security return is 10%. It is assumed that security returns are generated by a two-factor model. It is a two-factor model, factor 1, factor 2. Factor 1 can be anything like inflation, GDP. Factor 2 can be something like interest rate, market, okay, industrial production. So we don't know. Mr. X has rupees 1 lakh to invest and sell short rupees 50,000 of security B. So how much amount he has? He has 1 lakh rupees. He has 1 lakh rupees and he sells short 50,000 of security B. So he will get 50,000 rupees by selling security B. When you do the short selling, you get the money. So this is 1,50,000 he has now, and purchases rupees 1,50,000 of security A, and he buys security A worth rupees 1,50,000. 1 lakh his own money, 50,000 from short selling of security B. Investment in A is 1,50,000. B we will say minus 50,000. Short selling will be given a negative weight. Short selling will be given a negative weight. Okay. Always remember, short selling or borrowing will be given a negative weight. Question is, what is the sensitivity of Mr. X portfolio to the two factors? So you have created a portfolio which has two stock. Stock A rupees 1,50,000, stock B minus 50,000. Stock B minus 50,000. Is it right? So you have to find out the sensitivity of Mr. X portfolio to the two factors. So portfolio sensitivity you have to find for factor 1 and factor 2. Portfolio sensitivity is always equal to weighted average beta. So basically we have to first find out how much weight you have allocated to A and how much weight you have allocated to B. Is it right? Second question will come to this again, very easy. Mr. A borrows, if Mr. X A borrows 1 lakh, already he has 1 lakh rupees. He own money 1 lakh. Borrowed money 1 lakh. So right now he has how much? 2 lakh rupees at the risk-free rate. Borrowing will be given a negative weightage. Is it right? And invest the amount he borrows along with the original amount of 1 lakh in security A and B in the same proportion as described in part 1. As described in part 1 means this is the part 1. In part 1, own money was 1 lakh. Short selling of B was 50,000, correct? Now you have 2 lakh rupees. Now you have 2 lakh rupees. How much will be short selling? The amount of short selling in B is half of the funds that is available to you. In the first question, short selling in B was 50,000 when the amount available was 1 lakh. Now the amount available is 2 lakh. So what will be the short selling of security B? Is it 1 lakh? 1 lakh. So B will be short sold 1 lakh. So total amount you will have now 3 lakh. By selling B, short selling, you will get funds equal to 1 lakh. So 3 lakh. So my investment would be now in 3 items. A will be 3 lakh, B will be minus 1 lakh, and risk-free asset, that is borrowing, will be 1 lakh negative. So you will have to calculate the weights. You will have to calculate the weights. And by calculating the weight, after calculating the weights, you will be able to calculate the portfolio beta for factor 1 and factor 2 by applying weighted average beta. When you have more than one factor, we calculate weighted average beta for the portfolio. Is it right? So these two questions are same. Only in this question they have added borrowing also. And the third question is, what is the expected return premium of factor 2? What is the expected return premium of factor 2? So this is based on arbitrage pricing model. The expected return of a stock is equal to beta of factor 1 into risk premium of factor 1 plus beta of factor 2 into risk premium of factor 2, okay, plus risk free return, and that should be equal to 15%. So we'll have to solve an equation because risk premium is missing for factor 1 as well as factor 2. So by solving a simultaneous equation, you will be able to find out the risk premium for factor 1 and factor 2. Very important question. It was asked in the exam. So write down answer of first part. Answer of first part, write down. Answer of first part. Own fund. First I am going to explain so that in future if they ask you this question, you can answer better. Own fund is 1 lakh. Short sale of B 50,000. Short sale of B 50,000. Total is 1,50,000. Total is 1,50,000. Amount invested in A. Amount invested in A amount invested in A, so 1,50,000, and B is minus 50,000. B is minus 50,000. B is minus 50,000. Okay. Then you write down step next, computation of weights. Computation of weights. Under computation of weights, draw 3 columns. Presentation is very important. You may blame me for taking little more time, but it is important. First write down stock A. Total investment A is 1,50,000. Divide by 1 lakh. How did you get 1 lakh? 1,50,000 minus 50,000. So the total is 1 lakh. So the denominator will be 1 lakh. Okay, the denominator will be 1 lakh. Now write down weight 1.5. This is very important. What mistake students do? They write 1,50,000 divided by 1,50,000. So they write 1, but that is not right. Is it right? Now write down next point, minus 50,000 divided by 1 lakh. This weight will be negative because it is short. So the total should always be 1. Total should always be 1. Total should always be 1. Now write down sensitivity of Mr. X portfolio. Sensitivity of Mr. X portfolio to the two factors. Sensitivity of Mr. X portfolio to the two factors. Sensitivity of Mr. X portfolio to the two factors, factor calculation and beta. Factor calculation and beta. Factor calculation and beta. Factor calculation and beta. So you just have to apply the weighted average formula. Okay. 0.8 into 1.5, that is weight, then factor 1 beta 1.5 into 0.5 into minus 0.5, sorry, negative weight, is it 0.45? Is it 0.45? Now try factor 2 yourself. Try factor 2 yourself. Try factor 2 yourself. Factor 2 weights will not change, this factors will change, no? Factors will change. 0.6, can you see in the question book? Risk-free rate will come in the second part of the answer. First part of the answer does not have any risk-free. Okay. So 0.6 into 1.5 plus 1.2 into minus 0.5. 0.30. So this was so easy. Only you have to get the weights correctly done. Okay. Now we'll write down third answer. Answer of part 2. Answer of part 2. For that I need to first find out exactly how much amount was invested in A Limited. Write down answer of part 2. Write down answer of part 2. Answer of part 2. Under that write down own fund 1 lakh, borrowed fund 1 lakh, borrowed fund is also 1 lakh. Total we have 2 lakh. So you just draw a line and write 2 lakh here. 2 lakh. Total 2 lakh. Total 2 lakh. Total 2 lakh. Short sale of B, write down. Short sale of B. Short sale of B. 2 lakh divided by 2. 2 lakh divided by 2. 1 lakh. 2 lakh divided by 2, 1 lakh. Why it is divided by 2? Because they are saying that, one good question, you have to take the same ratio which you have followed in question number 1. In question number 1, you had 1 lakh rupees money. Short selling in B was 50,000. Now you have 2 lakh rupees. So what will be the short sale of B? You have to follow the same proportion. Okay. So 1 lakh rupees is this 2 lakh divided by 2, because half of the funds available is the short selling in security B. So now the total funds available after short selling is 3 lakh. Total fund available after short selling is 3 lakh. Total funds available after short selling is 3 lakh. Now the breakup of that 3 lakh is A limited 1 lakh, borrowing is 1 lakh, and B limited minus 1 lakh, and B limited is minus 1 lakh, and B limited is minus 1 lakh, and B limited is minus 1 lakh. Why minus 1 lakh? Short selling. Two things note down. Two things note down before I proceed further. For short selling and borrowing, write down students, short selling and borrowing, assign negative weights. For short selling and borrowing, assign negative weights. For short selling and borrowing, assign negative weights. For short selling and borrowing, assign negative weights. Okay, now we'll give the weights. Next heading, write down amount invested in security A. Amount invested in security A. In fact, this you don't need to write, we have already done. Just wait. Now step next, write down computation of weights. Computation of weights. Computation of weights. Computation of weights. Risk-free asset, write down minus 1 lakh divided by 1 lakh. Why 1 lakh rupees in the denominator? Why 1 lakh rupees in the denominator? 3 lakh is the investment in A. 1 lakh is borrowing. 1 lakh is short sale of B. So the total will be 1 lakh. Total will be 1 lakh. Write down. Total is 1 lakh. Denominator, one more note, write down for your future reference. For students who might get confused at a later stage, denominator will always be own funds. Denominator will always be own funds. Denominator will always be own fund. Denominator will always be own funds. Right? Now using these weights and multiplying by the factors, factor beta, you will be able to calculate the portfolio beta for the two factors. Okay. Write down last step for part 2. Sensitivity of the portfolio to the two factors. Sensitivity of the portfolio to the two factors. Sensitivity of the portfolio to the two factors. Just a minute. Sensitivity of the portfolio to the two factors. Sensitivity of the portfolio to the two factors. First write down factor 1. First write down factor 1 minus 1 into 0 What is minus 1? Minus 1 is weight of risk-free asset. What is minus 1? It is weight of risk-free asset. This is the factor sensitivity of risk-free security. Plus, what is 3? 3 is the weight of security A into 0.8. 0.8 is the factor sensitivity of security A. Plus minus 1 is the weight of security B, and this is the factor 1 sensitivity for security B. Just do the calculation. Just do the calculation. Is it 0.9? Is it 0.9? Right. You will try factor 2 so that I will understand that you are understanding it. Factor 2. Factor 2. Come on. One student has replied 0.6. Very good. Factor 2. Same calculation, minus 1 into 0 plus 3 into 0.6 minus 1 into 1.2. When you solve it, you will get 0.6. This is your second answer. That was so simple. Yes or no? Now the next task is to calculate the factor return premium for second factor, which means you will have to solve an equation. Because there are two risk premium in this question. Risk premium for factor 1, risk premium for factor 2. So therefore I will solve an equation. So write down, heading write down at the top. You can see the heading, calculation of expected return premium of factor 2. Calculation of expected return premium of factor 2. Calculation of expected return premium of factor 2. Then write down, let expected return premium of factor 1 be F1 and factor 2 be F2. So equation will be expected return minus risk-free return, or you can write risk-free return on the right side plus RF. Just like CAPM model, risk-free return plus premium. So what I have done to save your time and effort, I have brought this RF on the left side. If you are interested, you can write on the right side plus RF. Okay. This will just help you to save time. Numbers will come on the left side, equation will come on the right side. That was the intention. There was no bad intention. Okay. After that you write down for security A, 15% is the expected return. Can you see in the third line of the table? Minus risk-free return 10%. Minus risk-free return 10% is equal to 0.8. Can you see factor 1 0.8 beta? 0.8 security A, factor 1 beta 0.8 in the question into F1 plus 0.6 into F2, 0.6 into F2, 0.6 into F2. For security B, write down, or first I will simplify it for you. 5 is equal to 0.8 F1 plus 0.6 F2. Is it right? For security B, write down question in front of you. Expected return is 20 minus 10 minus 10. नहीं दिख रहा है क्या? ठीक है, हाँ करो. 1.5 F1 plus 1.2 F2. Okay, so simplify this. 10 is equal to 1.5 F1 plus 1.2 F2. Solve equation. Solve equation 1 and 2. Solve equation 1 and 2. Solve equation 1 and 2. Anybody wants to answer? What will be the answer for this? Solve equation 1 and 2. F1 is equal to 0. F2 will be 8.33. How do you solve the equation? That is not my duty. You are a CA finalist some days away from your exam. You have to solve. How do you solve the equation? That even I don't know. I also forgot. So you can just multiply this by 2. If you multiply this by 2, it will become 10 is equal to 0.8 F1, sorry, 1.6. 1.6. See, I have also forgotten. I have never done equation in my school also. Plus, wait, 1.2 F2. No, I think I have made some mistake. Anyway, let me try. This is 10 is equal to 1.5 F1 plus 1.2 F2. Something is wrong. So minus minus minus. So this will be 0. This will be 0.1 F1 and this will also be 0. Is it right? So which means F1 will be equal to 0. Something like this. See, I am not very sure and today is not the time to teach the equation. So this way you are going to crack the equation. Right? So write down, later on you can try as homework. If students are not getting F1 as F2 as this number, when you are free you can take coaching from your brother or sister who are studying in 4th or 5th standard and they will help you. So my answer is over now. Therefore the expected return premium of factor 2 is 8.33. Therefore expected return premium of factor 2 is 8.33. Now this question is very important. If you have not done practice before going to the exam, then you will have a challenge. Okay, one thing you should know how to solve the equation, and the other important thing was how to assign the weight. How to assign the weight. So that was a discussion on portfolio management. Just we'll wait for a minute. So the next topic is mutual fund. Most of the student must be happy. This is a very easy topic and you must have done similar questions also. So mutual fund topic. Question number 1. Are you ready? Say yes. Mutual fund question from July 2021 exam for 5 marks. The AMC of a mutual fund has declared a dividend of 9.9% on the units under the dividend reinvestment plan for the year ended 31st March 2021. So what is the rate of dividend? 9.98%. Dividend is always paid on the face value. Dividend is always paid on the face value. The investors are issued additional unit for the dividend at the rate of closing NAV for the year as per the condition of the scheme. This is a reinvestment plan. This type of plan is called dividend reinvestment plan. Have you studied dividend reinvestment plan? So you will calculate the number of units reinvested. You will calculate the number of units reinvested, right? Number of units reinvested, and number of units reinvested is equal to dividend divided by NAV, which in this question they are saying it is equal to closing NAV. Okay, next line. This question is very important. I am going to ask you also to solve, and you will check your intelligence. The closing NAV was 24.95 on 31st March 2021. An investor, Mr. X, who is having 20,800 units at year end, underline. So this fellow is holding 20,800 units at year end, means this is after adding the number of units reinvested. This is after adding the number of units reinvested, has made an investment in the units before the declaration of dividend at the rate of opening NAV plus an entry load of 0.04. So how much he has paid for the unit opening NAV plus 0.04? This fellow has paid at the rate of opening NAV plus 0.04. Understood? Next line. The NAV has appreciated by 25% during the year. So opening NAV plus 25% appreciation will be equal to closing NAV, which is 24.95. Can you see 24.95 here? Assume the face value of the unit is 10 rupees. So this 10 rupees will be required for multiplying by 9.98%. So that will give you dividend per unit. That will give you dividend per unit. Question is calculate the opening NAV. Very easy question. Calculate the number of units purchased and calculate the original amount of investment. In this question, I am going to test you. So are you ready for the test? Please reply to my first question. Everybody is invited to reply. What is the opening NAV? My first question, please try opening NAV. What is my opening NAV? Students are requested to reply. What is my opening NAV? Please try. Opening NAV plus 25% appreciation is equal to closing NAV. So let the opening NAV be X. Let the opening NAV be X. Mehul Garg has replied, let me check. So the equation will be X into 1.25 is equal to 24.95. Correct? Say yes. If you don't say yes or no, how will I understand? Therefore, opening NAV will be 19.96. Opening NAV is 19.96. This was not a question. This was a bonus mark. Okay. This was a bonus mark. Next question. Again you will participate. You will participate. Let me see who gives me the correct answer. Calculation of number of units purchased. Please reply everybody. Calculation of number of units purchased. Calculation of number of units purchased. Waiting for your answer. This is a question of dividend reinvestment asked in the exam. So the number of units purchased, we have to solve an equation x plus number of units which you are going to reinvest, and that should be equal to closing unit which was given to you 20,000 how much 800. So the student will have to again solve an equation. Please check whether you can get it right or not. Yes. My question is, what is the number of units purchased at the beginning? Let the number of unit purchased be x. Write down. Let the number of unit purchased be x. Let the number of unit purchased be x. And then you have to write down dividend per unit. Dividend per unit. Dividend per unit will be 10 into 9.98%. 10 into 9.98% means dividend per unit is 0.998. 0.998, correct? Then total dividend received. Total dividend received will be number of unit is x, dividend per unit is 0.998, so 0.998x. 0.998x. Now therefore number of unit reinvested will be 0.998x divided by 24.95, which is the rate at which number of units were reinvested. Correct? Number of unit reinvested is total dividend divided by the rate at which dividend was reinvested, 24.95. So now I am going to write a simple equation. Total number of units after reinvestment is 20,800. Total number of units after reinvestment is 20,800. So the equation will be, anybody wants to reply now? Solve the equation and reply. Come on, students, please write x plus 0.998x divided by 24.95. Equal to 20,800. Who wants to answer? Yes. Please answer.
12,000.
Is it 20,000? One student got 20,000. Very good. 20,000 is right. That was not very difficult question, but very few students are able to solve it by writing this equation. Any other person who wants to reply? What is my third question? What was the original amount invested? Write down. Calculation of original investment amount. Calculation of original investment amount. Calculation of original investment amount. right hand side amount, at what rate he has purchased. He has purchased at the rate opening NAV plus 0.04 entry load. So the amount you are going to pay is opening NAV plus 0.04 and multiplied by 20,000 units. Say yes. Write down. Please write down. This question you may not have solved in your regular classes. Opening NAV 19.96. Opening NAV 19.96. Question says entry load was paid. Add entry load 0.04. Add entry load 0.04. Therefore, selling price per unit. Therefore, selling price per unit is 20. This is the rate at which mutual fund has sold units to the investor. Point D, write down number of units purchased. Number of units purchased. Number of unit purchase is as per step 2 20,000. Now who will reply? Let me see who will reply first and fast. Total amount of initial investment. Come on, reply fast. Total amount of initial investment. Total amount of initial investment will be 20 rupees per unit into 20,000. C into D. Mehul Garg is saying 4 lakh rupees. Very good. 4 lakh rupees, right. If you practice in advance, you can do it fast in the exam. Because there are equations to be solved in this question. And there are concepts involved in this question. So now learned students, please come to question number 2. This is also from exam for 4 marks. And this is also a reverse working question. Mostly in the class we learn to solve question in a straightforward manner. But in the exam they give you reverse working question. From the last step you have to find the answer which is at the beginning. Okay, so one more practice. And I will expect all the students should participate. Messrs. Strong and AMC has floated a dividend bonus plan. In this question they will get bonus unit. In the previous question they had reinvested the dividend. Now here you will be given bonus unit. On 1st April 2016 at a certain NAV. At a certain NAV means this is your missing question. This is what we'll have to find. It's printed here also. Question mark. The fund has a robust growth and has declared a bonus of 1:5. And they have interpreted 1 bonus unit for 5 existing unit held, 5 right unit held, current unit, 1:5. And a second bonus of 1:4. One more bonus. Bonus is reigning. On 30th September 19, the fund has generated on 31st March 2021. When was the issue made? 1st April 2016. And this they are talking about 31st March 21. So how many years are over? 4 years are over. Or 5. 17, 18, 19, 20, 21. Is it right? 2017, 18, 19, 20, 21. 5 years are over? 5 years are over. So after 5 years they find that the average yield is 17.5%. That means the investor has earned on an average 17.5%. 5% per annum. So in 5 years time, how much he has earned? Multiply 87.5% he has earned. The Mr. Optimistic has made an investment of 16 lakh. So if you invest 16 lakh rupees today with 87.5%, you can find out what will be its value after 5 years. Yes or no? Yes. In the plan before the declaration of the first bonus and remain invested thereafter. So he has invested 16 lakh on 1st April. By adding 87.5%, you can calculate what is the value he will have been after 5 years. The following information is also available. You have to find out the NAV on this date. They have given you NAV on 39/2017, 39/2019 and 31st March 21, 100. You are required to advise to Mr. Optimistic the opening NAV which is required by him to calculate the capital appreciation. So first chance to you. Students will try. You have to find out the opening NAV. I'll give you 30 seconds to try. Then only your mind will work. You will think. So 30 seconds starts now. 30 seconds starts now. Anybody wants to reply? Students who are studying at home, they can also reply. Yes, please reply. Anybody, any answer? So far no answer. What was the NAV on 1st April 2016? You have studied mutual fund chapter. Okay, so let us do the reverse working. Let us do the reverse working. This is a question of reverse working and you will be able to solve. So first I will find out number of units on 31st March 2021. Number of units on 31st March 2021. Number of units I can calculate on 31st March 2021. We know the value of our investment. We know the NAV per unit. Value divided by NAV per unit can give you number of units on 31st March. And then you do reverse working and you can calculate the number of units at the beginning and then you can compute the NAV at the beginning also. Yes, I know this is a tricky question. First time very few students can reply correctly. So write down. Don't worry. That is why I am taking such question. It will be useful if it appears in the exam. First write down point A. Amount invested on 1st April 16. amount invested on 1st April 16, amount invested on 1st April 16 lakh. Then write down number of years, write down 5 years, number of years 5 years. Average return, write down average return 17.5%, average return 17.5%. So multiply point B and C, that will give you total return multiplied by 16 lakh also. So that will give you total gain during 5 years. Total gain during 5 years. A into B into C. A into B into C. 14 lakh is your gain. Therefore, closing investment value 30 lakh. You can write 30 lakh directly if you can get it, no problem. And what is the closing NAV on 31st March 21? 100. So can you find out the number of units? Number of units will be 30,000 on 31st March 21. Now can you do reverse working and reach the opening number of units? Opening investment is 16 lakh. Divide by opening units, you will get the opening NAV. So now you have to do reverse working and find out the number of units on this date. Right now you have 30,000. There was one bonus 1:4, 1:5. So you have to find out number of units at this point. This is simple common sense now. Write down step 2, number of units on 1/4/16. Number of units on 1/4/16. Please reply. I am giving you a chance to reply. 4 columns we will draw. Date, unit held after bonus, unit held, write down after bonus, unit held after bonus. This word after should come here. Unit held after bonus. Bonus ratio, unit held before bonus, unit held before bonus. Okay, unit held before bonus. So first write down reverse working I have to do. I will write 30th September 2019. 30th September 19. Bonus ratio is 1:4. Unit held was 30,000. So can you tell me how many units were held before bonus? 24,000. Now write down 30th September 17. 24,000. 1:5. So 1:5, you will take 5/6 into 24,000. If there are 5 shares plus 1 bonus share, you have 6 shares. So the ratio is 5 unit before versus 6 unit after. So 5/6. That is the logic. 20,000. Now write down step 3. NAV on 1/4/16. NAV on 1/4/16. These 2 questions probably you have not done in the class. Okay. Right hand side rupees. Amount invested. Amount invested. Yes, why are people not replying? 16 lakh. Then point B, number of units. Step 2, 20,000. Write down. Number of units 20,000. My question is, what was the NAV on 1416? Yes, come on. NAV per unit. Yes, yes, reply. Is it 80 rupees? Yes. Finally, we reached the answer. But it took some time. Nowadays in the exam, they are asking such reverse working question. Okay. Anybody, any query? Please reply yes or no. Query, yes or no. It was easy question, but if you are in the exam hall, then you may not have so much time to think, and it is only for 4 marks. So you can't dedicate 20 minutes on this. So pre-practice is required. Now the next topic is derivative. Under derivative topic, we will discuss future, option and interest rate derivatives. Okay. So lengthy topic. So first I am going to take derivative futures. What is a future contract? A future contract is a right as well as an obligation to buy or sell a specific quantity of a specific underlying at a specific rate on a specific future date. It is a right as well as an obligation. Futures are traded on the exchange. Forward contracts are over the counter. So we are going to take one November 2020 question from RTP. Question number 1 from November 2020 RTP. Quite important question. Write down. Again, pre-practice is required. Otherwise, in the last minute of the exam, you might make some mistake. So write down, very important for upcoming exam. Mr. SG. Underline this word sold. Sold means he has taken a short position. Short position holder will make profit if the price goes down. So he is betting on downward movement of price. He is expecting that Nifty will fall. 5. 5 means lot, number of lots. 5 is number of lots. 4 months. 4 months means the maturity period. This future will mature after 4 months. 4 months, here is the maturity period. Nifty future on 1st February 2020 for rupees 9 lakh. At the time of closing of trading on the last Thursday of May 2020, that is after 4 months, February, March, April, May, what is the actual index turned out to be? 2100. Actual index turned out to be 2100. The contract multiplier is 75, which means for one lot you have 75 units. So he has bought how many lots? 5 lots, 375, and he has taken it for 9 lakh rupees. The 9 lakh divided by 375, how much? 2400. So basically he has taken a short position on 2400 and market has actually gone down to 2100. So he will have a profit of 300 rupees per unit into 375. Into 375. So that will be his profit. That is a basic calculation. Based on the above information, calculate. You have to do reverse working again. The price of the one future contract on 1st April 2020 So 1st April 2020, the price of the one future contract is 2400 per unit and one lot is 75. So you can calculate the price of one future contract. Approximate Nifty index on 1st April 2020. You have to find the spot Nifty on that day. You have to find spot Nifty. Spot Nifty into e to the power RT is equal to future Nifty. Is it right? So reverse working and find the value of S. Approximate Nifty index on 1st February if the price of the future contract on the same day was theoretically correct. Theoretically correct means it follows this equation. Spot price plus interest effect is equal to future value. So you have to find this value. This is 2400, which we have already calculated in the first part. On the same day, risk-free rate is, and in dividend yield is 9% and 6%. So the formula will be e to the power r minus y into t, when yield is also given, r minus y. Maximum contango or backwardation, this I will tell you later. The payoff of the transaction means profit that we have done, 300 into 375. Carry out the calculation on month basis. So 4 months, wherever applicable, 4 months. You can do calculation on days basis also, but that will be little more complex, right? So please write down the answer one by one. Everybody should participate. Price of one future contract. Price of one future contract. Total contract value. Total contract value divide by number of contracts. You will solve and give me the answer. 9 lakh divided by 5. 9 lakh divided by 5. 1,80,000. Is right now? Right. Now next step 2. Step 2, write down price of index future on 1st February 2020. Price of index future on 1st February 2020. Price of index future on 1st February 2020. So under that write down value of one future contract. Value of one future contract divide by contract multiplier. Divide by contract multiplier. That is equal to 2400. So this is the number I am going to use in the other two answers. This is the Nifty future at which you have entered into a contract. You are betting that Nifty future after 4 months will go below 2400. Now your question is, what was the Nifty index on 1st February 2020? I know the future value. I have to find the spot value. So write down the formula. This formula is used when dividend yield is given. This formula is used when dividend yield is given. S into e to the power interest rate minus yield into time. If yield is not given, then the formula is S into e to the power RT. If yield is given, then it is deducted from the interest rate. So the student will have to now solve an equation. Nowadays they have started asking reverse working question. Future value is 2400 as per previous calculation is equal to x into spot price, assume x, 2.7183 to the power 0.09, which is the risk free rate, minus 0.06, which is yield, into 4 by 12. So first what you do, it's not difficult, you can do it. Simplify the power, 0.09 minus 0.06 into 4 by 12. Is it 0.01? Yes. In the SFM classes, we tell you how to solve this part. Is it right? By using your calculator, you can do it. First, you type 2.7183. Press square root 12 times. Minus 1 multiplied by 0.01 plus 1 multiply equal to 12 times. Multiply equal to 12 times. So you will get 1.01005 you are getting. 1.01005 you are getting. So the value of the x will be, write down x equal to 2400 divided by 1.01005. I am waiting for your answer now. Is it correct? So how much you are getting? Final answer. What is the final answer? Yes, everybody. Mehul Garg is saying 2376. Very good. Anyone else? Okay. So that was my part 2. Only one note write down. Note write down, because institute sometimes does not take continuous compounding. So if you are taking continuous compounding, write a note. It is assumed that interest is compounded continuously. It is assumed that interest is compounded continuously. It is assumed that interest is compounded continuously. If they specifically say that interest is compounded continuously, then you have to do it. Otherwise, do it and write a note. Otherwise, you take compound interest and write a note. Our next question is, what is the maximum contagio or backwardation? I will give you a note first. Yes, VV Ranglesh, you are also right. Sorry, Rangaiya. VV Rangaiya is also right. First time you have answered. 2.7183. That is the value of E. Value of E is 2.7183. This they teach in SFM batch. Have you not studied SFM? You have not studied this chapter. Oh my God. Oh my God. Directly you have come to exam without studying derivative. Okay, so it is quite possible that some students have not studied this. Okay, so can we continue now? Write down the note on maximum contango or backwardation. Maximum contango or backwardation. First write a note. In a normal market, the spot price is less than. In a normal market, the spot price is less than future price. In a normal market, the spot price is less than future price. And accordingly, the basis would be negative. And accordingly, the basis would be negative. Such a market is known as contango market. Such a market is known as contango market. Basis is negative means spot price minus future price is called basis, and if it is negative we will call it contango market, means spot price is less than future price. Okay, now write down next line. Basis is equal to spot price minus future price. Spot price minus future price. Basis is equal to spot price minus future price. 2376 minus 2400 is equal to 24 negative. It's called 24 negative. It means your spot price is less than future price. And if it is negative, the market is said to be in contango. The market is said to be in contango. The market is said to be in contango. If the basis is negative, the market is said to be in contango. Therefore, maximum contango equal to maximum contango equal to 2400 is your future price, 23,676 is your spot price, 24 rupees. Okay, so the formula for basis is spot price minus future price. If it is negative, it is contango. One more question. Okay, next line write down. Calculation of payoff on the future transaction. Calculation of payoff on the future transaction. The payoff on the future transaction would be dependent on whether it is a long position or a short position. Okay, so write down. SG has taken a short position. SG has taken a short position. The future seller gains. The future seller gains if the spot price on maturity is less than the future contract price. is less than the future contract price. Is less than the future contract price. So my question to all of you is, what is the gain? He has sold at 2400. Market is 2100. 300 rupees is the gain per unit into 5 lots into 75. What is the answer? 1,12,500. Is it right? 1,12,500. 1,12,500. So that was the answer of this very good question from November 2020 RTP. Now we'll go to question number 2, which is November 19 exam question for 8 marks. 8 mark question, very important. Again write down, very important question, and this time I would like you also to answer. The NSE 50 index future are traded with rupee value being rupees 100 per index point. 1 point is equal to 100 rupees. On 15 September, the index closed at 1195 and the December future, which is the last trading day, December 15, were trading at 1225. So you tell me the number of days between 15 September to 15 December, because they have given you days calculation here. How many days are there between 15 September and 15 December? 91 days. Okay, we'll check later. The historical dividend yield on the index has been 3% per annum. This is dividend yield. And the borrowing rate was 9.5% per annum. This is the interest rate. Determine whether on September 15, the December future were underpriced or overpriced. The formula we will use is the same, because this also has dividend yield and interest rate, but this time the question is of arbitrage, whether the future is underpriced or overpriced. For that we will do our calculation and see whether it is equal to, more than or less than the rate at which it is quoted. But suppose you find that it is undervalued or overvalued, then the next question will apply, whether arbitrage transaction is possible to gain out of this mispricing. So you have to explain what arbitrage action will you take, calculate the gain or loss, then after you have taken arbitrage position, wait till 15 December. Wait till 15 December, that is the maturity date, when the index actually closes at option A or situation A 1260 and 1175. So in both situations, you have to demonstrate that the person is definitely going to get arbitrage profit. Okay, and in this question use 365 days in a year for your calculation. When they are mentioning this line, it means the calculation this time will be in days, not months. And add one more line from my side, do not use continuous compounding. Write down please, everybody please write down, do not use continuous compounding. Such questions are asked in the exam for 8 marks. So my first step would be to calculate the theoretical value of index future using the formula. So when they are saying do not use continuous compounding, I will just apply normal interest calculation. I will take the spot price and I will add the interest on that. Okay, and because dividend yield is also given, I will take interest minus dividend yield. Okay, like the previous problem. So I hope you are ready. Yes or no? Write down step 1. Calculation of equilibrium price. You can write equilibrium price. Calculation of equilibrium price means at this price there is no undervaluation or overvaluation. So this is my spot price and this is my interest and dividend yield adjustment. Okay. Solve. Take your calculator. First you solve this part, which will give you interest and dividend yield effect, plus 1195 plus 1195. Anybody who has got the answer can reply. Please reply if you can. Anybody who got the answer will reply. So the answer is, final answer is 121437. 121437. Is the answer right? Is the answer right? 121437. 121437. And what is the actual value of index future which is trading in the market? 1225 they have given. 1225. So it means it is overvalued. Step 2, write down. Step 2, write down the current market price of December 15 future is, the current market price of December 15 future is rupees 1,22,500. Rupees 1,22,500. Why 1,22,500? In bracket write down 100 units into 1225. So it should be 121,437, but it is actually 122,500. So write down it is overpriced. It is overpriced. It is more than what it should be. It is overpriced. So the moment you find that future is overpriced, it will give rise to arbitrage opportunity. Step 3, write down. Step 3, arbitrage opportunity. Arbitrage opportunity, write down. The investor should, this is overpriced, so you will sell future contract. The investor should sell future contract and buy the stock. The investor should sell future contract and buy the stock. Only selling future contract will not be enough, because in order to create arbitrage opportunity, you have to ensure that irrespective of whether the price goes up or goes down, you should be able to make the profit. If you only sell future and if the price goes up, you lose. But if you buy stock also, the loss in future will be compensated by the gain in stock. Okay. So this was my answer is not over. Is arbitrage possible? The answer is yes. Now we will see how much will be my net gain because of this arbitrage. Under that, write down cash flow on September 15. Today, I have taken a position. I have sold future and I bought the stock. I have sold future and I bought the stock. So what will be my cash flow? In order to buy the stock, you'll have to borrow money. In order to buy the stock, you need funds. So you'll borrow money. So write down buy stock. Buy stock worth. What is the spot index? Spot index is 1195 into 100. One index unit is equal to 100 rupees. So today you will buy stock of 1,19,500. Which stock you will buy? Those stocks which are included in that index. Okay, the index stocks. And then how do you fund your stock? By borrowing. Borrow rupees 1,19,500. At what rate you will borrow? Given in the first line or maybe in the fourth line of the question, 9.5%. 91 days. This 91 days is the difference between 15 September and 15 December. Okay. So 119,500. Interest calculation in the next working note. Step number C, write down. Sell future contract. Sell future contract at 1225. There are people who are willing to buy future at 1225. Market rate is 1225. So sell. When you sell future that day, there is no cash flow. It is just a contract. Cash flow will come on maturity date in the form of gain or loss. Is it right? We are ignoring the initial margin money that is required to be paid because question is not there about margin money, but otherwise you will have to pay some margin money in practical world. So what is my net cash flow today? Net cash flow today, A plus B plus C. Yes, Mehul, what is net cash flow today? Rangaiya, what is net cash flow today? 0. Positive, negative, cancel out. But the important thing is, we have to ensure that we don't lose on 15 December when the index closes at 1260. We have taken a short position on index, but index has gone up. So are we going to make a net gain or net loss? Net loss or net gain we will see, because I have 3 positions. I have bought the share, value has gone up, on share I will gain. I have borrowed money, I have to pay interest, and I have taken a short position on index, I will suffer the loss. So I will take the net total, and the net total should be positive. Correct? Right. Calculation of gain or loss on 15 December. Calculation of gain or loss on 15 December. Under that, write down case 1. Index closes at 1260. First case 1, index closes at 1260. I have borrowed money, I have to repay along with interest. I have purchased the share, I have to sell it. In the meantime, we will get dividend yield also. Dividend yield is also there. So we will get the dividend yield also. That will be my inflow. And I have taken a position on future. So I have to consider gain or loss on that also. So first point A. This is a very good question. Many very few students are able to get it right. First point A, write down repayment of loan along with interest. Repayment of loan along with interest. Repayment of loan along with interest. So first you have borrowed 1,19,500. On that you compute interest at the rate 9.5% for 91 days. What is your final answer? Come on. 122,330.35. Very good. Point B, write down loss on future contract. Loss on future contract. Future contract, you have short sold at 12.25, but actually the rate has gone up. So 12.60 minus 12.25. You will lose on future contract position. 3,500. Very good. And you have purchased stocks. You have purchased 100 stock. So you will sell at 1260 rupees. Point C, sell stock at 1260. Yes, 100, because initially also you multiplied by 100. So that is 1,26,000. It will change proportionately, whatever may be the number. But for calculation purpose, we will take 100. Then dividend yield. Add dividend yield also. Dividend yield 1,19,500 into 3% into 91 by 365. 3% is the per annum yield. So we will take proportionately for 91 days. 893.79. Very good. Now my learned student will take the total of the last column. There are two negative, two positive figure. Gain will be equal to 1063.44. So whether the market goes up or goes down will make gain. This is gone up. Now I will take a situation when market goes down. Very good question. Market important. Case 2, write down. Index closes at 1175. Index closes at 1175. Index closes at 1175. Right hand side rupees. First point A, repayment of loan. Only one line will change, the gain or loss on future. Okay. This you don't need to show the calculation again. Just write down the same figure again. No need to show the calculation again in the same problem. Save time. 122,330.35. Then you will gain on future. Why? Because now the Nifty index has gone down and you have taken a short position. So short seller will be happy if the index goes down. So the profit will be 1225 minus 1175 into 100. How much is that? 5,000 gain. Sell the stock, but now the price is 1175. Sell the stock at 1175. Sell the stock at 1175. 1175 into 100. 1,17,500. And you write down receive dividend same number, received dividend will be same. Received dividend 1,19,500 into 3% into 91 by 365. Huh? It will be same because there is an arbitrage opportunity. Okay, in first case it was 1260, now it is 1175. Whatever happens, whether market goes up or goes down, this much arbitrage profit you are going to make. Arbitrage profit means without any risk, without any investment. You have not invested from your pocket. You have borrowed money, invested. You have not taken any risk also, because whether the market goes up or goes down, you are going to make the profit. That is called arbitrage profit. Now I am going to take some important question on options. Okay? Derivative, second part is options. Question number 1, derivative option. Option is a right but not the obligation. There are two types of option: call option, put option. Call option is a right but not the obligation to buy. Put option is a right but not the obligation to sell. When you are buying a call option, you are expecting price will go up. When you are buying a put option, you are expecting price will go down. Is it right? So the holder of a call option will make profit when the price goes up. The holder of the put option will make profit when the price goes down. So on that ground, we'll solve a small question which will give you an idea about call and put option, how call and put option profits are calculated. So tell me students, are you ready? Say yes, we are ready. Yes sir. Student in the classroom is saying yes sir. So start. This question was asked in 2008 exam, and please mind it was asked in April 22 MTP also for 6 marks. So after so many years they have asked it. Again they will ask in your exam. This is a very easy question. Mr. X established the falling spread on the Delta Corporation stock. What is the name of company? Delta Corporation. First he has purchased one 3-month call option. 3-month call option means expiry is after 3 months and the quantity is one only. Here one contract. And what is the premium he paid? 30 rupees. This you have to pay at the time of entering into the contract, and an exercise price of 550. That means if the market goes, if the share price is more than 550, the option will be exercised and you will get profit. If the share price is less than or equal to 550, option will lapse and the profit will be zero. That is the meaning of call option in this example. Second, purchased one 3-month put option with a premium of 5. Premium you have to pay at the beginning and exercise price of 450. In case of put option, if share price is less than 450, you will exercise the option. If share price is greater than or equal to 450, option will lapse and the value of the option will be 0. The basic thing you have understood. Now the question is, Delta Corporation stock is currently selling at 500. today's price. Calculate profit or loss if the price of Delta Corporation remains at 500 after 3 months. Situation 1, the price remains 500. Situation 2, price goes down to 350. And third, the price goes up to 600 rupees. Assume the size of the option is 100 shares of Delta Corporation. One option has how many units? 100 shares. So your final answer multiply by 100. Your final answer will multiply by 100. One more line. Name the strategy adopted. Add this from my side. This I have added. This line I have added. Name the strategy adopted. So if you have studied this chapter, you can answer what is the strategy adopted. When you buy a call option and you buy a put option having same maturity date but different exercise price. Same maturity date but different exercise price. What do you call it? This is called strangle. Write down. This is a strangle strategy. When the exercise price is also same, it is called straddle. Okay. Straddle is when exercise price is also same. So I will just give you a small note. Nowadays they don't ask question on strategies. One student have asked me this query also, that they don't ask question on strategies. Why you are taking it? May 2022 MTP. Is it right? And it was in the RTP also, I have not mentioned actually. So if they are asking in RTP and MTP, they can ask in the exam also. And there is no harm in knowing one question. So I will give you a note first on strangle strategy. A strangle involves simultaneous purchase or sale. A strangle involves simultaneous purchase or sale of option simultaneous purchase or sale of option in bracket call or put with same expiry date but with different exercise price. This is an example of long strangle. Okay, long strangle, write down. Why would somebody buy a call and buy a put at the same time? Because market view is mixed. Means market can go up also, go down also. Like after the election, results are announced. Market sometimes can go up or go down. If there is no clear majority of a party, market will go down. Similarly, after budget announcement also. So that means somebody wants to make profit from a rising market also and a falling market also. That is called market view is mixed. Second line, what action will you take? Action is buy put and buy a call at different strike price. Profit potential, write down, unlimited. Why unlimited? Because you have bought a call option. If the price goes up, the call will generate more and more profit. So profit potential is very high. And what is the loss potential? Limited. How much maximum you would lose? The premium that you have paid. The maximum loss is the premium that you have paid. Is it right? So now we'll solve this question. Write down calculation of payoff of the option holder. Calculation of payoff of the option holder. Calculation of payoff of the option holder. Make a table with 3 columns on the right side. First write down share price on expiry. Share price on expiry. Under that 3 columns, as per the question, 500 rupees, 350 rupees, 600 rupees. Understandable? Now write down point A, value of call option. Value of call option. In case of call option, we have a right but not the obligation to buy. So either my payoff will be positive or 0. Either my payoff will be positive, that is S minus E, or 0. It can't be negative. You are holder of an option, you paid a premium for that. And what is the exercise price of call option in this question? 550. So how do you compute? 500 minus 550 or 0, whichever is maximum. Minus 50 or 0, which is maximum? Minus 50 or 0, which is higher? 0 is always higher than negative number. Okay, same thing for second situation. 350 minus 550 means minus 200 or 0. Yes, otherwise forget the formula. If the share price is below the exercise price, write 0. What about the last column? Anybody for the last column? Anybody wants to reply? What will be the answer for last column? What will be value of call option? Anybody reply please? Is it 50 rupees? 50. Just write 50, will multiply by 100 afterwards. Value of put option, write down. Value of put option is maximum of E minus S or 0. Preeti is right, Mehul is right, very good. And what is the exercise price of put option? 450. So you will compare 450 with 500. If the market is more than 450, just write 0. If the market is less than 450, take the difference. Second column, everybody. Preeti, Mehul, other student, Rangaiya, 100 rupees, very good. Last column, anybody, last column, market price is more than exercise price, 0. Total, write down. Total 0, A plus B. A plus B. 100 and 50. Then write down point D, premium paid. Premium paid on call 30 rupees. On call 30 rupees, inner column. On put 5 rupees. So the total premium paid to create this strategy is 35. That you have to pay at the beginning. So that is the cost you have to incur to create this strategy. Point E, net payoff per option. Net payoff per option. Net payoff per option. So you will consider these two lines now. 0 and minus 35. Minus 35. 100 you will get, 35 you have paid. 65. 50 you will get, 35 you have paid, 15. This is per unit. Now write down last line. Last line write down total payoff on 100 options. Total payoff on 100 options. Total payoff on 100 options is 100 into 35 minus 3500. 100 into 65, 6500. 100 into 15, 1500 positive. So in some exam only for this much effort you will get how much? 6 marks. 2 marks, 2 marks, 2 marks. So whatever strategy they give, you just write the prices, do the calculation by the knowledge of call and put minus premium, and that gives you the answer. Premium you have to deduct in all the columns. Very good. Any other query? No query. This answer is over. Hello friends, good morning. Today we'll take topics on derivative, business and corporate valuation, and today is going to be very important for exam purpose. Some important questions which I believe would be asked in the upcoming exam will be taken. So please pay attention. Question number 2, derivative option. This question was asked in May 11 exam for 5 marks, October 18 MTP for 6 marks, and September 2020 MTP for 4 marks. So what is the next destination? Yes, the next destination, you have guessed it right, your exam. So question is, the current market price of an equity share of Penchant Limited is rupees 420. Current market price of a share is 420. That we will call S0. Today's price is called S0. Within a period of 3 months, the maximum and minimum price of it is expected to be rupees 500 and 400 respectively. So from 420, the price can be either 500 or the price can be 400 rupees after 3 months. If the risk-free rate is 8% per annum, if the risk-free rate is 8% per annum, what should be the value of a 3-month call option? You have to find the value of a 3-month call option using the risk neutral model if the strike price is 450. The strike price, exercise price is 450. You have to find the value of the call option today. And which model you have to apply? Risk neutral model. Risk neutral model means investor is risk neutral. He is not affected by the risk. He wants the same rate of return, which is equal to risk-free rate of return. Because he is risk neutral, so even if the risk is more, he would not be affected by that. He would be happy with a risk-free rate of return. So this type of model is called risk neutral model. There are several models for valuation of an option. This is one of them and more important for exam purpose. First what I'll do, I will give you a small note on risk neutral model. Those who want to write down can write it down, and those who want to just listen to me can listen to me. So I am going to give you a small note on risk neutral model. In case if you have forgotten, then it will be helpful to you. And if you are well versed with this, then you can simply listen to me. Let other student write. So write down, investors are indifferent to risk. Investors are indifferent to risk. Indifferent to risk means investors are assumed to be risk neutral. Investors are assumed to be risk neutral. So what is his expected return? His expected return is equal to RF. RF means risk-free return. So his expected return will be equal to RF. So very briefly, I'll give you steps involved to solve the problem of risk neutral. Steps involved in solving the problem of risk neutral model. Write down step 1. Step 1. Step 1. This is also binomial model. This is one of the binomial models. Okay. Please reply when I will ask you the question. First, step 1. Compute the value of the option at two stock prices. Compute the value of the option at two stock prices, two possible stock prices. In our question, the two possible stock prices are 500 and 400, and the exercise price is how much? 450. The value of the option can be found out. Step 2. Write down step 2. If you are writing, compute upside probability and downside probability. In risk neutral model, step 2 is important for cracking the question. You have to find out what is the probability that the stock will go up and what is the probability that the stock will go down. And how do you find the probability of price rise? Write down probability of price rise is equal to P is equal to R minus D upon U minus D. R minus D upon U minus D. Then your question is, what is R? Write down where R is equal to the amount to which an investment equal to the current price of the underlying asset will grow. Current price of the underlying asset will grow if invested at risk-free rate for the duration of the call. If invested at risk-free rate for the duration of the call. If invested at risk-free rate for the duration of the call. So what does that mean? Now look at your question. The current price of the share is 420 rupees and the option has a time of 3 months. So if it is invested for 3 months, e to the power RT. In your question last line, they have given you the value of e to the power 0.02 or something. So that is for finding the future value. That is what will be the price of the share after 3 months. What will be the price of the share after 3 months when invested at the rate of, what is the interest rate? 8% per annum for 3 months, compounded continuously. Now, how do you know you have to use continuous compounding? The last line of the question, e to the power 0.02, that is the formula of continuous compounding. So if 420 rupees is invested for 3 months at the rate 8% per annum, compounded continuously, what will be the value? That is the meaning of R. Now write down D. What is D here? D is the lower possible price. D is the lower possible price of the underlying asset on maturity. So in our example, D will be equal to 400 rupees. That is when the price of the share goes down, What will be the value? 400 rupees. Then your question is what is U? U means D for down, U for up. Okay. U means higher possible price of underlying asset on maturity. So in our example, tell me everybody, what is U equal to? 500. Very good. U equal to 500. So D is 400, U is 500, and you have to calculate the value of R. R is equal to this number. That will give you probability of the price rise. By what is the probability that the price will rise? Okay, now write down step number 3. Step number 3, write down. Step number 3. Step number 3. Value of call on expiry date. Find the value of call on expiry date. How do you find out? It is the weighted average of the values in step 1 with probability computed in step 2. So in the step 1, we have two values of call option when the price goes up and when the price goes down. In the step 2, we have probability that the price will go up and we have the probability that the price will go down. So multiply these two and you will get the value of call option on expiry date. But I don't want the value of call option on expiry date. I want the value today. So then you have to compute the present value. So last step, step 4, compute the present value of expected value. Compute the present value of expected value. Compute the present value of expected value in step 3. In step 3, by discounting at risk-free rate. By discounting at risk-free rate. Okay, very easy. Once you know the steps, you will find it very easy. And now I'm going to just apply these 4 steps in solving the problem of risk neutral model to find the value of a call option today. So first we'll draw a diagram. Now here the answer starts. Today the price is 420. Write down 420. And after 3 months, the price can be 500 or the price can be 400. S1 can be 500, S2 is 400. Compare with the exercise price 450. Compare with the exercise price 450. And you have to find the value of call option. If S1 is 500, exercise price is 450. Please reply, what will be value of call option in that case? 500 minus 450. The value of C1 will be 50. Very good. And if the price is 400, exercise price is 450. Call option will lapse. Option holder will not suffer the loss. Call will lapse. So C2, write down C2, typing mistake. C2 is equal to 0, write down. So when the price is 500, value of call is 50. When the price is 400, the value of call is 0. It will lapse. Now I have to find out what is the probability that the price will rise. For that, we'll have to apply the formula that we have learned. Okay. So now write down below probability of price rise. Probability of price rise. Probability of price rise. P is equal to, now instead of writing R, I have written spot rate into e to the power RT. Okay, spot rate into e to the power RT minus D upon U minus D. upon U minus D. Spot price is 420. E to the power RT is given in the problem. E to the power RT is given in the problem. 1.0202. Okay. Minus 400. Divide by this, you have understood. If I take e to the power r is 0.08 and time is 3 by 12, this becomes equal to e to the power 0.02. And in the problem, the value of e to the power 0.02 is 1.0202. So who got the answer? One student, Rishabh, has given the answer. 0.2848 you are getting? Yes, probability is usually written in fraction 0.2848. You can write in percentage also. Rishabh is right, 28.48%. Step 2, write on probability of fall in price. Probability of fall in price. Come on everybody. Please reply. Every student who is watching the lecture must reply. Yes, come on Mehul. Reply. What is the probability of fall? 1 minus previous answer. So that is equal to 0.71516. Okay. These are the two values of call option on expiry. These are the two probabilities. You will get 50 has this probability. You will get 0 has this probability. So now you can multiply the value with probability. You will get expected value on expiry date. Okay. Step number 3. Value of call option on expiry. Priyanka is right. Mehul is right. Very good. Come on, keep replying. Value of call option on expiry. So you just take the previous two answers. 50. This is 50 at the top. Into the probability of getting 50. 0.28484 plus 0 into probability of getting 0. 0.71516. So please reply what is the answer. You are getting 14.242. Very good. Now what you will do, this is the value on expiry after 3 months. What is the value today? The value today will be present value of this number. For that, the present value factor is also given. So present value of call, write down last step. Present value of call is equal to 14.242 divide by e to the power RT. Divide by e to the power RT, because we want to use continuous compounding. We want to use continuous discounting also. So when you have to use discounting, this will be written in the denominator. Anybody who wants to reply, and this figure is appearing in the question. Don't calculate. This is there in the question. 1.0202 divided by 1.0202. Come on. The answer is 13.96. Sidana is right. Anybody else who wants to reply? 13.96. Most of the time in the exam, the risk neutral model is like this only. They will change the figures, but basic concept will be the same. It was easy if you know it. That is for most of the questions, if you know it. Okay. That is for every question. If you know it, it is easy. Priyanka Kabra is right. Very good. Now we'll go to one more important question. Write down important for your coming exam. This question is based on multi-period binomial model, that is American option. Another highly tested question for exam purpose. Mehul is right. American call option. What is American call option? Anybody? What is American call option? What is American call option? One is called European option and one is called American option. American option, European option. European option can be exercised only on expiry date. American option can be exercised any time on or before the expiry date. American option can be exercised any time on or before the expiry date. So how to remember? European expiry, EE. American anytime, AA. Is it right? EE, AA. So this means the option can be exercised at any point of time. Yes. So let us go with the question now. Consider a 2-year, underline 2-year. Consider a 2-year means the option will expire after 2 years. The option will expire after 2 years. American call option with a strike price of rupees 50. With a strike price of rupees 50. What is the strike price? 50 on a stock. The current price is also 50. So what are the information available? The time to expiry is 2 years. Exercise price is 50 and today the share price is also 50. And what is the type of option? It is a call option. It is an American call option. Assume that there are 2 periods of 1 year. There are 2 periods of 1 year means today it is S0. After 1 year you will have S1, S2. Again after 1 year, that is after total 2 years, you have S3, S4, S5, S6. Each period, this period is of 1 year. Each period is of 1 year. So they have broken the 2 year into 2 parts. One part will consist of 12 months, 1 year. Okay. There are 2 periods of 1 year. Total is how much? 2 years. And in each year, the stock price can move up or down by equal percentage of 20%. So today it is 50, up 20%. So how much will that be? 50 plus 20%. And suppose it goes down 40. If it is 60 here, plus 20%. S3 will be 72. S4 will be 60 minus 20%. 48. 40 plus 20%. And 40 minus 20%. 32. These are the possible prices. These are the possible prices. You have to add 20% up, 20% down. It's a 2-period binomial model. The previous one was 1-period binomial model. This is a 2-period binomial American model. Interest rate is 6%. So you have to move backward to find the present value by applying 6% factor. Using binomial option model, calculate the probability of price moving up and price moving down. Same formula will apply. Same formula for price increase and price decrease. The one which we applied in question number 2. Then the next question. For calculating probability, you will get 2 or 3 marks. Also draw a 2-stop binomial tree. So this diagram you have to draw. 2 marks for that. Showing prices and payoff at each node. So what will be the value of the option at each node, at each point? What will be the value of the option? This is called American option. It can be exercised on or before expiry date. Okay, so first what I'll do, I will give you a small note on American option. Are you interested in writing, or you treat it as a revision? In case if you have already got this note and if you don't want to write, then just listen to me, and if you want to write, you can write. Choice is yours. There are students who are interested in writing, so I will give you a small note. In the exam this is not required, but one day before revising your syllabus you can go through it. Please write down. Please write down steps for American option. Steps for American option. Under that write down step 1. Step 1. Step 1 write, draw decision diagram. Draw decision diagram. Draw decision diagram and identify the market price, and identify the market price on various nodes, and identify the market price on various nodes until expiry date. Until expiry date. On various nodes until expiry date. You have to draw the diagram. Then the next line, step 2, compute the status of the option. Compute the status of the option. Compute the status of the option and find intrinsic value, and find intrinsic value and find intrinsic value at various judgment price, and find intrinsic value on various judgment price on expiry date. Find intrinsic value at various judgment price on expiry date. Point number 3 write down. Point number 3, the value of each previous node, the value of each previous node the value of each previous node is the higher of the following. The value of each previous node is higher of the following. Okay, so just let us continue. There was a small internet issue. So first step is to draw decision diagram. The second step is to find out the status of the option, whether it is in the money, at the money, or out of money, whether the value will be positive or 0, and find out the intrinsic value. For call option, intrinsic value will be S minus E or 0, whichever is higher, and for put option, intrinsic value will be E minus S or 0, whichever is higher. Okay, that is called intrinsic value. Now the next point is find the value of each previous node. Find the value of each previous node. Write down step 3. Students in the classroom, they are writing, so let them write. Find the value of each previous node. Find the value of each previous node. Find the value of each previous node, which is the higher of the following. Underline higher of the following. Higher of the following means, since it is an American option, You can exercise afterwards or you can exercise today also. So I will choose that option which is more profitable to me. If exercising today is more profitable, I will exercise now. If exercising later is more profitable, I will exercise later. So write down point number A. Write down point number A. Write down point A, expected value of that node. Expected value of that node being the weighted average value of branches, being the weighted average value of the branches which emanate from that node, being the weighted average value of the branches which emanate from that node. Emanate means originate from that node. Like the previous one, weighted average, value into probability plus value into probability. This is called value of later exercise. That means if you exercise later, this will be the value of call option. But in American option, you have a choice. You can exercise now also. So you have to check what will be the value if you exercise now. Write down. Compute the value of the node if exercised at that point. This is called value at immediate exercise. I will take higher of the two, and this process we will repeat till we reach year 0. That is called base node. So last step 4, write down. Step 4 for American option. Roll back to arrive at base node. Base node means year 0, S0. This is the fair value of the option. So very good question on American option we are going to solve. Students who don't want to write can take a screenshot of this. Okay. First we'll draw a diagram. Check whether the option is in the money, at the money, out of money. Calculate the value of the option. Go behind, go back. Find out the value of each point which is higher of later exercise or immediate exercise. This process will be repeated till we reach the base node. Let us see the application of the theory. So write down step 1. We have to first compute the present value factor. This is a problem of 2 years. Each period comprise of 1 year. Total is 2 years. So I will have to find out the present value of each part. That means time will be 1 year and rate of interest is given in the question. How much is the interest rate? 6%. So tell me what will be the present value factor of 1 rupee at 6% for 1 year using the continuous compounding formula. So please write down. If nothing is given, take continuous compounding. Calculation of e to the power minus RT. Calculation of e to the power minus RT, which is 1 upon e to the power RT, which is 1 upon e to the power 0.06 into 1. And the value of e is, you can write 2.7183. 2.7183. So please give me the answer of this. You have to give me the present value factor of 1 rupee discounted at 6%. Time is 1 year. Anybody, any answer? Please reply. Please reply. What is the present value factor for this? So it is approximately 0.94176. approximately 0.94176. 0.94176. 0.94176. Then write down step 2. Step 2, write down calculation of probability of price increase. Calculation of probability of price increase. So Rishabh Sadhana was right. Now we'll go to step 2, probability of price increase. Formula is same. P is equal to R minus D upon U minus D. Today the price of the share is 50 rupees. 50 into e to the power RT. This you write in power. RT, write in power. Minus 40. Divide by 60 minus 40. Divide by 60 minus 40. In some books, instead of taking the actual price, they take 1 rupee as a base and they make adjustment in 1 rupee. That is also okay. You might have been taught like that. So already the factor for e to the power RT you have computed in the previous step. Kindly solve and give me the probability. 0.6545. Is the answer right? Is the answer right? For probability of price going up 0.6545. Don't multiply by 0.94. That is a PV factor. You have to multiply by future value factor. So that is the mistake you are making. Rishabh is right. Mehul is not right. So the answer for 1 minus P is 0.353455. This is the probability of price going down. This is the probability of price going up. Now you got it right? Everybody? Say yes. Okay. Now we'll draw the diagram, which is your question. Draw the decision tree. So write down the diagram. American call option. It takes a lot of efforts to prepare such presentation. Okay. Because we have to do lot of animation. It is as good as writing on a board, but this ensures that we can do it faster and we don't make mistake. So we are well prepared in the classroom as a faculty. So write down diagram. Today the price is 50 rupees. Today the price is 50 rupees. After 1 year, the price can be 60 rupees, that is 20% up, or the price can be 40 rupees, that is 20% down. And the probability you write down along with the branches. Probability of 60 is 0.6545 and the probability of 40 is 0.3455. This is the first year, but it is a 2-year binomial model. If the price is 60, then it can go to either 72. This is after 2 years. After 2 years, the price can be either 72 or it can go down to 48. Understood? So tell me, what is the probability? Same. 0.6545, 0.3455. Write probability next to the branch. If it is 40 in year 1, then what are the two possible prices in year 2? Then it may be 40 plus 20%, that is 48. It can go up or it can go down. 40 minus 20%, 32. Is it right? Write down the probabilities also. Write down the probabilities also. Write down the probabilities also. Done. Now write down the action. What action will you take if the market price is 72 and exercise price is 50? Will you exercise or will you allow it to lapse? Market price is more than exercise price. It is a call option. You will say exercise. If market price is below 50, call option would lapse. So write down lapse. Again write down lapse. What about the last case? What about the last case? Exercise or lapse? Come on, reply. Lapse. Okay? Because in this last three cases, the market price is less than exercise price. So call option would lapse. So what will be the value of the option on expiry date? If it is 72, you will exercise and the value of the call option will be share price 72 minus exercise price 50. That is 22. Value of call, write down 22. Value of call, write down 22. Then write down 0 because it will lapse. Lapse 0. Again lapse. Again 0. Okay. So this is not the answer. We have got the value of option on expiry date. So we have to now move backward and reach this circle. C means P stands for circle. Okay, circle number. Just for future reference. So I will have to move backward and find the value of the option at C2, which is the higher of later exercise or immediate exercise. Later exercise will be 22 into probability plus 0 into probability. That is weighted average value. And immediate exercise will be compare 60 with 50. 60 is the value, 50 is the exercise price. So if you exercise at C2, the value of call option will be 60 minus 50, 10 rupees. Because market price is more than exercise price. You have a choice. You can exercise at this point or this point or this point. Is it right? Similarly, we'll do the working for C3. After doing working for C2 and C3, we'll again move backward and we will try to reach C1. Same process. So I have to find now the value of C2, C3, C1. Right below that. But the value you have to compute now. Okay, first you write, you will understand. It seems you have not studied this chapter before. Tell me, true or false? True. That is why you have asked this query. Now, this is a revision batch. So, please do not over expect. And if you have not studied American call option before this, you may find it little difficult at this time. So, please excuse me. This is not for the first time reader. Revision batch means there was a vision before revision. So write down higher of, koi baat nahi, it's okay. C2 write down higher of, at least I am trying to explain the way I explain in a regular batch also. Higher of the two, 60 minus 50 means immediate exercise. If you exercise at that point, and this is the expected value, this is the later exercise, 22 into probability plus 0 into probability, and then whole thing will be discounted. This whole thing will be discounted because you are moving from year 2 to year 1. You are moving from year 2 to year 1. So please tell me what will be the value of C2. It will be higher of, I'll simplify it for you, 10 versus this entire number, that is later exercise. So that comes to 13.56. So the value will be 13.56. Now same way you try C3 also. At C3, that is when the price is 40, the option will not be exercised because market price is below exercise price. So value of immediate exercise is 0. This is immediate exercise 0. This is later exercise. This is later exercise. Please solve. Because all numbers are 0, your answer will be 0. Yes or no? No need to apply any mathematics. 0 multiplied by any number is 0. So higher of the two, 0. Now we'll come to C1. Now we'll come to C1. C1 will be, what is the price today? 50 rupees. And exercise price is also 50. So the option is add the money. Add the money means exercise price and share price are equal. Value is 0. If you do later exercise, the value will be this number into probability plus this number which is 0 into probability and multiplied by 1 year factor and multiplied by 1 year PV factor. So what will be the two numbers? It will be higher of 0 versus 8.35. Any student who got it? Yes, 8.3584 is the right answer. You can round off to 8.36 also. Rishabh Chidana is right. Any query on this? Very easy. Again practice, you'll understand. This is called American option. Binomial multi-period American option. One more likely question and difficult question on this topic is Black-Scholes model. Have you studied Black-Scholes model? This is a question from November 2006 exam for 8 marks. So we have seen one period binomial model, then we have seen two period binomial model, but the other two models have some mistake, some conceptual problem, and that is they expect that price will have only 2 values, 4 values, 8 values, but in reality share price can be any value on expiry date, not just 2 or 4 or 8 or 16 or 32 values. On expiry date share price can have any value. So for that reason one Nobel Prize winning model was developed by Mr. Black and Mr. Scholes, and it is popularly called Black-Scholes model. They have got Nobel Prize in economics for developing this model. It is one of the most complicated financial model. Hence, there will be some calculation which we just have to accept as it is, some formula, because we will not be able to derive the formula in the classroom. It is beyond the scope of our CS syllabus only. Those are highly mathematical models, so we will just use the formula. You can see such questions are asked in the exam, so you can't ignore it also. Yes or no? At the risk of 8 marks, you can ignore if you want. You don't want to ignore. Then let us start. From the following data for certain stock, find the value of the call option. Again, call option. Usually they ask call option, easy. Stock price today S0, 80 rupees. Exercise price E, 75. Standard deviation of continuously compounded annual return is 0.4 sigma. Maturity period 6 months. Annual interest rate R. This is R. This is time T. It's 12%. Now they have given you a table. This table will be required for calculation of values. And I am going to explain briefly how to use this table. That is what the skill that you should have. Number of standard deviation from mean. This is a normal distribution table. Have you heard normal distribution table? And these are the standard deviation from mean Z. Mean is in the center. Then they have given area of left or right one tail. Underline one tail. Underline one tail. This one tail word is important here. If D1, which we are going to calculate later, is positive, value will be 1 minus table value. Value will be 1 minus table value. And if D2 is negative, D1 is positive means here. If D1 is negative, which means we are here. If D1 is negative, take table value as it is. Take table value as it is. So I'll just repeat if you can't read it on the screen. If D1 is positive and you are given area of the left or right one tail, D1 is positive 1 minus table value. And if D1 is negative, take table value as it is. Take table value as it is. Now we will see how to calculate. To help you, they have given you factor for e to the power 0.12 into 0.05. This will be required for present value calculation. No, that is the answer. This is the answer. Time period is 6 months. 6 months means 0.5. It should be 0.5, not 0.05. Question is wrong. 6 divided by 12 means 0.5 here. Okay. So you can rectify the question. Question itself was having this mistake. And this is the value of natural log. This also I will require in solving the problem. So in the exam, you are given the values. You have to apply the values given in the problem and solve. Black-Scholes problem are usually solved in 7 steps. What is the first step? The first step is write down. Now we'll solve the problem. This is a revision batch. So we will directly now solve, but I will explain every step. The first step is called calculation of ln S by E. ln means natural log. ln means natural log. Log with base E. Log with base E. So find the value ln in bracket 80 by 75. 80 by 75. Question should be in front of you. Solve. 1.066667 or something. Are you getting? Right. Then write down the value of this figure. which is printed in the question, last line of the question, 0.0645. Can you see the last line of the question? You don't have to calculate. One student is saying thanks to institute ln value is given. Yes, otherwise it will take some more time to calculate, but usually given. Otherwise there are some calculator tricks to calculate that also, but don't worry, if it is given, use it. Step 2, write down calculation of D1. Now here there is a complex formula which you have to by heart. We cannot derive this formula in our class. If we can derive, we will also get Nobel Prize. Our mathematical power in CA course is not enough to derive this formula. So this you accept it, but we will learn how to apply it. Write down ln S upon E plus R plus sigma square by 2 into T upon, in the denominator, sigma square root T. In the denominator, sigma square root T. Ln S upon E plus, in bracket, R plus sigma square by 2 bracket close into T upon sigma square root of T. Now ln S upon E we have already calculated. This we have just now calculated in our step 1. So that is 0.0645 plus rate of interest is 0.12. Can you see 0.12 rate of interest? Sigma is 0.4, but I have to take sigma square. So 0.4 square divided by 2 into time is 6 months. So 6 by 12, 6 months will be converted into year, 6 by 12, and then the whole thing divided by 0.4 into under root 0.05. So first what you do, first calculate D1. Solve this part first. Solve this highlighted part first. Are you getting 0.1645 in the numerator? 0.2828 in the denominator. Please reply. So one student has already replied. Very good. 0.5817 approximately. 0.5817 or 5816 approximately is right. This is the formula for D1. Now you please calculate D2. Students will please help me. D2. The formula for D2 is D1 minus under root sigma into under root T. Solve. D1 I have already calculated. D1 you take from the step 2, same figure. And this also denominator you have calculated here. So take the same figure. So save time. D1 and the denominator will be required in the second formula. So how much you are getting? Approximately 0.2989, or you can say 0.2988. Both are okay. If you are getting 0.2988, that is also okay. D1 is positive. This is also positive. You are given area of the left or right one tail. If you are given area of one tail, and if D1 is positive or D2 is positive, the value will be 1 minus table value. Value will be 1 minus table value for further analysis. Write down step number next. Note, because you will forget, I have written this note for you. Human memory is limited. When one tail table is given, note, write down those who are interested, not for exam but for your future reading. When one tail table is given, we subtract table value from 1. We subtract table value from 1. Now write down step number 4. Calculation of ND1. ND1 means normal density function. That is value of the D1 in the normal distribution table. So that is n into 0.5817. Now there is a small problem. What is the small problem here? You are given in a tabular format, value of 0.55 is given, 29.2912, 0.60 is given, 0.2578, but you need to find the value of 0.5817, which is between 0.55 and 0.60, which is between 0.55 and 0.60. So you have to apply interpolation. What you have to apply? Interpolation and find the value of 0.5817. So this is again a new problem for you. In classroom we sometimes used to round off to save time, but in the exam the institute have taken interpolation. Okay, if 0.55 is 0.2912, 0.60 is 0.2578, what will be the value of 0.5817? So I will help you now. Write down. So basically interpolation, whatever method you know, apply it, you will get it. For D1 is equal to 0.55, for D1 is equal to 0.55, area on the left or right one tail, is 0.2912, which is given. For D2 equal to 0.60, area on the left or right one tail, is 0.2578. Write down. Given one school level arithmetic, given change in number of standard deviation is to change in the area to the left or right. Okay, now you understand, if it changes from 0.55 to 0.60, this area changes from 0.2912 to 0.2578. So write down, on the left side I have written change in the number of standard deviation 0.05. On the right side I have written change in the area, which is 0.2912 minus 0.2578, 0.0334. But suppose I don't want to change 0.05, I want to only bring so much change. I want to only change from 0.55 to 0.5817. By what amount the area would have changed? Is it right? If I want to only change from 0.55 to 0.5817, by what amount the area would have changed? So write down below. 0.5817 minus 0.55 is equal to left side 0.0317, right hand side question mark. So now go back to your happy lucky school days. In school days when you are running around in half pant, this kind of equations were taught to you. Is it right? So what will be the value of that question mark? Cross multiply, divide by 0.05. So write down, therefore change required. These two numbers I'll multiply and divide by 0.05. 0.0211. So I have to change the area by 0.0211. Understood? This is called interpolation. Next line write down, hence if number of standard deviation from mean is 0.5817, area of the left of the right write down, area of the left of the right is equal to 0.2912 minus 0.0211, that is 0.2701. This will be the area. This is extra effort they want you to do. Now write down, hence n 0.5817 equal to, this is not the answer. Again the student can make a mistake. This is not the answer. I have to deduct this from 1. So that will give me the cumulative normal density value. So n 0.5817 equal to 1 minus 0.2701, which is 0.7299. Is it clear? Now don't be happy. We have to do the same exercise for ND2 also. We have to do the same exercise for ND2 also. I have given you the answer in detail. In case if you want, you can apply any shortcut. Okay. But you have to reach this number. This magic number is the correct answer. Now write down calculation of ND2. This time little fast. Just understand it is exactly the same thing. So I am not explaining. In the given question you are given 0.25 standard deviation is 0.4013 and 0.30 standard deviation they have given 0.3812, but we want 0.2989 value. 0.2989 will fall between 0.25 and 0.30, yes or no? So when a number falls between two numbers, we apply interpolation technique. So write down, given change in number of standard deviation. You see number of standard deviation is changing from 0.25 to 0.30, means 0.05 is the change. The change in the area is the difference between these two numbers, 0.0192. But I want to change from 0.25 to 0.2989 only. I don't want to go up to 0.30. So if this is the change, what will be the change in area? Solve. I have already explained it in the previous one. Please do practice of this question. If it appears in the exam, in the same way, it is a bonus mark. Okay. So this is 0.0188. Write down next line. Hence, if number of standard deviation from mean is 0.2989, the area of the left or left of right tail is 0.4013 minus 0.0188. So it will be 0.3825, very close to this number. Can you see that? Because it is 0.30 whereas this is 0.2989. In the classroom we usually used to round off this to 0.30 only. But institute will not agree to that. So write down n 0.2989 is equal to 1 minus 0.3825. Finally the answer is 0.6174. If you have learnt any other presentation, any other shortcut, you can do it. You will get the same result, 0.6175. Now write down step 6. Step 6 write down. Please write down step 6. Calculation of e to the power minus RT. Calculation of e to the power minus RT. That is present value factor 1 divided by e to the power RT. 1 divided by e to the power RT. I will give you the numbers. Student will solve and give me the answer. Unless you answer, I will not move. One divided by 2.7183 to the power 0.06 to the power 0.06. 1 divided by 1.06184. Are you getting 1.06184? Solve it, you will get it. And this is equal to 0.9417. If you look at your institute, they have given you the value of this 1.06. But their figure is wrong because it was for 0.05. Actually it should be 0.5. So I have done the calculation myself. So this comes to 0.9417. Now we are ready to solve. In the institute answer, you have to fight with the institute. Last step, write down 7 value of call option. I will give you the formula, you will give me the answer. Yes, everybody should reply. I am not getting reply from some students. Value of call option formula under Black-Scholes model is S into ND1 minus capital E, which is exercise price, into e to the power minus RT, e to the power minus RT, that is present value factor, into ND2, I want the student should reply. Okay, again to help you, I'll put the values. Now at least reply. Share price is 80 rupees. ND1 we have computed. Step number 4. Minus exercise price. Present value factor step 6. ND2 step 5. Anybody? Please come on. Yes, solve. One student Rishabh has answered. What is your answer? 14.78 is the right answer. So this is the steps to be followed. Okay. Now write one note. if cumulative factors are given, that is only for future, not for this question. If cumulative word underline, if D1 is positive, if D1 is positive, take the factor directly. Take the factor directly, which means they have already done the calculation. And point B, write down, if D1 is negative, D1 or D2, whatever, D1 or D2 is negative, then factor will be equal to 1 minus cumulative factor given. 1 minus cumulative factor given. Exactly opposite. If area under one tail is given, if area under one tail is given, the question which we have solved, and if the D1 or D2 is positive, 1 minus table value. Okay, and if D1 or D2 is negative, then we'll take the table value, right? But if cumulative factors are given, if cumulative factors are given, means already they have done the calculation. If D1 or D2 is positive, take the factor directly given in the problem. But if D1 or D2 is negative, then 1 minus table value. Then we'll take 1 minus table value. So this way they can ask question in the exam. Anything is possible. Okay. Now we'll go to next concept called over the counter derivative, OTC, or interest rate derivative. So here we will see some miscellaneous type of derivative. We have seen future, we have seen option. Now we'll see some interest rate derivative like forward rate agreement, okay, currency swap, interest rate swap. This type of question we'll see. Overnight index swap. So are you ready? Okay. Over the counter derivative means they are not traded on the exchange, but they are negotiated between two or more parties. Is it right? So here we are going to solve first one important question on currency swap. This is May 11 for 8 marks, and they are repeated in RTP and MTPs also. Now the next destination is exam. So come on, write down important, because I am waiting for this question to get repeated now. It is quite a long time. We are missing you. Currency swap, we are missing you. Please come. Question is A and B. There are two companies, A in, B in, incorporated, intends to borrow $2 lakh. So A wants to borrow $2 lakh, and B wants to borrow $2 lakh in yen, means equivalent of $2 lakh in yen. So A wants to borrow in dollar, B wants to borrow in yen for a 1 year time period. The prevalent interest rates are as follows. Prevalent interest rate, suppose A goes to the market on its own. A goes to the market on its own and it wants to borrow yen. Because it has a good reputation, it can borrow at 5%. But if A goes for borrowing in dollar, it will have to pay 9%. That is for A. B independently goes to the market to borrow in yen, it will have to pay 8%, and If it borrows in yen, in dollar, it will pay 10%. So who is a strong party here? Who is a strong party here? Who has a better reputation in the market? Who has a better reputation in the market? A or B? Quickly reply. It is not a difficult question. Who has a better reputation in the market, A or B? Please reply. Who is a better reputation? A can borrow at a lower rate, whether it is dollar or whether it is yen. So we will say A has got a better reputation in the market. So A has a higher bargaining power. A has a higher bargaining power. Got it? A has a higher bargaining power. The prevalent exchange rate is $1 is equal to yen 120. So $2 lakh multiplied by 120 is equal to 240 lakhs yen. Okay. They entered into a currency swap. So what is currency swap here? The currency swap means exchange of one currency with another currency so that both parties can benefit. What is A's requirement? Dollar. What is B's requirement? Yen. So how will the swap take place? How will the swap take place? So A will first borrow yen and B will first borrow dollar and then they will swap yen with dollar. Why A will borrow in yen? Because interest rate is less. Compared to B, they will save 3%. If A borrows instead of B, they will save as a gang 3%. B will borrow at 10% instead of A, who could have borrowed at 9%. So there is a loss of 1% here. But still, 3% gain minus 1% loss, as a group, if they combine, they will save 2%. They will save 2%. So as a group, if they come together, they will be able to save 2%. Okay, understood? That is the power of swap. They entered into a currency swap under which it is agreed that B will pay A, understand, line by line, at 1% over the yen loan interest which the latter will have to pay as a result of the agreed currency swap, whereas A will reimburse interest to B only to the extent of 9%. If you can interpret this paragraph, you can solve the problem. So first A will borrow at what rate? 5%. But A will transfer to B at what rate? 1% over 5%. So A will transfer to B at 6%. B will borrow at 10%, but B will transfer to A only at 9%. B will transfer to A, it is written here, at 9%. A will borrow at 5% yen loan, transfer to B at 6%. So A will gain 1%. A will gain 1%. B will borrow at 10% and transfer at 9%. So B would lose 1% on the dollar loan, but B is also gaining 2% on, not 3, 2%. 3 minus 1, 2% on this. So therefore the effective gain to B would be 1%. A will gain 1%, B will gain 1%, both will gain 1%. Keeping the exchange rate invariant. Keeping exchange rate invariant means assume that Exchange rate will not change. Assume that exchange rate will remain 120. Assume exchange rate will remain 120. Quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. Resulting from the designed currency swap. So how much will be the gain or loss to each party? Without solving only we can say both parties will gain 1%. So A will gain 1% of 2 lakh, $2,000. B will get 1% of 240 lakh yen. 1% of 240 lakh yen, how much? Yes, 2,40,000 yen. 2,40,000 yen. That means 8 marks you can get in 2 lines only. But we have to write the answer in detail. So write down please. Write down please. Requirement. Requirement write down. A's requirement is $2 lakh. Now how do you write the answer in the exam? A's requirement is $2 lakh. A's requirement is $2 lakh. I am teaching you also how do you write the answer in the exam, because same question 2 students get 2 marks versus 8 marks. B's requirement is B's requirement is 2,40,000 sorry 2 crore 40 lakh 2 crore 40 lakh. B's requirement is 2 crore 40 lakh. Understood? First tell me whether this part you understood. B's requirement is equivalent to $2 lakh and the exchange rate is 120. Continue. Swap arrangement. So what will be the swap arrangement? I am writing in detail. In case if you don't have time in the exam, you can write briefly also. Because I have to ensure every student understands, not only few students. There will be thousands of students who are going to learn this. So every student in the country should understand. A will borrow yen 2 crore 40 lakh. Swap will happen only if they borrow in opposite currency first. If they borrow in the same currency in which they want, where is the question of swap? A will borrow yen 2 crore 40 lakh at 5% per annum from the bank and give it to B at 5 plus 1. Instruction is printed in the question. 5 plus 1, 6%. I am not doing anything here. Question says 1% more will be charged to B. Point 2 write down. B will borrow $2 lakh. B will borrow $2 lakh at 10% per annum from the bank. And give it to A. At 9%. This is how the swap was executed. Okay. If you don't have time in the exam, then you can skip this. It's already printed in the question book. Now write down diagram. Diagram would be there are two parties A and B. This is bank of A. This is bank of B's bank. That is B has an account with this bank. Okay. So see practically how they will execute it. A will first borrow from its banker at 5% yen loan. A will borrow from its banker at 5% yen loan and A will transfer to B at 6%. Can you see the two arrows? A will borrow at 5%. A will transfer to B at 6%. B will borrow dollar loan at 10%. B will borrow dollar loan at 10%. Draw the diagram if you are interested. And B will transfer to A at 9%. Is the diagram important in the exam? No. But this is for understanding. See the movement again. For those who have not studied in detail earlier, A will borrow at 5 and transfer at 6. B will borrow at 10 and transfer to A at 9%. Now the question is, last line of the question is, calculate the gain or loss of the ultimate outcome resulting from the designed currency swap. So I have to present the answer for the exam purpose. Otherwise the answer is 1% of 2 lakh and 1% of 2 crore 40 lakh. So write first point A, write down. First heading write down gain or loss to A. Gain or loss to A, right hand side amount. How will you write the answer in the exam for full 8 marks? Question should be understood. Presentation should be such that they can't deduct even half mark. So A has borrowed from the bank 2 crore 40 lakh yen loan at 5%. So you have to pay to your own banker 12 lakh yen, correct? Keep the diagram, you will understand. A has given this loan to B at 6%. So A will receive from B interest. A will receive from B. A will receive from B 6% of 2 crore 40 lakh. 6% of 2 crore 40 lakh. 6% of 2 crore 40 lakh. Come on. 14 lakh 40,000 yen. But A has also taken loan from B $2 lakh at 9%. So you will write A will pay to B. A will pay to B 9% into $2 lakh. This will give you dollar value, but we have to convert into yen. So multiply by 120. 21 lakh 60,000 yen. So now you tell me the net total of this first 3 lines. Net total, net amount paid in yen. Net amount paid in yen, A plus B plus C. Now 1 is negative also. 2 positive, 1 negative. Sorry, 2 negative, 1 positive. This is negative, negative. This is positive, the middle one. So 19 lakh 20,000 yen will be the outflow. Now what is its equivalent amount in dollar? Point number E, write down equivalent amount in dollar. Point number E, write down net amount paid in dollar equivalent. Net amount paid in dollar equivalent. Net amount paid in dollar equivalent is 19 lakh 20,000 divided by 120. $16,000. Okay. So what it is effectively paying $16,000 with the help of swap. Suppose A would not have entered into swap. It would have directly borrowed $2 lakh from the market. What is the interest rate applicable to A for dollar loan? 9%. Interest rate payable by A on its own. Can you see in the first line of the table, A in dollar loan 9%. It would have paid to the market without swap $18,000. 2 lakh into 9%. 2 lakh into 9%, $18,000 without swap on its own. But with swap, it is paying $16,000. So what is the gain to A? One student, Mr. Rishabh, has answered gain to A is $2 lakh. 2000, sorry, 2000 is right. This is the correct answer. Okay. And now I am going to give you a small classwork. You have to write down the answer in the similar manner and calculate the gain or loss to B. So I'll give you 30 seconds to write the answer. I'll just come in 30 seconds. Please complete. Have you completed? Check the answer now. First you write down interest paid by B to bank. B has borrowed in dollar. So first B will pay interest to its bank 2 lakh into 10%, 20,000. Then B will receive interest from A 2 lakh into 9%. B will receive interest from A 2 lakh into 9%, 18,000. Then B will pay interest to A at 6%. 2 lakh into 6%, 12,000. All calculation first we will do in dollar. Are these three lines understandable? And then you take the net total, minus 20 plus 18 minus 12 is minus 14,000. And this is in dollar. So I will convert into equivalent yen. Net amount in yen. Net amount in yen. Yen 16 lakh 80,000. Now suppose B goes to the market on its own and does not enter into a swap. The interest rate applicable to B on a yen loan is 8%. So B would have paid, Cabra is right, 2.4 lakh gain to B. Very good, Cabra. So very good to all the students who have replied. Sidana is also right. 2,40,000 yen. Gain in yen. 2,40,000. Now if you present like this, you will get full marks. I also know the shortcut. Somebody will say, why you have done so much? You can just write 1% of 2 lakh, 1% of 2 crore 40 lakh, and the answer is same. Yes, you are right. Shortcut answer is same. If it was an MCQ question, do like that only. So this was my question number 1. One more question number 2 also will solve today. Those who have completed, I request you to read the question number 2. Read question number 2, those who have done. Okay, now we'll go to question number 2. This question was asked in RTP some years ago, but still important. Two companies AS and XY face the following interest rates. This is a question on interest rate swap, okay. The previous one was a question on currency swap. Name of these two companies. AS, similar question but little different also. AS Limited can borrow US dollar floating rate at LIBOR plus 0.5%, whereas XY company can borrow LIBOR plus 1%. Canadian fixed rate, suppose they want to borrow Canadian dollar, fixed rate of interest. Fixed rate means interest rate will remain 5% for the entire tenure of the loan. AS will have to pay 5%, XY will have to pay 6.5%. Again my question is, who is a stronger party? Who has an upper hand? Is AS Limited stronger or XY Limited is stronger? Quickly reply. Quickly reply. I can't wait so much. AS Limited, because on fixed rate also it has to pay less interest, and on floating rate also it has to pay less interest. So AS Limited has got an upper hand. Okay. So how much is the benefit here? Just understand, the AS Limited has an upper hand by 0.5% here, and here it is 1.5%. Wait, I'll change the color. On floating rate 0.5%, on fixed rate it has an upper hand of 1.5%. Okay. Now it says AS Limited wants to borrow US dollar at floating rate, and XY Limited wants to borrow Canadian dollar at fixed rate. So AS Limited wants floating, XY wants to borrow Canadian dollar at fixed. So if on their own, if they borrow, these are the rates applicable to them. But we have to check, can we enter into swap and gain something out of it? A financial institution is planning to arrange a swap. These two parties are in two different worlds. They don't know each other. So how do they enter into such transaction? So they are usually through an intermediary, a broker, which are usually big banks who arrange the deal and they get a commission. So financial institution is planning to arrange the swap and requires a 50 basis point spread. 50 basis point spread means underline 0.5%. 100 basis point means 1%. So they say I will get a cut of 0.5%. I will arrange the deal, but then I should get 0.5% commission. If the swap is equally attractive to AS and XY, equally attractive means both should gain equal percentage. What rate of interest will AS and XY end up paying? So what is the effective rate of interest they will end up paying? That is the question. So what will happen? AS will borrow at first fixed rate and XY will borrow at floating rate. Okay. In order to have a swap, they will take an opposite position first. AS Limited wants to borrow at floating rate, but then it will borrow at fixed rate. XY Limited wants at fixed rate, but it will borrow at floating rate. So what will be their gain or loss here? Instead of XY, AS borrows at 5%, so they will gain 1.5%. Instead of AS Limited borrowing at LIBOR plus 0.5, XY will borrow at LIBOR plus 1, so they will lose 0.5 here because XY has to pay a higher rate. But still, if I compare, they will together as a gang get 1% benefit. AS Limited will borrow at 5, transfer to XY, so they will get benefit of together 1.5. XY will borrow at LIBOR plus 0.1, LIBOR plus 1, give it to AS, who would have paid LIBOR plus 0.5. So in floating rate, together they are losing 0.5. In fixed rate, together they are gaining 1.5. Net gain 1 and commission is 0.5. So effectively, still they will get 0.5% benefit. Okay. This 0.5% benefit they will share equally. This will go to financial institution. 0.25 benefit goes to AS and 0.25 benefit will go to XY. Right? So first what I'll do, if you are interested, I will dictate you a small note on interest rate swap. Write down. One day before the exam, you can just quickly read it, just few lines only. Heading, write down interest rate swap. In interest rate swap, the two parties swap the interest obligation. One swaps the fixed interest obligation, other party swaps its floating rate obligation, such that both parties are benefited. Okay. Principal is not exchanged. Only the interest is exchanged. That is called interest rate swap. And whether interest rate swap is possible between two parties or not, I will give you a note for that. Whether interest rate swap is possible or not. Write down. Point number 1. Point number 1, write down. A switch from, it is better to write in the notebook, a switch from fixed to floating rate is possible. A switch from fixed to floating rate is possible. That is what we are doing right now. Fixed to floating. The strong company AS will borrow at fixed rate and swap it with floating rate. Only if the difference in the fixed rate available to the two parties, only if the difference in the fixed rate available to the two parties is greater than is greater than the difference in floating rate available to the two parties. In our example, difference in fixed rate is 1.5% and difference in floating rate is 0.5%. So swap is possible between AS Limited and XY Limited. Next line, write down. This is our question number 2 on this point. This we don't have a question on this, but write down for your exam. A switch from floating to fixed rate is possible. A switch from floating to fixed rate is possible only if the difference in floating rate available to the two parties is greater than the difference in fixed rates available to the two parties. That means if the strong company first borrows at floating rate and swaps it with the fixed rate, the difference in the floating rate should be more than the difference in fixed rate. Then the swap is possible. And you should know the swap properly, because in your financial reporting subject also, in Ind AS 109 financial instrument, there are questions on accounting of interest rate and currency swap. So this knowledge will be required in FR topic financial instrument. Now write down next line. Note, write down point number 1 and 2 above. Point number 1 and 2 above apply to the strong company. Point number 1 and 2 above applies to the strong company. Point number 1 and 2 above applies to the strong company. That is, write down little fast. In case of one above, point number 1 above, the strong company should desire to move from fixed rate to floating rate. The strong company should desire to move from fixed rate to floating rate. And in the case of 2 above, 2 means point number 2, and in the case of point number 2 above, the strong company should desire to move from floating rate to fixed rate. Strong company should desire to move from floating rate to fixed rate. So sometimes the question is whether a swap is possible or not. So to check whether the swap is possible or not, apply this test. If this test is successful, swap is possible. Otherwise, swap will not be possible. Now write down steps involved. Steps write down. Compute the difference in fixed rate. And difference in floating rates available to the two companies, and difference in floating rate available to the two companies. Now write down compute the net difference. Compute the net difference. Compute the net difference. I have already explained. Step 3. Split the net gain. Split the net gain between the strong and weak. Between the strong and weak in the agreed ratio. In our example, the agreed ratio is 1:1, equally. Okay. Both parties should gain equally from the swap deal. And point 4, which is applicable in our question, intermediary. If an intermediary is involved, the net gain should be arrived. The net gain should be arrived after deducting the commission. Okay. If intermediary is involved, the net gain should be arrived after deducting the commission. Now, in some question you will get in the exam, intermediary is not given. Then ignore that. If intermediary is not given, ignore that. Written the note. Now write down the answer. Just 2 more minutes. Step 1, calculate the net difference. Calculate the net difference. Step 1, calculate the net. From here the answer starts. So this will be your starting point in the exam. Okay. Previous few lines I have dictated for understanding purpose. Draw 4 columns. Particular column, AS Limited, XY Limited, and difference. Particular, AS, XY and difference. First write down fixed rate. Look at the question. What is the fixed rate applicable to AS Limited? 5%. Very good. What is the fixed rate applicable to XY Limited? 6.5. So if AS Limited borrows at 5% instead of XY, they will gain 1.5%. They will gain 1.5%. Write down gain 1.5%. Now write down floating rate. AS Limited can borrow at LIBOR plus 0.5. L stands for LIBOR. L stands for LIBOR. And XY will borrow at LIBOR plus 1. XY will borrow at LIBOR plus 1. So instead of AS Limited, if XY borrows, there will be a loss of 0.5%. There will be a loss of 0.5%. So what is your net difference? Net difference is still positive 1%. Say yes. So gain will be 1%. But between the two companies, there is an intermediary involved. Intermediary will also get 0.5% commission. So less commission to financial institution. Less commission to financial institution. 0.5%. Now my question to all of you is, what is the net gain? 0.5. Come on, reply. Net gain, net saving to both the parties. 0.5. This is what is the net gain, and then according to the agreed ratio, they will have to share this net gain. Agreed ratio is given equally in the problem, somewhere equally attractive written. Can you see equally attractive? Which means both parties will share equally. Step number 2 heading write down. Step number 2 heading write down, split the gain. Split the gain. Split the gain. So under that write down, AS Limited. AS Limited will get 50% of 50%. 50% of 0.5.